So it's basically like a bull steepener then, so the short end just comes down faster than the long end? Yeah, and that, look, history has shown that every single interest rate cycle, the curve, ends the hiking part of it flat or inverted. We've got more inversion this cycle, and then it re-steepens. Now, again, it's not going to happen tomorrow, but that's where we're going to end up, later in 2024. And I think that, but the main story is you need to prepare for, lower interest rates overall. The near term, the repricing happens right now. It's going to be volatile, but the big picture for bonds is you're going to get your yield carry most of the year. Higher for longer is good. If they don't cut interest rates for the back half, then you're just clipping a higher yield for longer, and then you've got price returns coming later in the year. So I think that's a good combination for bonds overall.
Good morning. Good morning, everyone. Good morning. Good morning. I'm your host, Cousin Benny, coming to you from theclosingprint.com. It is Thursday the 4th of January, as we ease into our first week of the new year. We got today, tomorrow, to try to make sense of this consolidation that we've seen over the last couple of days since the peak on Thursday, Friday last week to end the year. Okay, I see that the shippers are on the move. ZIM integrated. Okay, so we were looking for ZIM to break out. All right, it's currently up 60 cents. So ZIM looks good. Let's take a look at Disney as well. Disney is up 20 cents. Okay, ZIM. I might want to add to ZIM integrated. Okay, let's take a look at ZIM. Yesterday we were talking about ZIM coming into the end of the year. These shippers were showing strength. Okay, saw the volume. Additional shippers also looking good. Mic check, mic check. You guys hear me all right? Shippers, bulk carriers yesterday. Ranking these by performance. Okay, ZIM was on the move. TK, TNK coming off of the level. So just make sure you check out these names. I'll leave them on the screen for a second. You might want to jot these down. All right, let me get Thinkorswim up and running here. Hershey's is up another 12 cents. IWM is flat, a little bit lower at the moment, 50 cents. Okay, so let's see how the markets closed yesterday. How the markets finished. Sorry about that. Closed the wrong window. This is the way we finished yesterday. Okay, so you can see energy down on the bottom right. Utilities, energy utilities did okay. Some of the healthcare names like Lilly did well. What's Lilly doing this morning? Lilly. Okay, we got about 4 minutes to go for the opening bell. Let me make sure I get Thinkorswim up and running for our alerts. I have a doctor's appointment, by the way, at 3 o'clock today. So I have to leave about 20 minutes to 3. I'll be back most likely by 4 o'clock. Doctor's appointment today. Haven't seen a doctor in over a year, so got to do that at least once a year. Get my annual checkup. Not getting any younger. Okay. We got 3 minutes to go. 3 minutes to go. All right. So you can see where some of the interest has been: energy, utilities, healthcare, consumer staples, kind of mixed, but consumer staples, there's a lot of names there that are working, like PepsiCo, ConAgra, Campbell Soup, etc. Okay, Apple is lower again, down $2.35, headed towards that 160 target that I forget the analyst that gave it the target, the downgrade. Piper Sandler cuts to neutral this morning at 4:55 a.m. That came out. Piper Sandler downgrades to neutral from overweight. Apple. One way to trade Apple, if you're not interested in puts, is you could sell premium. You could sell maybe a couple of weeks out. Let's see, maybe February. Sell maybe the 192, maybe 195, and buy the 200. Bear call spread for income. Consistent income is what we're looking for. Pretty soon we'll probably be able to take a Iron Condor on Apple. With the recent highs, Apple has the call credit spread overhead, and a put credit spread target is like 170, but the 200 days right there, 160 to 170. The 200 days probably going to see some action right there. So maybe a Iron Condor on Apple at some point. What's Microsoft doing? Microsoft hanging in there. Okay, we've got less than a minute to go. Less than a minute to go. First 15 minutes, we're not doing much of anything except taking profits off the table. And then we look for 945, 950 for direction and high relative volume stocks signaling in play status and looking for sloping VWAP. All right, let's keep an eye on Disney. Disney. S&P gapping down a little bit. All right. Disney. All right, Disney's up a little bit this morning. There goes Nvidia. Nvidia on the move. Nvidia going. All right, so don't be sucked in early. Okay, Disney, Nvidia. Watch Nvidia here. Nvidia. Yeah, ZIM was Ali's favorite stock. ZIM Integrated. He rode that one down, insisting that it was going to reverse. All right, there goes ZIM Integrated. Okay. Okay, when does ZIM report? Because they have very high implied volatility. ZIM, let's see. They reported last time around. They reported on 11/14. So that's right around Valentine's Day. They report again. So if you're looking at calls or put credit spreads, look out maybe to February. Volatility is picking up. February. Okay. Maybe sell the 10. Buy 750.
Not at all. You are seeing around a 20% move to the downside here, Oliver. And you are right. They did adjust their forecast on several different fronts here, trying to narrow the Q4 guidance as well as their Q1 guidance and fiscal year guidance for 2024. I think the Q1 guidance is actually the biggest shock for the street. We're watching ZIM on the move here. Systems and may actually help out with autonomous vehicles, EVs, things of that nature. And we are actually seeing that they're identifying around 6 to 7 million units of the IQ system on a chip offering. Okay, nice follow through on ZIM Integrated. Excuse me. All right, so nice follow through, breaking higher. ZIM breaking above the 200-day moving average.
It's got an ATR of 90 cents. So you would be chasing it. You would be chasing it here. I'll give it a few minutes for the markets to settle down.
Yeah, definitely. But when we were looking at Mobileye, here's one of the key areas to focus on. They actually have been very innovative in this space. So the market actually has been providing them a little bit of a premium because even though we are seeing a little bit slower when it comes to autonomous vehicles, things of that nature, they do actually
Okay.
technology when you're looking at industry experts.
Disney, ZIM Integrated. All right. That looks pretty good. These shippers most likely will continue. All right, we got a nice bounce on the S&P for now. Let's keep an eye on the S&P because we want to get back above those closing levels yesterday. 4,700. We need to hold this level. Should see some puts monetized. Anyone with in the money puts below 4,700 are probably taking some profits off. Could see the markets lift a little bit. That's what we're looking for. If there's enough of that kind of liftage, if you will, we could see some calls being bought too right here. Nothing yet. Not a follow through yet. A lot of conversations about Bitcoin lately and the prospects of the ETFs and the SEC and Gensler approving AMD with a nice bounce. AMD, big bounce here. Okay, let's look at AMD. AMD. Okay, don't forget the banks report next week. If AMD holds here and follows through, that would be a really good level to keep an eye on. AMD. ZIM Integrated continues. All right, so right around 945, 950, we're going to be looking for potential trades if the markets are set up. And we see more shorts covering and puts monetizing. Markets should lift. Okay, we're right down here at that 4,700 level. That's the key level that we need to move back above. That's where all the option gamma is presently. Realize we're 3 days into the new year and we haven't done much in the way of trading. We've done a few things. We'll analyze those in a minute. Apple. All right, down there at 182. Let's see, IWM. Okay. Hershey's, some of the defensive names, consumer staples. Watch Hershey's. This looks pretty interesting. Hershey's chocolates. Hershey, Pennsylvania. Okay, so this looks pretty good. Breaking the downtrend above the 50-day. Yesterday was a good bit of selling, so we really want to see that negated. There was a lot of volume over the last week and a half. most likely institutions. Some shorts, initially, probably some shorts covering down near 180, 178 to 180. Pretty much looks like a base. Okay, accumulation. See the volume by price bands over here on the left. Prices flattening out, moving averages flattening out from a descending pattern prior to that. From July through October, this was in a downtrend, a markdown phase, phase 4, characterized by price below the 920 and 50-day. Now we're flattening out and starting to turn the corner. If we do turn the corner, this could be a good swing into, I don't know, first quarter, second quarter. A lot of stocks in the consumer staples. You should be focusing on consumer staples. Let's go look at that. Ranked by performance. Consumer staples are bought when the markets are in a consolidation or potential pullback phase. Okay. Let's rank these by percent performance. Okay. So Constellation brands. Okay. Coming out of a flat base. Brown-Forman, Altria, Kimberly-Clark, Philip Morris. Philip Morris looks pretty interesting. Okay, Philip Morris is trending. Okay. Colgate, I believe that's on the watch list, right? Yeah, Colgate's on the watch list along with Church & Dwight. Church & Dwight is known for baking soda. Church & Dwight. We also had Kroger, Kellogg looked good this week. Kellogg. All right, flagging at the 200-day. That's fine. General Mills actually looked a little better. General Mills, Procter & Gamble, that consolidating. Schmuckers. Okay. Now, the other group that's working really well, if you're interested in putting some money to work, healthcare stocks doing well. Merck, DaVita Health, Cigna, all of these following through. What used to be Anthem Health is now Elevance. Okay, that's following through. We had United Health also on the extended watch list, I believe. Yes, on the extended watch list. United Health following through. Humana. I have a secondary insurance card with Humana. Okay, that looks good. Let's see, Regeneron, Abbott Labs. Let's see, AbbVie. We're still trying to bounce here. All right, consolidating. Merck, we just looked at. All right, what's Bristol Myers? Bristol Myers had been changing direction, potentially. Okay, ZIM integrated. ZIM. ZIM, nice follow through. Okay. Disney. We had a nice support level on Disney yesterday. So this is consumer discretionary, Disney. We also recently saw Las Vegas Sands showing some potential. What's it doing today? Still consolidating. But note these stocks that are coming out of accumulation bases, flat base, moving sideways, moving averages, flatten out, and then start to turn up and to the right. Las Vegas Sands is just in the beginning of doing that. All right, some stocks are already at the highs like Pinduoduo. That's on the watch list. Okay, what's IBM doing? IBM on the watch list. Okay, IBM still consolidating for about the last 4 or 5 weeks. We're either going to break out or break down. This would have been a good candidate in hindsight for a butterfly or an iron condor, selling a call spread overhead and selling a put spread below for income as a credit. Obviously, in hindsight, if it starts to move higher, watching that IBM. If it gets up to 162, maybe a Iron Condor makes sense. Doesn't look like it's going to move much. It's $1.80 and ATR. Okay, Amazon. You guys can hear me, right? No one's telling me. Usually Captain Cautious tells me 30 seconds in, one minute in, if I'm quiet. Steven does as well. Most of you keep me apprised of whether or not you can hear me. All right, Amazon. Okay, that's kind of a step back. Okay, so the FANG stocks that have run up this year from the October lows, they're up quite a bit from the beginning of the year. We just have to keep an eye on them. Rotation, there's Tesla going. Tesla's at 237 now. Maybe something works on Tesla today. We'll see. IWM. Okay, I currently have a call credit spread on IWM, half of a Iron Condor. If this starts to consolidate right in here, I might sell a put credit spread, so that'll create an Iron Condor. Okay, I currently have a call credit spread. I sold the 126, January 26th. I sold the 210. I'm sorry, I sold the 205 and bought the 210 for a nice credit. That was yesterday, I believe. I think I had a limit order in for that. That got filled when I wasn't paying attention. Sorry if I didn't let you guys know. All right, Hershey's. What are the energy stocks doing? Delic, still sitting here. Hershey's. Hershey's looking pretty good, folks. Hershey's looking good. Now remember, this is just starting to show signs that the moving averages are going to turn up and to the right. Okay, so we had a fake out over here, up and to the right, and it continued to flatten out. It takes institutions weeks, several weeks, a lot of times to fill all their positions, several days, sometimes several weeks to fill a position. A lot of times you'll see this at the lows. Okay, I don't think Hershey's going out of business. Okay, so you can see what you're dealing with. All right, so you got 4 phases right here. Phase 2 on the left, as price action continues to make higher highs and higher lows. Distribution, phase 3 at the highs where it can't make new highs and it starts to flatten out. The 10 EMA starts to flatten out on a weekly time frame. And then prices can't get to a new high. It drops below the 10 EMA. That starts phase 4. Very clear. A lot of stocks go through this period. The key for you as a long-term investor or swing trader or position trader, if you're thinking about longs, this is the area where you want to start looking, okay, over the last couple of weeks, because it's held for 10 weeks or so since the late October lows. It didn't take off, but the volume is starting to pick up. Now, is this a guarantee this is going to continue higher? No, but you want to be looking for this phase 1 accumulation, which is what we're seeing on Hershey's, okay? And you can see nice price action. Volume isn't that definable yet. It's pretty low. But if we start to break higher, I will shift my call vertical up. I'll probably take the upper strike, the short strike. I'll roll that up, sort of like a synthetic long position where I would normally have shares and then a covered calls overhead. If it starts to move higher, I'm more than likely just going to roll those covered calls up and obtain the appreciation in share price as Hershey starts to move higher. And then I want to lock in or give myself a little bit more room by rolling that short call or covered calls, in this case a short call, move it up from, say, 195? 195, I'll roll it up maybe to 200, something like that. And let these calls continue to appreciate, because I have the February 190. I bought the 190, sold the 195 for Hershey's. Okay. Lilly, watching Lilly. I have a credit spread on Lilly. the selling the 580 put, buying the 570 put. I did this just a few minutes ago. Had a limit order in at the open. I wasn't paying attention. Sorry. Once again. Let me show you what I got here. All right. A limit order. I'll just post this in the trading room. Yes, yes.
So the streaming industry is definitely in an interesting point as we start off 2024. As you mentioned, for the last year and a half, the story has been that shift away from growth at all costs to really focusing in on profitability. And what we've been hearing from our experts at Thurbridge is the fact that
Yeah, brother Bill, I see what you're saying. Thank you, Captain. All right, so this is what I have on. I missed the opportunity to get shares. Shares took off. All right, so that filled this morning, 580, 570, 580, 570, 580.
Normally all that high up on people's lists as must-watch streaming platform, and they had the Showtime integration earlier this summer, or summer 2023, which didn't really make as much of a splash as they might have hoped for. They're still definitely trying to make things work, and perhaps benefit by having either some content or some benefits from scale to enable that distribution. Now, whether or not that's something like with Warner Brothers Discovery, there's definitely a lot of back and forth as to whether or not that makes sense. Also, on top of that,
yeah, I was talking to my son about this. Yeah, I was talking to my son about this. He's eager, like a new options trader. He's eager to make money. He's like, Papa, what would it take for me to make $10,000, my account, grow my account to $10,000 by the end of the year? I said, well, first of all, let's double your account. So we started at $1,000 on his account. On November 30th, we took our first trade. So I started an account with him with the goal to double his account by the end of January. All right. So we had a little bit of a snafu coming into this week. So he lost about $100. So he's currently at 1274. He was closing in on 1500. So he lost a couple of $100. I tried to explain to him that, you don't want to start taking risky trades. You want to do 90% or 95% consistent. In this case, we're doing credit spreads only for now. Consistent with about 90 to 95% of your trades. And then with 5%, and he gets this, 5%, you can take one risky trade a month or a week, whatever it happens to be. But the goal is to double your account by January. The only way we can do that is to be consistent. That means don't take too much risk. The tendency is to take too many credit spreads or to use credit spreads like a casino. Credit spreads are very, very definable risk. All right. So he understands delta. You want to sell like under 20. I like to use between 15, 17, maybe 18. Sell an 18. That means that you've got an 80% probability of not having to aggressively manage the trade. meaning you come in, excuse me, check it out in the morning. Check it out in the morning. And if everything is good, then, you go about your business for the day. Come back the next day, do the same thing. But if you have too much risk on and you have maybe you sell a 25 delta because you're getting too cocky. You sell a 25 delta and you have this week where the markets pull back. We had to take NVIDIA off my account. We had to take NVIDIA off because it was starting to get to an area where we were losing too much premium, losing too much credit. So I took that NVIDIA off. What's NVIDIA doing today? It's probably up. No, it's okay. All right. So that was a good decision. Excuse me one second. I'm going to clear my throat. All right. So I told him that, we're not going to be taking any kind of risky trades. He's just like, let's take some puts on whatever. Let's take some calls on whatever, because he understands puts and calls, but he doesn't understand leverage, and that the fact that, yeah, you can make money on the upside, but you can also lose money. We talked about theta and how theta can kick in and can create an issue for you if you have calls and it doesn't go and the stock doesn't go anywhere. Let's take a look at Disney. Or even worse, you buy the calls and the stock doesn't move. Like, say, Disney. Say you bought calls on Disney and you didn't take profits yesterday. It comes back a little bit. Now you're starting to lose some of the gains that you had yesterday. Looking for Disney to follow through. But that's the thing about directional calls and puts. Unless you're doing verticals for a debit, credit spreads, to me, condors, butterflies are the more consistent way to make money. You can also just buy shares, and even shares have an issue that the market is random, so you have to pick precisely where you want to get in with the least amount of risk. So anyway, long story short, I talked to him about that. He's like, already, as a new options trader, thinking like an options trader, he's already ready to like risk too much of his account and risk blowing it up. And I said, you're not going to make the mistakes I made when I first started trading options. All right. You're not going to blow up an account. And I'm going to teach you how to make consistent income. And then out of the 95%, out of the 100%, you're going to do 95% consistent income. And then of that 5%, we can take one or two risky trades, maybe one call or one put. But we're going to sit down and we're going to talk about why you would take that position. What does the chart say? What does the fundamentals say? What's the markets doing? What's the sector doing? Are all the stocks in the group moving together, like we've seen with healthcare lately? So if you're looking at healthcare, all right, so say you bought some calls on Merck. I bought calls. You remember when we went to Duke? I went to Duke with my daughter to visit the college. It was the end of October. And we thought that Duke was going to follow through. It just went sideways to down over the following 5 weeks. So the calls that I had to take them off because we lost about 40% of the call premium. Had we done an Iron Condor, in hindsight, that would have worked out pretty well, expiration in December, or a call vertical. But the point is that in the calls, if you were in a directional call situation, it didn't do anything, theta's kicking your ass, right? Now we got a trend going. So we come out of a base, pretty obvious base here. Let me zoom out a little bit. So I wouldn't chase Merck up here, but it's definitely looking better for a follow through. All right. So you got a base. Let me go to the weekly. All right. Big base. Okay. So the longer the base, the higher in space. So a breakout above 117. Look at the volume. What does that tell you? This is what I need to teach my son. Look at the volume. It's telling you institutions have been buying, and they've been buying since the lows at 100. So it's up 16 points. You think that's all they wanted? You think that's all they want? All of this volume? There's like what, 250 million shares trading hands in the last 3 weeks, last 3 months. So you think that's all they want out of Merck? I don't think so. Well, that's fine, but we need to see it break above 118 or so. If it breaks above 118 and volume continues, that's telling you institutions are in this for months, maybe into next, into the second, third quarter. So Merck would definitely be something I already have a position in Merck, but it needs to appreciate a little bit more. I've had these for a while. Now it's just starting to work over the last 6 weeks. So Merck would be one, okay? Another one in the healthcare group that I really like, AbbVie. AbbVie looking for a follow through, starting to flag right now. This is a daily time frame. Let me get rid of ZIM. All right, there's no hurry to do anything because the markets aren't following through. AbbVie. What about AstraZeneca, AZN? That looked good yesterday. Okay, it's above the 200-day now. All right, so yesterday I was telling you AstraZeneca in the healthcare group, in the pharmaceuticals, in the biotechs, it was pressing up against the 200-day 2 days in a row. All right, so wasn't able to get above it. Now that it has, that's definable. That's telling you that there's something going on here that's pushing it above the 200-day. It's no longer just shorts covering back here in December. This is new money coming in. Now it's not piling in, but it's showing you signs that this could follow through for a swing trade. Now let's look at the weekly, see what kind of prospects we have here. All right, so on the weekly time frame, if this isn't obvious, I don't know what to tell you. You've got a nice downtrend, okay? Now, is this something I would trade calls on? If it was calls, I'd be way out in time, probably March, and I'd probably be doing a vertical. More than likely, I would sell some puts, maybe a put credit spread to finance a long on AstraZeneca. You can see the weekly breakout prices above the 10 EMA for the past 4 weeks. So if you're looking for a nice long setup in a sector that's showing strength and stocks in the group are all moving, I would look at AstraZeneca as one example. What about Johnson & Johnson? Johnson & Johnson also turning the corner. Now, definable double bottom. Volume is okay. I'd probably pass on this one for now. Merck, Johnson & Johnson, AstraZeneca, AbbVie. So you get the idea. There's 4 of those. Eli Lilly. Eli Lilly's the other one, and Novo Nordisk, another one. All right, so here's Eli Lilly. All right, so what do you see with the Eli Lilly? Well, first thing I notice on the weekly time frame is that we have, oops, I don't want to do that, is we have a definite uptrend. All right, so that's the first thing that I would lay out on a chart. That would be, in this case, this is where I would be placing my bull put credit spread. So I sold puts, as I told you. I had a limit order good till canceled because I missed the entry yesterday. I didn't want to chase it, but I would like to buy or sell a credit spread. So I sold a 580. Look where the 580 would be. That would be a loss of this trend line. So I would know that this trade is not working if it started to lose, say, 620, 610. I wouldn't wait for it to get all the way back to 580 because that would just be silly. I would take credit. I would take the credit and the theta that I've accumulated probably in the next few days if it started to pull back. So I keep the credit. I just have less of a credit. And I'm going to keep the theta deterioration in these January 19th puts. Okay, so that's one way to make money. I want to be long, so I did the credit spread first, and I'll buy some shares if this breaks out. Look at the volume. Look over here, March, April, May, June, into August. We know that what is that, Wegovy obesity drug is doing well. What's Novo Nordisk doing? So we've got like half a dozen stocks in the healthcare pharmaceutical looking good. All right, we also have United Health. Oops, that's not right. United Health, UNH. So once again, you're going to get tired of me saying this. The S&P is on the move. You want to You want to take trades in sectors that are moving with the markets. And a lot of stocks in the group are all working together. Here's United Health, Tenet Healthcare, ELV, that used to be Anthem Health. Okay, these are all doing the same thing. All right, so your probabilities, every trader wants a guarantee that when they buy stock, it's going to go up immediately. Best way to get the absolute best entry is to wait for the pullback and then buy, because now the pullback is out of the way. You have a pretty good shot, if it's in the right phase and the moving averages are turning up and to the right, that you might have a good setup. All right, so let's look at Lilly again on the daily. Okay, Lilly coming out of a base, so very close to an area where, you know, if you'd bought down here 570, 580, you're doing really good now. Okay, so S&P is on the move. Okay, so here's a good example of what I was talking about coming into the week. If we hold today at 4,700, that's a critical level. We know that that's the level where all that gamma is built up, right? We know that 4,700 is absolutely paramount, that we hold this level. Okay, let me just show. Okay, here we go. So here are the levels as of the close yesterday. You see the call wall at 4,800. The S&P closed at 4,704. 4,700 is a major level. You can see these puts in here, the puts and calls. The blue is puts, the orange are calls. You can see this major area starting to build. Look at 5,000. Look at that. That's building out there into the future. You know that Oppenheimer and Fundstrat, Tom Lee's firm, have a target, I believe, 5,200 and 5,400, something like that, for 2024. So this is already starting to build at a higher level. So if that call wall starts to deteriorate, the 4,800 starts to lose the significance, and it starts to build out there at 5,000, we're starting to get an idea of what institutions are trying to do. Also, on the flip side, 4,700, you can see the puts and the calls are pretty major in this area. See all the blue down in here? All right, so this is puts. A lot of these puts are in the money. As we start to reverse and start to move higher, we're starting to see those puts being monetized. And that lends to fuel for more upside, to maybe head towards 4,750 resistance and then 4,800. Eventually, we're going to get above 4,800, hopefully. VIX is starting to roll over. Let's see what the dollar is doing. Let's see what the dollar is doing. Okay. All right. So the dollar is starting to roll over. And the US 10-year. US 10 years back to 4%. So that's creating a problem for equity longs.
Because our data are good, which it has been, inflation data being high. Yeah, which it has been, and we have been able to. Again, we had stocks just recently all-time highs. I mean, on the intro, you were, throwing the dial under the bus of the baby boomers. But I mean, I'd like to point out it was most recently posting new all-time highs just this week. The only one in the new year that did. So yeah, I mean, obviously a lot of focus on the Nasdaq, right? And even these numbers here, I don't really think that these are the most compelling data points for traders that are trying to gauge economic conditions. I think we're really looking at the jobs number as well. But yeah,
Okay, so Lily's starting to move. The S&P is starting to move. Okay, US 10 years at the high. So that's going to be an issue that we need to deal with. The dollar, the 10-year, the VIX. What's junk bonds doing? Junk bonds holding. All right, let's look at junk bonds. Now, this is important for traders to understand. If we hold junk bonds, anyone who trades junk bonds or high yield corporate has a lower risk tolerance. In other words, if the markets start to pull back, or they think that the markets are about to pull back, or they think there's some issue, they'll start to sell. So we saw a lot of that, a little bit of that coming into this week. Now, that said, we're sitting on top of the 21-day. We have an inside day. So it's important that junk bonds see more buying, catches a bid. Okay, so we had 4 days of, selling, elevating into yesterday. If we bounce and start to move higher, that's bullish for equities. It would also be bullish for equities if IWM bounces. Okay, IWM sitting right on the 21-day. Looks pretty familiar. A lot of the stocks are doing the same thing, right at the 21-day starting to bounce. After a 2% pullback in most cases, the Qs below the 21-day, a little bit more selling on these big tech names. The diamonds, all right, so the diamonds, we have big cap stocks, 30 of them. Major industrials, major industry groups, and the top names in those groups are the components of the Dow Industrial. So why is that important? Well, aside from, say, Apple, many of these are holding and seeing some accumulation. Let's see. All right, so we've got about 7 stocks red on the Dow Jones right now. Merck is number 1, Boeing's number 2. So Boeing pulled back recently, right below the 21-day. Would I buy it right now? No. I'd wait for a follow-through day tomorrow. 50-day turned up nice over the last 10 weeks. However, we've had a gain from October up to the highs, and this looks like it's going to be consolidation. So would you buy calls here? I wouldn't, because I'm looking for consolidation. Maybe I'd sell some sort of premium. Not sure what I would do just yet, but Boeing looks pretty good. Maybe just buying the Dow Industrials, the diamonds, works. The equivalent to the SPY on the S&P, DIA. Travelers insurance. I mean, this is pretty obvious, right? You got the base, phase 1. Let me get rid of this here. Okay, just pull this down. Excuse me. Okay, so look at the volume over the last several weeks. Look at where it broke out, Travelers Insurance. Mr. Flood talking about a lot of these names yesterday. Okay, a lot of these stocks look good. Okay, so you got this nice breakout. Okay, you got a flat base. The volume comes in. And then it takes off, 9/21/50 day. Would I buy it at the high of the day today? No, but I put it on my list of stocks to look at. Health insurance names, okay? Let's look at Cincinnati Financial, another insurance name, and then Chubb. Chubb was one we mentioned. Is that on the watch list? No, but I was looking at Chubb. Chubb following through, breaking out of this little cup. Cincinnati Financial, another insurance company. So if you're looking for swings, these are the things you should look at, okay? Let's look at growth and value again, because value has been outperforming growth as this line continues to drop. You can see value looks much stronger. It's above the 21 EMA, but it's consolidating for a week, not losing much, whereas growth has dropped off, trying to consolidate after a 10-week gain from October lows up to the highs. So I would be leaning towards healthcare, consumer staples, maybe some of the shippers, some of the transports, maybe some energy. All right, energy looking okay. Okay. Energy, oops, don't want to do that. Energy. Okay, looking much better now. Look at energy. All right, so we've got a higher high, a higher low to end last week. Now we've got a higher high this week. So that's good. RSI is rising. Look at the volume. Okay, about 45 million shares trading hands, 40 million shares trading hands the last 3 trading days. Energy looks like it's in play. Some of the major names, check those out, like Chevron, CVX, making higher highs and higher lows coming out of a cup pattern. So here's another one, another area. Or you could just buy energy. You know, buy energy. Doesn't move a lot. Okay, what's ZIM doing? ZIM integrated. Okay, Doji, that's fine. Spinning top, S&Ps, okay. What else? Diamonds, the Dow Jones Diamonds. Okay, this looks pretty good. Okay, so we're looking at that. Let's go check out the watch list real quick. Watch list. Where are you? Here you are. Watch list for the week. Okay, best case scenario, you're making money this week. Next best is that the markets are moving and you're not losing any money. Worst case scenario is you're in positions, you have no hedges, and we're pulling back, and you're starting to get worried. Okay, in the latter case, maybe you hedge a little bit to satisfy your anxiety. Okay, here is the watch list. Okay, you can see Mara doing very well. Mara, nice bounce off the 21-day. So this is what I would love to see all of the stocks we've already discussed this morning do. All right, you get a bounce off the 21-day, then you get a follow-through day on day 2. This is pretty high conviction. RSI is turning back up. Volume is picking up. Stochastic's turning. So while it's never a guarantee, this is pretty good. Mondo was adding to Maro recently on the pullback, I believe you said, right? Okay, what's Nio doing? All right, so Nio looks okay. All right, so this one looks really good. Mara, all right, so that's on the watch list. Again, here is HUT, also on the watch list. That's, the extended watch list, including stocks that, we talked about last week, not technically on the list. So I added those this week, carried them over from last week. HUT starting to bounce as well. What else? ZIM Integrated, we talked about. That one's doing really well. Coming in. ZIM Integrated has been on the watch list, I believe, for the last couple of weeks. Let me just check, make sure I'm correct here. I thought it was on last week's list. Maybe it was just this week. Maybe I talked about it last week. Let's see. December 3rd, 17. Oh, I'm in the wrong area here. Okay, so it's definitely on this week's watch list, right?
Are they going to come and materialize? Corporations have a lot of COVID cash on hand. Are they going to use that cash rather than fire people? Of the wait and see what these job numbers this year. Okay. Okay. Thanks, Phil. Again, appreciate the trade. Appreciate the macro thought and bonus for us from the portfolio manager, the rational equity on the phone. Great day. Go. We'll come back and talk some autos. Go over those numbers that we got earlier this week. We kicked things off with deliveries from Tesla, which were pretty solid, but BYD was kind of stole the show a little bit. Even stocks didn't react great. The numbers are closing in on Tesla in a hurry.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free.
All right, so S&P is stalling, but above 4,700. Don't think this is going to be just cut and dry. We bounce and we just follow through and make new highs. I think there's going to be a lot more consolidation in this area. At least that's what I'm planning on. Okay, let's see what's going on here. Microsoft doing well, pushing higher. Microsoft, Moderna. All right, Moderna fading a bit. Moderna looking for a follow through.
Download the Schwab Network app and join in on the latest market trends. Available anytime, anywhere, on any device for free. Recap your trading day with the wrap right here on schwabnetwork.com.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Let's talk some autos. As the delivery numbers from Tesla earlier this week seem to confirm that they are indeed the winner in America, but the real competition might be in China. BYD's numbers closing in fast. Anthony Sassini goes from trading shares to senior investment strategist. Anthony, welcome.
All right, so that Iron Condor on Rockwell is working. Let me show you what I'm working on here. Theta's kicking in. $11 on each side. Okay. So Rockwell, I have this Iron Condor. Let me just show you what's going on here. Okay. Implied volatility was above 30% yesterday.
They still did 1.85 billion. They had a good year, and from a technological perspective, from a brand perspective, they continue to be leader. Now,
Let's see, what do I got? 330, 340.
getting up to Tesla, I mean, what's even taking over them eventually? Is that just like the nature of kind of the reason which they're in?
And the 280, 270. 280. 270.
Yeah, no, absolutely. That's for China in general, right? Like when you look at China,
And that is for February. So we got a month.
despite being, great companies, and I mean, these cars are a little bit cheap. They're cheaper than Tesla, 20-30%. They operate on the lower end of the mass market. That's close to 200,000 RMB, which is like 25 to 30,000. Whereas Tesla's Model Y is at the top end of the mass market, right? So there's a little bit of a difference in pricing here. I think you will see BYD kind of dominate the Toyota market that we've seen in the highs, whereas Tesla is a little bit more of a luxury brand considered. And definitely they're going to sell more cars. Their cars are cheaper. And if you look for revenue,
Okay, let me show you what Rockwell's doing. All right, the S&P is starting to fade a little bit.
so far 95 billion as of Q3, where BYD's revenues were closer to 85-90 billion, but only 80 or 70% of that is open. So you can see the difference here, even when you look at margin.
Okay, here is, all right, let's go to Rockwell, ROK. Let me just keep a chart of Rockwell. I think I put a, you know what, let me save this in the watch list because I want to keep an eye on it. All right, so Rockwell, you can see that it's just moving sideways. So I sold a credit spread, Iron Condor, calls overhead, puts below, looking for price to just stay in between this area. Okay, here is that trade. Key things to look at: implied volatility is about 30% or higher. The deltas are all 18 or below on the put side. 25 is the call side. That increased a little bit. The theta is about $10 a day on each leg, so about $20 a day in theta deterioration. So I'm going to collect. If this continues, you can see in the bottom left side there where price is currently at 306 and change. As long as it stays between those diagonals, basically, the green vertical lines are where I maintain my maximum credit spread position. All right. So anything below or anything to the left or anything to the right, I start to lose money on the credit spread. I would gain on the other side if it moves to the left, or if it moves to the right, I would gain on the put side, and I might have to adjust the position higher. But the position for now is working fine because it's sitting right in the middle. This is 1 day after taking the trade. Data's kicking in, and it looks pretty good. So that's Rockwell. Not expecting it to go anywhere. That's a good example of why I would take an Iron Condor and not necessarily calls thinking this is just going to take off to the upside. Okay. So if it doesn't do that, that $10 a day on the call side, theta is going to eat away at your position. So you need more time and you need to do something in the money, most likely, if you're going to do a long on Rockwell. So that's Rockwell Automation. Let's go take a look at aerospace and defense. Aerospace. All right, let me just check Rockwell. I forget. Did I check the date? Rockwell earnings. Okay, last earnings was 11/2. So February 2nd will be the next report, most likely somewhere around there. Rockwell looks fine. On the 5-minute, 15-minute, or on buy signals, looking for the daily to go on a buy, but not doing anything right now, just chopping around. Okay, so some of these aerospace and defense names, let's see how they're doing. Okay, and let's go out. Let's see what these have been doing over the last week. BAE Systems, I believe they're in the UK. BAE Systems doing well. Nice move higher. Trades low volume. That's the only thing I don't like about it. Northrop Grumman in OC. Okay, that's at resistance. If it starts to fade a little bit, maybe you could sell some call premium. A put call spread. RSI is rising, buying picking up. MACD and stochastics rising at resistance. Let's see what's working at the moment. Okay, Merck, Boeing, Travelers, Verizon, Goldman Sachs. Timmy mentioning JP Morgan at the highs, right? Goldman Sachs looks like it could break higher. Now, remember, these are reporting in a week. Okay. Disney, no follow through. Moderna with a failed breakout. Let's see, failed breakout. Well, it's I wouldn't say failed breakout. I would say it's at resistance at the 200-day, which you would expect. 921. It could pull back to say 102. So if you're thinking about taking a stop, I understand that. Looking for it to bounce. So that's why we like to buy dips. Okay, buying into Tuesday's rally was a bit more difficult, right? Wednesday we consolidated inside of Tuesday's candle. Now we're fading another day. So you want to be buying on the dip, not the rip. So you can just practice getting used to buying after a flag gets close to support, like the 9 EMA. That's where you want to start to buy, not up here at the highs. Okay. And also, if you're going to go into something and you're chasing it, scale in. If you're going to take 1,000 shares, maybe you take 100 shares. You're going to take 10 calls, maybe you take 1 or 2. If you're going to sell a credit spread, instead of doing 10, maybe you do 2, that kind of thing. So once it does start to follow through, you can add to it. But if you're wrong, you're wrong on a smaller position. You're picking up Apple shares? Okay. Buying the fear? Okay. So contrarian trade there. All right. So the 200-day is right below, Scott. So if we can get to 200-day, that would be great. Okay. Apple testing the lows again. NVIDIA trying to hold this level at 240. IWM. All right, NVIDIA looks like it wants to go. Yeah, Brother Bill on Iron Condors. I don't know if you use this or not. Okay, I don't know if you use you probably do something similar. But here's the watch list. And in the top panel, you can see the credit spread, or the standard deviation, one standard deviation move, $5.33 plus or minus. So if you're going to sell condors, you could sell outside of standard deviation, like the 480 or the 470 put. Okay, and you would be standard deviation 1. So the likelihood that you're going to get filled, or rather have a trade go against you, is a little bit less if you can get outside of standard deviation 1. So below 470 or above 480. So that's why I put this on here, just for this exact reason. Whether you're trading spreads or credit spreads, or you're selling condors or something like that, you can look at these levels as one standard deviation. This is based on options on Friday at the close for the next week. Okay, so on Friday at the close, we'll know what the expected move is for the week, plus or minus $5.33. The Qs, $5.86. Let's look at the Qs right here. The Qs are currently trading 397. All right, so we still got a ways to go to get down to standard deviation 1. You see that 403.66 is the lower end of the Qs. 396, 396. All right, so we're below that level. Sorry, we're below that level. So we're inside of standard deviation 2, standard deviation 1. Same thing with IWM. Let me look at IWM. IWM is 194.81. So we're below the lower number here, starting to move back up towards the mean, which is what we're looking for. Okay. So Apple, just pulling back. Apple making new lows here. Apple making new lows. Amazon starting to bounce. Amazon is something that maybe we do here. Amazon on the dip. I'd like to see it base down here first. It's right on the 50-day. Seeing some activity. Let's see what. All right, you got the pullback. Amazon. Can we sell a credit spread on Amazon? Amazon. I put credit spread. Let's see what the 138 goes for. 138. All right, I'm looking at a potential credit spread on Amazon. It's got IB at 23% for this Friday. Let's go out a couple of weeks. Let's go to the first expiration in February. You got a 34% implied volatility. You got theta of $8 a day. Let's see, 144 is the low. What about 140? What is 140? 140 delta is 29, so you'd have to go below that. 135 maybe. 135 is a 19, so that'd be the high. That'd be the highest I would sell is 135. That's way down there. 135. What about an Iron Condor? That's an idea. Iron Condor on Amazon. $135 is a 22 delta. That's cutting it close. 135. Call side 155. That's a 34. So you'd have to go above that. Wow, 160. 160. That's a 24 delta. That's a little close. 160. Sell a 165. What is that? That's $5 wide. So 130. Oh, that's pretty good, actually. Okay, that's a potential trade. Amazon, Iron Condor, or a put credit spread. Okay. For a credit, 180 for $3, $320 in margin. Actually, cash in my case because I don't have margin. Let's see, 180.
Bullish outlook last year, that one was built on that belief that the market is fully discounting the most anticipated predicted economic slowdown in generations. I know we all remember that conversation. That didn't necessarily happen last year. Doesn't mean that it's not going to happen this year, but who knows? But they say that multiples have rebounded to historic norms. In fact, MX is trading right near its 52-week high, and it's trading at its highest levels in around 2 years. And so JP Morgan thinks that the risk reward outlook in the consumer finance sector is actually less compelling when it comes to the entire picture further on. They say less.
Okay, so it's a little bit rich on the delta. I would normally try to keep that under 20, but I'm going to monitor this today since I'm here.
Maybe they just see a little bit more happening with the entire picture than just with this stock itself.
And it seems like they feel like this is the only one worth trading, in the consumer finance and the credit space. Credit in particular, because you're going to get a lot more commercial and business credit here.
Okay, Amazon. Let me show you what I did on Amazon. Okay, here's Amazon. That's Roku. Here's Amazon. Okay, so this is what I'm looking at on Amazon. Looking for it to stay between these strikes. All right, so Amazon, I'm looking for it to stay between the strikes.
But there was some really interesting stuff that you could see if we were able to zoom in on our next chart here. So focusing on the past couple of weeks, you can see that we had a Harami candle. That's where we saw the real body of the one candle was completely encompassed by the previous day's candle. So it was an inside pattern here. So that suggests a solid trend. We can also see 2 dojis in a row. So that's where price opens and closes at the same level here. So we had 2 of those in a row, 2 days in a row, another sign of solid trend. We had once again, a few days later, another Harami.
All right, so I'm looking at this as this credit spread. If it starts to move in the right direction, I mean, if it just stays right here, this theta will kick in. Theta is about, if you take both sides, it's about $10 a day. Okay, and these deltas should come in a bit if we stay right in this area. We're right at the 50-day moving average. We could bounce a little bit more. If we bounce a bit more, then, there's a possibility I might take the call side off. If we move lower, the reverse is the case. I might take the put side off, okay? Keep the call side and just make the money as a credit spread on the call side. So right now, Amazon looks like it's just going to stay put in between the 50 and the 21 day over the next few trading days. So we've got, what is that? The second week of February. And price is just hanging out right there. So I'm just going to take it easy right now and see if Amazon could stay right in this area. S&P is pushing a bit higher. Okay, so everything's starting to work. What's Netflix is doing okay. Netflix. Netflix. All right, watching S&P pushing a bit higher now. Let me just go back to the S&P. S&P starting to grind higher. We got 4,700 as support. That's held. Yesterday's high that we were trying to get through is just overhead at around 47.30. Then we got resistance at 47.50. If we start to build here, folks, all of those puts, remember, you got a lot of puts down here. Okay. A lot of puts that are going to monetize. Okay, so watching these puts monetizing in this area, as we start to push off of this area, let me show you what I'm looking at. Okay. Okay, here we go. Dropbox. What the hell did I do with that? Okay, we're watching the markets grind a bit higher. Okay, so as we're starting to move higher, these puts down below, these blue shaded on the histogram, those puts are starting to monetize as we're pulling away from that major level at 4,700. If we can get above 47.25, maybe start to head towards 47.50, then more of these puts, the blue, start to monetize because they're losing value if it starts to move to the right. You can see the volatility trigger at 47.45. If we get above 47.45, this could really start to catch a little momentum and head towards 4,800. Okay, so that's what we're watching for right now. Yeah, it's a good idea. Good idea.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. They're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through. I definitely feel privileged to be in that position.
Trading the trending names every day. It's fast market. Ready for you, ready to go. I'm Kevin Hicks. Catch me on Fast Market. Weekdays.
All right, so you know, I was having this conversation with my son, talking about. All right, so that's the close. You've seen that. All right, so we're talking about. You see those blue? See the blue? That's puts. Okay, all of those puts. Think about it. The market's dropped down to 4,700. You got the 4,700 put, or maybe you got something a little bit lower. Now markets start to hold this area. Why is it holding? Because there's so many puts at this level. so many calls that when we start to move in the bullish direction, all of those puts are saying, holders are saying, holy shit, I better take profits. They take profits. What happens? The dealer is no longer short that put that they sold to Joe Plumber. Joe Plumber takes profits, monetizes those puts, takes the profit. Maybe they flip and take calls. Maybe they take calls. That creates more energy. The energy starts to build on itself, more and more people. The dealers are no longer short the puts. Maybe now they're short calls. So you start to see the markets lifting. Okay, so that's the importance of what we're dealing with right now, that support level. That's why 4,700 is holding for now. If we lose 4,700, then all of these puts down here start to weight a little bit more. Okay, now on the opposite end, you see the 4,800 strike? Look to the right and look at the lack of puts up there. So those puts need to fill in. That'll create a structural support as we move higher. You might think, well, they're buying puts and they're in the money. Yeah, maybe somebody's selling them too. But the point is that we need to build more puts, not just calls. You can see the orange, we got a lot of spikes, a lot of calls built up there. And you can see the 5,000 strike. Excuse me. You can see the 5,000 strike is building both puts and calls. So that's going to be formidable resistance at some point. And it could be that the call wall is already starting to shift from 4,800 a little bit at a time out to 5,000. That happens to be the area where Fundstrat and Oppenheimer have their targets. Now, I believe JP Morgan and those guys have targets that are lower, like 4,600, 4,500. I forget exactly where. But what's NVIDIA doing? NVIDIA, all right, NVIDIA is turning the corner, folks. While I'm yapping here, NVIDIA is turning the corner. Okay, so you know what we expect with this. Now, here's the thing. We just bounced off support, 4,700. We got 4,800 overhead. So if you were going to define an iron condor, if we manage to get back to 4,750, maybe you sell something like a 4,810 or 4,825 and buy like 4,850 overhead as the call side, and put side, maybe you do 4,650 or something like that and buy the 4,600. I don't know, it's a lower put. You have an iron condor, or you sell premium. Maybe you sell the 4,650 put and you buy the 4,640 put for insurance, for your maximum risk, all right, to define your risk. And you look for prices to move away. That's one way to trade it long too. Or you could just go calls or call verticals. So a lot of ways to go long and short. Just depends on what you're thinking the market's going to do. We could just stall here and not go anywhere, which is what Bill's hoping for. Brother Bill took an iron condor, so he's looking for price action to be more neutral, another bear flag, or excuse me, another flat VWAP. Thank you, Bill, for that post on copper. Let's go take a look at copper, talking about potential needs for copper. Copper is a leading economic indicator for construction-related industries. All right, so copper, higher highs, higher lows for now. Okay, so it's in a relatively flat, neutral position right now. All right, watch NVIDIA. NVIDIA. Okay, here's another one. I would probably only do a credit spread on the put side for NVIDIA. I don't think I'd want to do a iron condor. The other thing about starting an iron condor after we've had a pullback and the price action is moving sideways. Okay, so look at NVIDIA. I want to show you something. All right, so this is the way my brain works anyway. So you see the upside. Okay, here's the upside. Support, resistance. And then lately, we've got this tightening price action. Price moves down, moves back up, moves back down, and so forth. Moves back up, but it doesn't make it through 500, 505, 510. So when I look at that, I'm thinking to myself, okay, price action is fairly neutral. If I'm thinking about call verticals or calls, I want to see momentum pick up and to start to rip back up to say 500. But for the most part, it's pretty neutral. It's inside of this pattern until it breaks out. So I could be selling premium on either side of this, overhead or below. With me, it would probably be below because we're making higher lows. So I would probably sell something like the 470 put, buy the 465 for defined risk, collect a credit, experience theta decay, collect that on a daily basis. So I would probably take a put credit spread on NVIDIA if this continues. And then at some point, if it starts to break out, then I can get long shares and sell covered calls. All right, let's just take a look at that, Corey. All right, so Amazon. It's about a 50% return on my money that's sitting in cash. All right, so that number there, the $320, $320 is the amount that Schwab will keep in. We'll put on the side just in case the trade blows up and I wind up falling asleep and I'm not paying attention. Okay. So that's what, 56% return on my money. I believe that's about right. 320 of 180. That's about a 56% return on my money in a month. All right. So 12.5%. 12.5%. Well, a little bit more than that. 13% a week return on my money. Where can you get 13% a week? 12.5%. Where can you get 12.5% return on your money in a week? Okay, if I hold it all the way till expiration, that's a 56% return on this $320 that I put aside in my account. Relatively, like I was teaching my son, consistent income. This is consistent. I mean, I'm doing this trade over and over and over and over, whether it's an iron condor or a credit spread. I'm always looking for this number to be about 50% if I can get it, 25 to 30% in some cases. But if I can put 320 aside and let that sit there per contract, let's say you take 5 of them, so $1,500 versus $1,000 or a little bit less than $1,000. So I put 1,500 aside. Can I make 1,000 in a month? Think about it. Now this is a neutral setup. Okay, I'm looking for neutral. I'm not looking for this to break out to the upside or to the downside, but I'm covered if that does happen. If Amazon breaks out to the upside, then I just close that side. I make less of a credit on that side, but I keep the put side. Or if this starts to break out to the upside, I can always roll this upper half higher. Okay, I can roll this up, this Amazon, I could roll it up to say, sell the 160, buy the 170, buy the 165, sell the 175. Okay, so I just roll these two strikes, just roll them up $10 or however I need to. Because I'm making money on the put side if it starts to break out. If it starts to break down, the opposite's the case. I would roll these down and I would just continue to collect the premium on the call side. I prefer it to stay in the middle because this is a neutral strategy that I wouldn't have to manage at all. All right, sorry, I got sidetracked there. Just a reminder, I have to take a break later. I have to go to a doctor's appointment at 3. I don't think I have it, but I spent a lot of time in the sun. I don't want to save this. Okay. I'll just keep it at that. I got a doctor's appointment at 3 o'clock, so I have to leave here about 20 minutes to 3 today. Be back by 4 by the close. What is going on here? Nope. All right. So NVIDIA. The problem with just taking a long. All right. So this is I'm talking to my son now. Okay. The problem with taking a long, Antoine, is that you have to be correct and you have to have impeccable timing. Okay. You want to trade a delta of about 40, maybe even 50. I like to trade in the money, buy an in the money, call if I'm long, buy an in the money call, sell an out of the money call, say a 20 delta. So I know there's a 20% probability that short delta is going to bite me. Whereas the 50 or 60 delta is going to make me money on the call side, but it's got to move. It has to move. Like NVIDIA, if you're on the long side, NVIDIA has to move today, tomorrow, and follow through. We see the same thing with Disney. Disney's not following through. Okay. So Disney's actually erasing all of yesterday's gains, it looks like. So we'll see what happens here, Disney. I might have to cut this one loose. The 50 and 200 day are support. Okay, the 50 and the 200 day are support. So I'm looking for a bounce. I have March. I have a March vertical. I bought the 90, sold the 95. So the short vertical on Disney is helping on this little pullback. Let's see, Disney. That's okay. Actually, I'm surprised that the call side hasn't lost as much value. That's because it's way out in March on Disney. Stochastic's trying to turn. Okay. Like I always say, it's never a guarantee, but if you're going to get the best probability, it's going to be if we stay above the 50 and 200 day. Okay, what's Hershey's doing? Hershey's. All right, Hershey's looking a lot better. Earlier I mentioned Hershey's. Okay, let's look at Hershey's. HSY. It's a defensive sector. Consumer staples. Look at Hershey's. Hershey's follow through day. All right. Okay, I think I saved this, right? Hershey's. HSY, HSY, EFGH. No? I was making a, oh, you know where I saved it? Probably in the consumer staples. Consumer staples. Or maybe I saved it in the watch list. Let's see. Hershey's. Oh, let me do it here anyway. All right, so let me just go to default. Okay. All right, Hershey's is working, folks. Hershey's is working. If you took that, I know Frano likes to trade this one from time to time. Okay, there's our resistance. There is our support. Oops. Okay, let's put a Fibonacci on here. Oh, let me just save this real quick. Okay, let me add extra bars because I want to put a little space over here so I can see it. Let me put Fibonacci's on here. So a Fibonacci breakout. Actually, I want to do it the other way. Here. Okay, so look where 1618 is, okay? So I'm looking at I'm looking to make some targets. We got a pivot right now. So if I take this down to this previous pivot right here. Okay, Hershey's. See that pivot right there, 191.62. That's where we're breaking through right now. So that's about right. 1618 would be a break to 200. So about 7 points, 6 points. Okay. If we get through this level, then I can go to the next. I can go to the next. Okay. Okay, so let me oops. Okay. So Hershey's looking good. It's working. So I got to go the other way again to that level. I watched the end of that Bernie Madoff special on Netflix. Man, what a mess. What a screw up that guy was. I mean, obviously, right? But if you look at the details, all right. RSI is above 50, so that's a good start. Okay. And all of this time over here, Hershey's has been on a downtrend for the most part. A little blip there higher in November. We're gonna discount that. Okay. Stochastic is now in the red zone. The other thing about doing this with charts is that it keeps you from, too frantically chasing prices or charts. You got plenty of time. This is a game, a business that you want to take your time, just like a coffee shop. If you own a coffee shop, I know it's a weird analogy, but just like a coffee shop, if you have a nice customer base, you don't just go out and buy lots of inventory because you don't know if, things are going to continue to do well. You got to monitor it. You got to do trends. You got to do what does the different months look like. You've seen businesses do that. So, you take your time. You don't rush into buying inventory. You don't rush into changing prices. You don't rush anything when you're in business. Same thing with stock trading. You don't rush into taking a new position. You want to build around your thesis. In this case, my thesis says this accumulation phase 1 is the accumulation, and you can see over here on the left side, this is institutions. You can see the volume over the last few weeks building, and price action is now starting to turn up and to the right. It's still early, just like Disney yesterday. We're still looking for Disney to bounce, looking for buyers to step up the low of the day. But it's the beginning stages of a trade. So in this case, if I was going to take 1,000 shares of Hershey's, I would only do 100 shares. Maybe I would add today 100 shares, double my position because it's moving in the right direction. In my case, I have a call vertical on Hershey's. Expires the second week of February. I bought the 190, I sold the 195. I'm already up to maximum gain. So I can do one of two things. I can close the position and start a new one, or I can roll this short strike that I have at 195, which is what I'm going to do. I can roll that up to, let's see, 200. Let me roll it up to 200. Same month. It's going to cost me a little bit, a debit. 195. I'm selling the 195. I'm going to buy the 195 to cover that short put, a short call, and I'm going to buy the 200, rolling it up essentially. All right, I'm going to see if I get filled. It should, because it's a pretty liquid stock. Sorry about that, guys. Got sidetracked. My apologies. Okay, so we're starting to move a bit higher. I want to roll these short calls up. And I'm not getting a fill yet. Let me go change that order to a 240 debit. Okay. Or I can just take Hershey's off. You know what? Let me roll the whole thing up.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a year.
Let me roll this position up. That's what I'm going to do. Positions. Hershey's. I'm going to roll the Hershey's position up. Hershey's. Roll out. Okay, I just rolled up Hershey's. Just rolled Hershey's. All right, I just rolled it up from 190 to 195.
Wrap up the trading day with me, Oliver Renner, for the biggest earnings coverage, 3 p.m. Eastern. It's market on close. No place better than the Schwab Network.
Consistent income. That's the whole idea. All right, so this is consistent. It's making money. Hershey's looks like it wants to break out. Okay. Let me just update this. Okay, moving through 195. I just rolled up to 195 and sold the 200, making money. Now that's the way I like to do call verticals. If the calls work and it looks like I have plenty of time and it's working, it's doing what it's supposed to do, then a lot of times I'll just roll them up. I could have just taken profits as well. But it looks like Hershey's going to work a lot longer. So as long as this keeps going up, I keep collecting a credit on the move and making money as it keeps rising. Okay. What's Disney doing? Disney. All right. Buyers are starting to show up on Disney. All right. All right. Disney pulled back, shaking people out, maybe. I don't know. QS is on the move. All right, let's look at QS. Whoa, nice move on QS. QuantumScape could be. Didn't Kathy buy that at some point? Okay, Disney. Okay, I got to take a couple minute break. Give me a couple of minutes. I will be right back. Let me just go to the S&P. S&P working.
since. Again, as mentioned, it's a very bullish pattern. Looking at a 60-minute candle chart, you can see the vertical conviction on the left side of your screen and the horizontal development, the acceptance of that big move up here, currently bouncing around 60. Now, let's take a step back, because as we do, and look at a daily candle chart, almost an identical pattern, right? So, again, remember this. Take a snapshot. We're going to talk about this a lot today. I want to show you here again, conviction on the left side of your screen, beginning of 2022, February, March, April, May, since June, July of 2022, and all throughout last year, we've been sideways, and in this instance, we're talking around 65 on the daily candle chart. Another step back shows how this really starts to stack up here. You go all the way back to fall of 2020, you're going to see that pattern repeat itself multiple times. This provides the longs opportunities to try and participate to the upside in terms of this trend higher upside. Let me just clean this up here a bit, but basically you can see again these really well-defined areas of consolidation here in the call that gets separated by the vertical conviction, and then again here's this consolidation.
All right, NVIDIA turning quite nicely now. NVIDIA. NVIDIA turning. All right, nice move on NVIDIA.
I like what I see, and I like the fact that these stocks are being down inexpensive, have great risk reward. Again, it's 50% off the 2022 top. You know, up top of this range that we've been in, targets 50.
All right, S&P making new highs now. Nvidia going. Looks like everybody's buying.
All right, good to know. Last but not least, here, Pfizer's on your radar. Tell us a little bit about this one.
Ben's not going to agree with anything I say, so he can turn off his mic. Pfizer's trading about 29 and a quarter right now. It's a 6 stock. It was down 40% last year. Now, that's why I look at this as opportunity. And the way that I trade is more important than the stock in this particular instance. So, if you look at it, it's been between 25 and 35 for 6 months. We're right now at that 30, that 30 range. If we get to that midpoint, then we should pop up to the top of the range at 35. There's a lot of upside. There's gaps up above. In the big picture, I don't want Ben to dial out. We make between 30 and 60 for 10 years. Okay? 10 years. So let's use that 30 as a kind of pivot point, a support point to lean on it. The way to lean on it is to buy it in the money option, buy a 30 call when we have here a 32 call I had. I'm sorry, 25 call. 25 calls trading for about 475 or 5 right now. It's 415.20. The expiration break even on it's 50 cents higher with almost 6 months of time. And the PE on this stock is low. So a lot of pharma stocks, a lot of bio stocks haven't really enjoyed a good year. Moderna was a dog last year as well. Both of these were down 40%. I like the bottoming formation. I love the bullish divergence. That's my sign that the sentiment has shifted. And you're going to see these sellers that have run out of strength, and then that stock can move. Now, again, a modest move in this stock can produce some big gains. When we talk about 35 is the range top right now. So, if that happens, just gets the range top here in the last 6 months, this option gains what, 100%.
All right, and a lot of folks have been coming on and taking this name so far this week, even, our guests that have been coming on. Ben?
Did queue up that longer-term chart Alan asked for. I don't think it really provides a lot of clarity, but we will take a look at it. Let's begin first and foremost with the similar pattern we were talking about in terms of the other 2 names, high conviction on the left side of your screen. Now, this is a 5-minute candle chart, and you can see the sideways consolidation, but you can also see how it kind of started to leak lower, right? Getting back quite a bit of this move up. That's not what the bulls are looking for. And let me just show you here. I did try and identify an area of consolidation, but we continue to extend that to the downside right now. So I think maybe this could be a bit of a breakdown playing out before our eyes here. It looks like stock's starting to roll over after a big move up to 30. Take a look here, stepping back, we can see that, well, this big move up has been kind of continuation of the rally we've seen off the lows around 25, 26 back at the end of, or I should say middle of December. And I went ahead and identified a couple of areas of consolidation along the way up just to kind of help us map out.
All right, we'll continue to rise now.
These areas for us to reference on the way down, because while we are starting to roll over here, this still could be a buy opportunity as long as trend environment to the upside.
AMD volume.
Again, we're looking at 2850 right now. Everything above that's still supportive of the idea that value's still moving higher, trend still continues to play out. It's pretty well defined your bottom left and top right. But take another step back, and you're going to see a bit of a different pattern playing out with both daily time frame. Oftentimes like to say, when in doubt, zoom out. I think the more you can trade the bigger picture, oftentimes depending on what you are, you get shaken out of those trades that oftentimes you do if you're focused on the more intraday granular, a lot less when you're stepping back here, and it's just a lot easier to sleep at night in many ways. Taking a look though at this is a trend lower here, and what I'm seeing, as long as we hold below 33, yeah, the bulls have done some heavy lifting, but they're still well below some key areas that need to get taken out before they can declare a victory. One last time, Alan looked at that, or asked that longer term chart here. I see the conviction of the upside. He's calling a bottom pattern. I see more of a test of a lower extreme here right now. Again, I'm not sure that this downtrend that we've been in off that high around 61, 62 has been invalidated at this point. Yeah, we did not really see follow through below the lows from back in, what was this, spring of 2020, but still we have to reject this lower level as we get kind of hanging out around and down below 30 still. So again, bullish, I guess, on those shorter terms, but still kind of bearish on the longer term.
On the longer term. And look, I mean, there's a lot of hope for pharma and healthcare, but look what happened in Walgreens today. I think a lot of folks were surprised. Final thoughts, Alan, and will you be able to sleep at night for 2024 when you're doing your portfolio?
Oh, I sleep well. My trades are lifestyle options. You saw that's a 6-month option that, I don't have to
get 6 months with an expiration break even 50 cents higher. So, that's those are lose no sleep options for sure that fit my lifestyle. But looking at Pfizer, it is a down dog, and typically you'll see some rotation into some of those. We just had the Dow make new all-time highs here, and so this is the way to position with a lower risk, a limited risk attack. And you can always put a stop loss in your option anyway. So this option, we're going to pay $475. An option loses half of its value. Either the market's gone into the way or I'm running out of time, and you can salvage what you have and be done with it. But I'm very optimistic for the year, but the job is a little bit harder because a lot of stocks have already moved. These three big stocks, well known, well traded, have not moved in the last year. So I'm looking for some of that money flow, and that's what I keep track of with these options, and that's my signal that the sentiment has shifted. It's my signal that somebody sees something, and so I'm going to follow that signal.
Good to see you both. Happy New Year. Thank you. Alan Upman, Dan Lichtenstein, Big Three today. We appreciate it. Thanks for being here. Coming up next, we want to spotlight medically assisted weight loss. GLP-1 drugs have been a hot topic over the last year. Now, we have CEOs of two companies that are partnering in collaboration for a new medically assisted weight loss program. We'll explain. We'll be right back.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us, Chris G, at 4 o'clock in the morning. We're going to always make sure that you have all the financial tools and support to secure your financial future. That means a lot for my community and for every community.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennie.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all of your favorite streaming services.
All right. So with my son's account, I put him in a Iron Condor. I just took one. Of each of these strikes. And he got a credit. Oh, that's pending. All right. So we're waiting for a fill. We're trying to get $180 credit. $175 is the bid. So I'm going to change this to $175. What?
So basically, under this agreement, Medifast using LifeMD technology platform to have this access to clients, and it's a collaboration. Medifast investing $20 million into LifeMD, and so I'd love to hear more about this.
Trying to get a bit more credit here. S&P right up to yesterday's resistance.
is also advanced telehealth way to do this. So tell me about your thoughts on this collaboration, why this works for you.
Yeah, thanks, Nicole. It's great to be here.
All right, stocks at highs.
Important things for us at ZIM
Look for some consolidation.
comprehensive virtual primary care. We built a very big business, one of the leading direct-to-patient virtual care companies in the United States over the last couple of years. Our weight management offering is the fastest growing part of our business, and our goal is driving long-term outcomes for patients. So we're introducing them to incredible physicians. We're helping them access this class of medications that is truly game-changing, not just for their weight, but also for their overall health. And now we're thrilled to have a company like Medifast as a partner that has 50,000 coaches throughout the country that, as people are losing the weight, as they're using these life-changing medications, and even once they're off the medication looking to keep the weight off, Medifast is going to be an amazing partner to help these patients have the keep the right diet and lifestyle, make the right diet and lifestyle changes that will help them keep the weight off over time.
Right, understood. And over at Medifast, I mean, this continues a quarterly dividend. You're focusing more on getting the customer acquisition and making people reach their goals, Dan, right? I mean, and you're using the idea of having the influence of the coaches and the experts coupled with medications. Is that what's happening here?
No, that's exactly right. What we found over the years in doing this is that there's a few insights that are important. One is
Okay, NVIDIA.
people in the country understand that they can become more healthy, and only 15% of them are confident that they can do that on their own, which is where the coach comes in. We know from our own
NVIDIA continues to push here.
is put in a connection with a customer who's trying to achieve a greater either lose weight or become more healthy, that the results or the impact is measured by weight loss are 10 times more impacted when somebody is connected with a coach. So several years ago, we converted our entire company to this coach-centered habit-based model. And as Justin said, we now have just under 50,000 coaches.
Looking for S&P to get above this pivot high that we saw yesterday.
Benefiting from the coaching, which now we think that bringing coaches and clinicians together to benefit customers is the next important impact or important change or transformation for us as a company. And our dividend cancellation is a reflection of our belief by investing behind this new opportunity, this new collaboration to help customers be healthy.
And, this is exciting because everybody wants to be healthier. You look better, but really it's also about cardiovascular health and a better lifestyle. Justin, when you look at the numbers here and trying to use weight loss as a solution coupled with the medications, do you see that you're getting more success with certain medications over others? Right now, a lot of these are injectables. There's been a lot of talk about pill form. You have the coaches, the coach-guided part of this and the experts, but it's all about your habits too. Are you finding certain weight loss drugs are better than others? What's your outlook for 2024, Justin?
This year, Nicole, we've seen about 20,000 patients come to our platform for help accessing an amazing physician or nurse practitioner and a GLP-1 medication. Most of those patients are using tirzepatide or semaglutide, and I mean the results, as we've read all over the place, have just been incredible. My inbox is every day full of success stories from patients, and it's amazing. Not just people aren't just losing weight. This is impacting every aspect of their health, or many aspects of their health, their social life. It's truly an amazing thing to be involved with and to be facilitating as a CEO of Life.
Yeah, I'm sure. Dan, thank you. I mean, you must be seeing the inbox filled with people that are excited and want to have the opportunity, and the success stories have been many. I just don't know,
All right, I'm just looking through NVIDIA's potential trade.
It's great to see you both. A nice collaboration between two companies with common goals, one NYSE, one NASDAQ name. Great to see you both today. Dan Garth, CEO of Betterfast, Justin Schreiber, CEO of LifeMD. Thank you for being here on the show. Come back with some updates. Coming up next, the disruptor, watching Micron stock the high last week. Prices are upgrading the stock to overweight. We're showing us details. We'll be right back here on Schwab Network.
All right.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was hurt, we were able to help her move forward. Your client won't care how much you know until they know how much you care.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at SchwabNetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device, for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
All right. looking for a follow through. S&P is still banging up against resistance. NVIDIA looks like it wants to keep going.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
What's Intel doing? Intel, AMD. AMD turning the corner. NVIDIA looking good.
Irrespective of some of the revenue and earnings challenges the company had over the past couple of years because of memory supplies, which were too robust. They actually were in a situation post-pandemic where they increased supplies for just-in-case contingencies, and of course prices started to come down as they started working that inventory. But I think if you look at the performance the past year, that's giving you an idea that the prospects for Micron, which is one of the global leaders in essentially dynamic memory for PCM markets, data center servers, and even automotive markets, prices seem to be firming up and supplies are coming down. I think this is one of the primary reasons why Piper Sandler actually moved their rating on the stock to outperform from neutral.
All right, let's look at Money Magic's levels. NVIDIA 510, 520, and 500. All right, looking for the S&P to follow through. All right, 11:47 on the East Coast. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It is Thursday, the 4th of January. Reminder, I have to leave here at about 2:40 p.m., about 20 minutes to 3. I have a 3 o'clock appointment. It's about 10 minutes away, doctor's appointment. I should be back by 4 o'clock. Shouldn't be but a few minutes. Do my yearly checkup.
I remember when I first started flying and we would experience turbulence, I would watch the flight attendants. They're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through. I definitely feel privileged to be in that position.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hicks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
Low ticker at -800. From Bell to Bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network. Missed out on today's market headlines? Get caught up and catch the rep at schwabnetwork.com. Available anytime, anywhere, on any device for free.
JR Convex with us, Managing Director, Eagle Learner Group at High Tower Advisors, and Kevin Riley, Managing Partner, Exponential Investment Partners. Kevin, I'll start with you. Do you see some clear winners in the group? Because there's so many names when it comes to social media. What seems to be working for 2024?
I don't think Snap is going to work at all. I think it's like a meme stock, if you will. They've got lawsuits with fentanyl about to hit them hard. You know, the stock went from 8 to 16, but the RSI shot all the way up to 93. So I don't think that one's going to go anywhere. Facebook, of course, had that monstrous year last year. You know, of course, the prior year it had a completely disastrous year. So I think the safe bet would probably be Facebook. I would not go with Snap, though. Pinterest is probably a takeover play, although when you know, they were previously trying to be acquired by PayPal for $45 billion, that didn't work out for anybody. But you know, the company's only worth $24 billion right now, market cap, so that could be a nice takeover play right there.
Yeah, it's interesting. I mean, you said they tried once, but it didn't work out for a takeover. Pinterest is interesting. A lot of folks like to use that, but it doesn't certainly have the footprint of that of Meta with Instagram, Facebook, and such. Sarah, tell me your thoughts. What do you think the themes are here for 2024? Which ones are the winners and maybe not so much? So.
Overall, we like the U.S.
All right, so we're pulling back in a little bit.
Inflation is falling. Wage inflation is still running about 4%. Home equity.
Low tick alert minus 800.
So the platform, social media, e-commerce platform should be poised to benefit in 2024 is what we'd expect. The challenge is the valuations. We think with the performance last year, given other alternatives within the marketplace, we think investors will be more inclined to rebalance for the breadth of the market in other sectors in 2024, despite how strong the consumer is. Falling interest rates should drive demand for mortgages and credit and other areas. We think other areas of the marketplace will do better than social media overall.
Yeah, it sounds like you're pretty bullish overall, JR. I mean, you're talking about the U.S. consumer, the wind at their back, the wealth effect. You know, I guess they could take their trips and brag where they are on social media. Is that what you're seeing here, JR, for 2024?
Well, no question. As long as the labor market, we saw the ADP this morning, the labor market is
All right, just sitting and watching.
more spending for the U.S. consumer this year. And again, the equal weighted S&P didn't do nearly as well, just given the outperformance of tech last year. But given where the consumer is likely to continue to
Kind of a slow day at the moment.
sectors that underperformed last year, we continue to think investors will be more inclined to rebalance this year and look at other opportunities.
Yeah. You know, Kevin, we think about Meta, which we mentioned, Pinterest, Snap, you're out on, you said. But there's also Twitter and TikTok. Google, I guess you have YouTube. That's a little different because that's more like streaming. But do you see that TikTok is still number one or something?
Yeah, well, that's an interesting one there with TikTok because you know they're trying to sell products, you know, instantaneously to their users right now, and I guess that's going pretty well. You'll see Amazon stock was down quite a bit earlier today, probably because of that. So they got that going for them, but I mean, how much is that really going to amount to? I don't know. My mom certainly isn't ever going to use TikTok to go buy her next item. So I don't know if that'll work. Plus, you've got all these, you know, sentiment in the U.S. government against TikTok. It's just a tough one overall. I mean, I don't think I would go there. Instead of going there, I think the smarter play would be to go with Google, which has been kind of trading in a range for, although it's starting to break out, it looks like a little bit right now. It's kind of been kind of ranging now for about 6 months. Yeah, I think that could be a big hit because of that.
All right.
So hard because everybody thought we were behind that AI, which I really don't.
Yeah. How much do we care about names like Nextdoor Holdings, which actually connects neighborhood stakeholders, or Match, for example? JR, quick thoughts.
Well, on those, I think given where the consumer is, there can be benefits because again, some of those didn't do nearly as well last year compared to others. And going back to Google, I would agree. I think Google could be a sleeper pick in this space relative to
some of the other big tech names, because again, I think their AI got a negative hit initially, but I think they're going to catch up in a big way, and I think we'll see a lot of benefit this year with the name of Google.
Yeah, I just was seeing Matt is down for the 1 year, and I was thinking about Bumble too. That one also down 1 year. All right, thank you both, J.R. Gondek of the Lerner Group and Kevin Riley.
Hershey's looking for a follow through in Hershey's.
That's going to do it for us here on Trading 360. I'm Nicole.
Apple still drifting a bit lower down to that. Looks like 180 is the next strike. Flat VWAP on Apple. Apple's just tracking sideways along its VWAP. All right, so we just got this sideways action in Apple. NVIDIA continues higher highs and higher lows. Eli Lilly. All right, did move a bit higher today. Eli Lilly along a sideways VWAP now. Eli Lilly. Okay, Eli Lilly with the doji up at the highs. Looking for a follow through.
It's time to move forward.
Find the next trend.
From every click to every tick.
There's no fear of missing out on next trend investment.
Available anytime, anywhere, on any device for free.
All right, Netflix. Let's take a look at Netflix.
He's out coffee. I'm Jenny Ford. Join us for next trend investing.
1 p.m. Eastern. Only.
All right, Netflix is pushing above the 9 and 21 day. 9 EMA is still a problem. All right, we're watching for this to follow through a higher low. Looking pretty good. VIX is at the highs. SPY, S&P pulling back a little bit.
And from the heart of Wall Street at the New York Stock Exchange.
Up to the minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics,
No noise.
analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
And on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every market day.
Binge watch the market with Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network available anytime, anywhere on any device for free. Schwab Network. Good afternoon, traders. Welcome to Fast Market here on the Schwab Network. I'm Tom White. We've got a great lineup for you today, including discussions and option strategies in Micron, which rallied 70% last year and was upgraded today, and PayPal, which fell 13% in 2023 and was downgraded ahead of the open bell. And likewise, we'll break down consumer sentiment data on Constellation Brands, which had a pretty choppy and volatile 2023 and reports earnings at the open tomorrow morning. Now let's let's take a look at the four major indices, which are gyrating around the flat line, giving up some gains that we had just about a half an hour ago. The S&P 500 still up 0.1%. The Dow Jones Industrial Average up over 200 points. The Nasdaq 100 near the flat line on weakness out of Apple. The Russell 2000 small caps up about 0.25%. Something breaks down this market action. Quick in the co-host Kevin Inks. Kevin, pretty much gyrating after 3 straight sessions of losses for the major indices. That last day in 2023, last 2 days have been weak. They've given up some of those gains after the 9 straight weeks of upside for the major indices. So not surprising that maybe some consolidation is warranted here.
The fact that yields on December 27th hit 3.78. On December 28th, the S&P hit 47.93. Yields have crept higher, and the market has crept lower since then. Now, the biggest surprise.
All right, SPY is just drifting a bit lower. It's 12 o'clock. Let me shift gears and tune into CNBC.
Bad for the sort of returns these generate. I want to know what your view is, Kerry, on these stocks in particular. They're the most widely held. They're the most bankable names. They have been for investors. They care about them seemingly more than they care about a lot of other names, at least for the moment, because watching the shakeout of that has been a little unnerving, and trying to wonder when the buyers are going to come in. So Tony Pasquarello, Goldman Sachs, right? Cite him a lot, and I cited him yesterday afternoon when this note drop, but I just want to reiterate some of the comments that he made regarding mega caps and tech. The stocks are not cheap. They're widely held. So one should be a little choosy on adding length up here. Bigger picture, however, I'm inclined to keep my eye on the ball and would look to add on meaningful dips. Well, we've had some dips to start the year here.
Low tick alert -800.
Okay, so if we look at what amount they've gone down, and we could say 5% on average is what the mega caps have gone down. That's close to $500 billion of value that has to be replaced. Well, it wasn't replaced, and the market did fall off. If we see a little strengthening here, if the market comes back over the next few days, then we have recovered and replaced that amount of selling by buying, which I think would be meaningful. And I take it as a positive for the overall interest of investors into buying other names. Remember, there are 493 other names in the S&P 500, plus there are a lot of mid caps and small cap names that aren't in it at all. So I think that he's overstating to the extent that these stocks are not very expensive. They're they're basically market multiples.
They are
mega caps. Well, Google is, Meta is, Amazon on next year's earnings. I'm looking at next year. It's 30 times. It has never been 30 times. This is the first time ever since it went public that Amazon is trading with a 3 in the multiple, and it could go to a 2 if earnings start to pick up. The one that's expensive, I guess, would be Microsoft. I mean, Microsoft is in the 30s, but is that very expensive for the leading AI company? And Apple is printing. We're underweight Apple and we're underweight Microsoft, but the others.
Well, you would admit that. You think those valuations are too rich? I mean, they're both above their 10-year historical average.
Yeah, but the market is selling for 20 times earnings. So I don't have a problem with people taking some profits ever. I mean, if you have a group that's up 75% on average for the year, and Amazon up 83%, Meta up 200, Nvidia 235, go through the list. Why would anyone have a problem with taking some profits? I mean, that's what we're supposed to be doing.
Yeah, but Josh, it's the hardest thing with these stocks is knowing when to get out and when to get in. That's why you've had people say don't trade them, own them. But yet, from a technical standpoint today, I've got ROK MKM suggesting we recommend taking profits in Amazon. Respective charts have become very stretched above trend and poised for a pullback. So you own that stock. They say many names are now stretched at risk of experiencing a deeper pullback. They find some opportunities. They've added to Microsoft. Alphabet and Meta, 2 of our existing holdings, remain firm in trend, but tactically appear ready to pull back. So how do you assess this?
Well, I think you just said the key word in the last sentence of what you were quoting, tactically. So you have to ask yourself, first of all, do you even know what you're doing in the market? you know if you're an investor or a trader. MKM is institutional research that's geared toward hedge funds and other more tactical traders. And they are actually trying to outperform the market on a reasonable basis. And they are trying to do things in the short term that over the long term will be additive versus just buy and hold. Most people are not trying to do that. And most people who are in Amazon, they're in it understanding that there are going to be quarters where the stock underperforms and quarters where it outperforms, but it's really hard to know in advance which is which, when is when, and they don't want to take the risk of missing out. And every time you read somebody say something like, tactically, this chart is stretched and maybe it's a good time to take a profit, every time you need to ask yourself, what if this doesn't apply to me? And what if the bigger risk for me is being out and they're wrong? So maybe the chart is stretched and it gets more stretched. Or maybe it's stretched, it pulls back. I'm busy at a dentist appointment. When it bottoms, I don't get back in. And then the thing adds 15%. So you have to know if you're a trader or an investor. It doesn't invalidate what they're saying. It invalidates what they're saying for me because I don't care.
Hey, but you can be an investor and still, have a debate over whether you want to get more invested in some of these names.
I agree.
And I guess I posed this question, Josh, in the context of last year it was easy just to buy them all, right? You just buy the Qs, you buy the 7 names or whatever, and you did well. I'm trying to play off of Tony's choosy word, right? He uses that word, choosy. So if you're going to be more choosy this year, because maybe you have to be, and they're not all going to trade in tandem, which ones do you lean into, and which ones do you say, you know what, Apple just got hit with its second downgrade this week. Piper cuts it to neutral.
Yeah.
You have some concerns about that stock, technically speaking, fundamentally, revenue growth, etc. Do you need to be more choosy, I guess is my question.
Yes, I think if you were to force rank all of the Magnificent Seven and ask yourself, like, what is the setup for each of these? The first question probably wouldn't just be valuation or price action. It would be, what industry group is this company really in? Because they're not all quote unquote tech stocks, by which I mean.
All right, ZIM integrated. It's at the highs of the day. ZIM.
Amazon, even though it's considered consumer discretionary, is going to be cloud, which is obviously a tech business, and advertising and media. Like, that's where the growth is coming from. Obviously, with Alphabet, it's a rebound in advertising that you need to see take place, even though they are in other businesses. So I think you should not look at these companies and just say, oh, Mag 7, bullish or bearish. I do think that that's right. You can delineate between where is this company really going to get its growth from this year. When you do that, in my personal opinion, I think Alphabet and Amazon are the two best setups in the group. Doesn't mean I want to sell my Apple. It just means, to your point, there are some areas that you'd rather lean into than others. So I think that's totally fair. And I do think that that is what most investors are starting this year out trying to do. They're saying, okay, I got 50% out of the Qs last year. Is it likely that I'll get 50% out of the Qs this year? Probably not. I mean, it could happen. Nobody thought it was likely last year either, but probably not. It doesn't repeat. So if it's not going to repeat, but I still want exposure to tech, what are the themes? What are the industries? Where do I want to place my bets? I think that's totally a reasonable way to proceed.
Shan, Happy New Year to you. Good to see you as well. What's your assessment of this market? A couple of rocky days, trying to get some buying going today.
Well, I mean, I think there's been multiple folks here who talked about valuations. And Scott, I mean, people only start to question valuations when stocks sell off, right? I mean, we were talking in the fourth quarter about valuations on these Magnificent Seven stocks. And, we stated that we felt that they were vulnerable to not only multiple compression, but also just kind of a switch in momentum. And I think we've seen that in the short term. I wouldn't necessarily disagree with Jim. I don't think this is setting up as a play for all 7 of these stocks to sell off meaningfully. But I think Carrie made a great point in that when you think about what is this dispersion that we're looking at, the reason that Apple is selling off this week is not just on tax loss selling. It's about questions about the fundamentals. And so if you look at each of these stocks and you think about, for instance, as Josh mentioned, advertising, is this the best way to play advertising from your perspective in this environment? Or are there names outside of alphabet that you could potentially harness to put in your portfolio for exposure. The other thing that I want to drive home and that you really want to think about is there's a lot of people that are talking about, and we talked about this in our Solving for 2024 piece, the opportunity to start to buy some of those laggards. Just because you're buying outside of the S&P 500 or buying outside of these 7 names doesn't necessarily imply that large caps are going to underperform here in the US, or that even some of these stocks that have performed well last year can't replicate that, a la NVIDIA. Like you can't say that there's a needs to come off the sidelines. Cash rates are coming down.
All right.
Whether that goes into short duration bonds or back into some of these underlying
Just scanning through stocks.
that didn't participate, that's really where we start to kind of fill this gap, if you will, on tax-less selling and some of this fundamental dispersion that we're seeing in the Mag 7 right now.
Yeah, back to you, Jen. No, I think that what Shannon said is so true. There's still money coming in off the sidelines, and you've got a lot of names to look for. This is a year that we can't just rely on 5 or 6 names to boost your portfolio so you can beat the S&P. You're going to have to work harder, and that means digging into what's working and what isn't going to work for these companies in a slowing environment where there's some growth, but it's not so easy to find them.
Okay, so we're just sitting in here moving sideways, S&P, sorry. Flat VWAP, 4,700 is still support until it isn't. So while it is kind of boring, there are stocks that are moving like NVIDIA, ZIM, Merck, some of the pharmaceuticals. What is, let me take a look at XBI, biotechs. Consolidating, okay, like it did a few weeks ago. The biotechs are consolidating like it did a couple of weeks ago. Pushes higher, went sideways for a week, and then pushed higher again. Consolidation. Let's look at IBB. Okay, inside day.
Whether it's big money center banks that are trading at discounts to their historical multiples of book, or you can look at something, and I don't know if we want to talk about this later, but BlackRock, it's something that this is an easy thesis to understand. If the market's going up, both stocks and bonds, which most of us predict for this year, well, their assets under management are going up and their fees are going up. So what I'm saying here is a synthesis of 2 things. Carrie just said, do your work, look further afield. I completely agree. But I also say in some cases, it isn't that hard. Look at JP Morgan, the creme de la creme. Didn't it set an all-time high just a couple of days ago? It isn't that hard. Well, I mean, if you want to look at more...
Okay, what's Amazon doing? Amazon.
It is a little harder. To your point, right? You said it. You said it's going to be harder this year, right?
Amazon. Sitting here on a doji. Could move a little bit lower.
Look under the car, because it's just not that simple when you're worried about what the trajectory of the economy is going to be, when the first cuts are going to happen.
Sure. We don't know any of that.
Exactly.
That's all in the future, but when? So trying to pick a date, I want to be in the interest rate sensitive starts by March 15th because we're going to look at that. That's ridiculous.
You want to tell me what kind of year Freeport's going to have today?
No.
You want to tell me what kind of year that Caterpillar or Deere are going to have today?
They're in a terrible year, so let's hope for the owners that it has a better year than Pat's at an all-time high, right?
You want to tell me what kind of year autos are going to have this
I
year?
now understand your question.
Yeah.
I now understand your question. So let me rephrase this. Relative, and this is what Carrie was saying, relative to the Magnificent Seven and the Triple Qs last year, which was the easy button, just push the easy button. Yes, Scott, you're absolutely right. This requires all of us doing the homework that we love to do. Opening up the hood, taking apart the engines, what we love to do, frankly. But when you do that, and I do that all the time, I do come out and I say, to answer your question directly, Deere, yeah, Cat, this seems pretty easy, particularly as the cost of capital is coming down. Stocks like this that generally have more leveraged balance sheets should find that
Lilly.
headwind at the same time, and this is very important, that the economy continues to grow. So there's demand.
ZIM is at the highs. Lilly. Lilly. Let's see what Lilly's doing. Still a spinning top. Disney dipped into yesterday's price action. Now buyers are stepping up. So it looks like a shakeout on Disney. Okay, nice little turn on Disney. If you wanted to add to it on the dip, stop underneath the 50-200 day. That's what I do. What I would do.
Well, it's not just any revenue warning. The autonomous driving systems company expects a 50% drop in revenue for the first quarter of this year because of excessive customer inventory issues. So that means buying less as they work through their inventory. Keep in mind as well, 30% of Mobileye's business is exposed to China. Mobileye is having its worst day, Scott, like you pointed out, since going public in October 2022. It's actually the 5th straight day of losses. You can see shares down, 25%? And like you pointed to, the dire warning slightly impacting companies like Intel, since Intel actually bought the firm back in 2017.
Just another reminder, I got to leave here at around 2:40 p.m. to make a 3 o'clock appointment, about 10 minutes away. Should be back by 4 p.m.
ADI as well, which really just leaves about 3 names positive in the SMH ETF right now. And this is the first negative pre-announcement from a chip company in 2024. I know it was day 4 in January. It could be isolated to Mobileye, or it could set a negative precedence for auto exposed names like onsemi and XPI, especially as they meet with investors at the Consumer Electronics Show in Vegas next week. So there could be a lot more news coming. Separately, Scott, Qualcomm announcing updated chips for its augmented and virtual reality devices that offer faster processing from dozens of cameras. And they claim it could even be better for motion sickness, because that was a complaint in the past. But Google and Samsung both plan to use this new chip in their VR headsets, and competition could definitely be ramping up when Apple launches its Vision Pro headset this upcoming February.
Jimmy, I mean, you've got NXP. So I know you're watching this closely, and Mobileye's having an impact on a lot of names, as Christina says.
It is. You don't have me on to prevaricate, and I won't disappoint. I think this is
love that word.
I thought about it. This, I think, is a Mobileye situation. I don't think this is an industry situation, and it's very reminiscent of a quarter ago. I think it was a quarter ago. onsemi, remember this? They had a very disappointing guidance. Took the whole sector down, but it turned out it was just onsemi's problem.
Excuse me.
As Christina said, selling heavily into China. Truth here is we've been producing autos. There's demand for autos. We got auto sales yesterday. They were very good. There's also a production pickup in autos to catch up with what happened during the strike. Now, this all plays to the auto semiconductors' strength. So, NXP was off almost about 6% earlier today. It's scrambled back a little bit. I do think this is a Mobileye specific situation. Could be wrong. We'll see, but there's my stake in the ground.
Christina, I'm looking at some calls today as well. KeyBank, X1, they're looking for continued appreciation.
Okay, Disney looking for a higher high. Looking for it to get through the 200 period EMA on this 2-minute chart. Note the 20 EMA is turned up, starting to head towards the 200 EMA above VWAP. Looking for a bounce off of this area and the shakeout to turn out to be positive on the day.
Jim, just to your point, I feel like you're maybe a little bit more biased because you're talking about ON and you own it. It did trade down about 22% after its miss on October 30th. NXPI also guided below for Q1 as well. So it might be isolated to Mobileye, but there has been some concern that auto, specifically auto within the chip world, it was the last chip to fall, no pun intended. So maybe this is that contraction that we were looking for, especially when we look at EV demand.
Christina, just so you know, I don't own ON. No big deal there. That's okay.
Apologies.
But you own NXP.
I do own NXP. I got to go back to my notes because you said they guided down for the first quarter, and now I'm doing this from memory, but I thought their last earnings report was pretty good on the guidance. I hate to disagree with you without the facts right in my hand.
NXPI guided Q1 below already, but I can double check that. So it's just in my notes.
Okay, I'll double check as well, and I'm not saying you're wrong. I'm just
I could be wrong.
Just emotionally remember it as a pretty good quarter.
Of course, because you hold that name and not onsemi.
You should have quit while you were ahead when you said he's biased.
Period. End there. Dead silence after that, right?
Mic drop. Christina, thanks as always. Christina Parts and Network. Josh, give me something though on this AMD from KeyBank. Target raised to 170 from 140. It's a new buy for you, or relatively new.
Look, AMD is going to play a very critical role in AI. We all know that. That's obviously priced into the stock. Lisa Su has made substantial strides. You think about it, it's only really last January when Microsoft announced its $10 billion investment into OpenAI. That was like when the race officially began, right? So it's only really been a year. It's not even a year since that announcement. And in that time, I think AMD has very forcefully thrown its hat to the ring. You see her speak. She's saying all the right things. The new chips are very impressive. They're working on training. They're working on inferencing. They're announcing customer wins and design improvements. And they've got certain things that are actually working faster than some of the prevailing technology from NVIDIA. She's wearing leather jackets. She's doing everything that you could want a CEO to do. And quite frankly, they're never going to have market share in comparison with NVIDIA, at least not, I don't think, in the next 5 or 10 years. But that's not what's important. What's important is they're going to grow regardless because the whole pie is growing so rapidly. And they're going to be there where it matters. So I'm sticking with it. I don't have a lot of the stock. Candidly, I didn't buy enough, and it took off really quickly. I'm accustomed to buying things and they drop 10% immediately. So that's what happened there. But I will not part with what's going on with AMD. I'm currently long.
I got you. Just to clean up as well, the end of our last
Marathon Digital.
Yes, on NXPI, their guidance.
Okay, no follow through yet. AMD just dipped and now it's starting to bounce. In-phase pulling back another day.
I didn't mean to call her out on that. My own interpretation, just for the record, is that NXPI is very underappreciated. Stock went way down after that, and the stock is underappreciating just how many drivers this company has. It's not just automotive. There's a lot of Internet of Things, but basically auto production. Outside of Mobileye, this announcement is out of keeping with every other indication from automotive.
No harm, no foul. It was a good conversation. We just wanted to clean
Thank you.
All right, let's take a break. When we come back, we got many more stocks on the move today. We're going to hit analyst calls on PayPal, Amex, on Depot.
Okay, so if you missed a position, if you missed entering something, whatever it happens to be, this morning because it ran up and it left you behind. If that's the case, then this is the time of day you start to look for B and C pivots. Okay, so B and C pivots we look for this time of day after stocks run up. The reason why you get this A segment from the open up to the A pivot high, the reason that happens is because number one, you might have people like Corey that are on the West Coast that get up early in the morning, or maybe in mountain time, maybe in Colorado, some area like that. They get up at 6:30 or 6 o'clock. They get ready for the opening bell at 6:30. It's 9:30 here in the East Coast, 6:30 on the West Coast. So maybe they get up and they trade the first hour or so. And if they're, quick at it, they will catch this run up that we often see. Let me see if I got an example here. ZIM is a good one, I guess. ZIM. Okay. So here's a good example. Well, it's not the best example, but it's a good example. So in the morning, you get this run up. You get a gap up. We dip. Okay. Now we're starting to run higher. So now, if you missed the opportunity the first hour or so on the gap up, you're looking for what's going on here. Why is this not showing up? Okay, so you missed the opportunity in the morning, then you're looking for B and C now. Okay, you don't want to chase into the ATR. ATR, the average true range of the day. So if you're at 115 or 120% of ATR, you've already traded out the range for the day. So what you want to do is wait for B and C pivots between 12 and 2 o'clock or so. Okay, ZIM integrated currently is 153% of its daily range, 174%, 164% of its ATR. So it's well beyond its ATR, its average move for the day, average true range for the day. Okay, so that can expand as ZIM integrated continues to push higher. But you don't want to buy at 100% or higher ATR because the risk for it to pull back is pretty high. So what you do is you wait for B, you wait for people to take profits and look for B and C. Does it show up? I don't know. Maybe it does, but that's what I would be looking for if I missed the morning run or if I missed this dip to buy, closer to 13. So that's what's good about this time of day. If you happen to be tuning in, I'm your host, Cousin Benny, coming to you from theclosingprint.com. It's Thursday, the 4th of January, 12:26 on the East Coast, the best coast, the Costa Nostra. Love you guys on the West Coast. I just like jabbing you. S&P, looking for S&P to bounce, get back above VWAP and push higher, produce a higher low, higher high.
Look, I don't have a huge stake here, but I do think that a lot of pessimism has already been priced in. It would really be hard for somebody to come to the story and say, "Oh, but what about blank?" Because again, they've lost $300 billion worth of market cap since the peak in 2021. So you can't really say that there are more shoes to drop. What you can say is that it's going to be really challenging for them to ever grow at the rate that they used to grow. I would stipulate that, but I would say it's a 17 multiple. It's a new CEO who has been highly successful in M&A elsewhere, who could be contemplating a strategic transaction that none of us are. And you're not really taking a huge risk on multiple to bet that something might go right. I could be wrong. I could change my mind. A quarter or two could go by where there's no progress and I just get bored of the story. But right now in the high 50s, I feel like the risk is to the upside. There might be something unexpected that could occur. And if it doesn't, I'll change my tune. But that's how I feel today.
Let me come back to you, Kerry, for AXP, because there's two positive calls on it today. Up to JPM and top pick over at Goldman. Price target at Goldman's 215. That's about 15% upside from here, which is the stock you own.
Yeah, I think this is a relatively easy call in that the stock sells for a very low multiple, and if consumers keep spending and traveling, then that's good for American Express. The consumer product is growing in terms of young people signing up for platinum cards, and it's really, I think, showing traction today with millennials and Gen Zs, and we think that there's a long runway for American Express, more than 15% from this point.
AI play in some respects?
Yeah, sure. I mean, they understand a lot about what you purchase. They can give you information about what you've spent before, what you might be likely to spend on. I think it's a fantastic service that they offer with the card. And, I bet most people who come on this show use their American Express card and think highly of it.
Let us know how that black card is. I know how you roll, Kerry Firestone. Depot, top ticket Wells. Target goes to 385 from 340 overweight. What do you think about this one?
Yeah, I think that's a good call. I mean, this has not been a good stock recently, and of course it went down because interest rates were going up, and that affected the housing market, mortgage market. If there's any chance that interest rates come down, it's a positive for Depot. It's one of the best retailers in the world. So, we think that it could see a good year this year, and particularly if rates fall.
Let's get the headlines now with Courtney Reagan. Hey, Courtney.
Hi there, Scott. The Justice Department has sued the state of Texas for its immigration policies on illegal migrants. The lawsuit alleges the Texas law governor, Greg Abbott, signed into law last month is unconstitutional because it violates the Supremacy Clause, which establishes that federal law supersedes state law in most cases. Members of President Biden's national security team met on Wednesday to review options for possible military responses against the Houthi rebels. That's according to two officials from the Biden administration. This comes as the White House faces growing calls for a stronger military response against the Houthi rebels for the repeated attacks on shipping in the Red Sea. Some of the possible options reportedly include strikes against rebel targets in Yemen. And ESPN will become the exclusive broadcaster for 40 NCAA championships, including the Women's Division I basketball tournament, in a deal announced today. The $920 million deal between the NCAA and ESPN is for 8 years, with 21 women's and 19 men's sports, including tennis, track and field, and men's and women's D2 and D3 basketball. Scott, back over to you.
All right, Court, appreciate that. Courtney Reagan. Coming up, big news and big moves for Eli Lilly. Shares trading at an all-time high today. The company going direct to consumer for its weight loss drug. We're going to trade that as well. Coming up next.
Okay, so we're looking for a bounce. S&P, no bounce yet. Could just turn out to be another lackluster sideways day in the neighborhood, with S&P 500 not making any progress. We're below resistance 4750 and above support 4700. There's lots of puts and calls in this area. Lots of puts and calls. And as they exercise, if they start to monetize the puts in particular, that would help solidify the support at 4,700. That could have a positive impact on price action, pushing prices higher as those long puts close. The short puts that the dealer has will be rehedged or eliminated. And that could help us lift it a little bit. Some people, if we do get a bounce off this 4,700 level eventually, they could start buying calls, which would give us some upside. We'd like to see some puts building above the current levels, though. That's the only issue I have with the current situation with Gamma, which I shared with you before. You can see that there's lots of puts and calls near the money right now. We closed at 47.04 yesterday. We're just above it. You can see the calls are all in orange, and you can see the accumulation in this area is very pronounced. That's good. As we move higher, as we said, we start to see some monetization. However, if you move over here to the right a little ways, just to the left of 5,000, you can see there's very little puts there. We want to see that fill in. We also want to see, the calls are looking good. They're starting to fill in, but the puts, corresponding puts, have only started to begin just above this 4850 level. You can see that little blue line there starting to drop off. And then 5,000, which is where most of it is. So that would be the furthest upside target I would see in the short term, like the next month or two, at that 5,000 strike. There were some thoughts that might be some arbitrage going on out there. Bottom line, 4,700 is support, 4,800 is resistance. If we drop below 4,700, then this could accelerate, as there's a lot of calls overhead that would start to monetize, or else they lose value. So a move below 4,700 or a move above 4,800 is what we're watching for. Below 4,700, above 4,800. So we're right in the middle, in the lower half of the range for now. $100 range, 100-point range on the futures that we're just watching for now.
I think that Lilly believes the price is going to go down further. And if you have 10% of the population, 20% of the population on these drugs, you can make $50 billion, $70 billion across the world on them. And why not control it yourself? That's what they're doing. They're controlling it themselves. And I think that's a brilliant move.
All right. Next question. Follow up. Why aren't you buying it today?
Well, this just happened, right? It just happened. So
happened earlier.
But the stock has been a huge stock, right? It's been a huge stock.
Yeah.
And we got to do, got to look at the numbers.
So that this could be, just the beginning.
Yeah, but there are several in line who also have drugs that are going to compete with them. Novo Nordisk, of course, is number one. They've been capacity constrained. That could start to change. I think this is a more complicated story, but they're the first to do this. And it's a very clever move.
not going to buy it at this price. I acknowledge fabulous company, fabulous product. I was listening to what you're saying, you're talking to the but this actually changes the profitability. They're cutting out the middleman, right? The pharmacy benefits manager.
All right, so we're just waiting out the market.
Managers don't get a cut of it. They actually don't want to get a cut of it. I'm not sure they're making that much money on these diet drugs. All that said, there's competition cropping up. I'm not taking anything away from Eli Lilly. What I am saying is, at 50 times forward earnings, it is priced for perfection, and things can go wrong when things are priced for perfection.
Which one do you like better than this?
Well, we're also talking during the break, Vertex. Now, this is not a diet drug. I don't have exposure in diet drugs. However, Vertex, cystic fibrosis is its core business, and it's expanding into sickle cell anemia, and pain is the real killer drug that's coming up because they've got a drug that looks like it has the effects of the opioids without the addictive property. That's going to be a blockbuster.
All right. Josh, you have a take on this space?
Look, I think it's an area where you really can look and say there's not a lot of challenge here valuation wise. The real question is just going to be, is this the year that they deliver? Is this the year that you find the stories where the fundamentals are getting better faster than the market expects? That's typically the way that I've approached these names. But I really don't have any particular horse in the race at this point in time. It's just not something that I'm personally very focused on.
Sharon, what about you?
Yeah, I mean, I think we saw last year, Scott. I mean, therapeutics just generally didn't do all that well, and healthcare certainly didn't do well. I think the risk here is that there's expectations that this hurts the prospects for other healthcare companies, particularly those that treat diabetes and heart disease. I think the other side of this, though, is that over a long-term perspective, this really should help the payers if you think about managed care, because, this could be one of those trends that lowers medical loss ratios over time, whereas right now we're really seeing those escalated and weigh on some of the prospects of managed care in this year.
Eli Lilly going direct to consumer. Eli Lilly. All right, there goes QS. QuantumScape starting to turn higher.
Hey there, Scott. Yes, we do want to call your attention to shares of McDonald's. They have taken a move lower. They seem to rebound somewhat here. The company CEO, Chris Kempczinski, posting a New Year update on LinkedIn, mentioning the war in the Middle East was having a meaningful impact on business. He wrote in part, I also recognize that several markets in the Middle East and some outside the region are experiencing a meaningful business impact.
All right, what's Disney doing? Disney. Okay, looking for a higher low to fill on Disney. Okay, so Lilly, watching Lilly and Novo Nordisk. All right, sorry, let me take this off here. Okay, okay, let's go look at Novo Nordisk. NVO, it's breaking out, NVO. NVO is another one I might sell some put credit spreads on. NVO. I wouldn't sell them up here at the high because you probably get a better fill if it dips at all. But you could put a limit order at a lower price. If it does pull back, you'll get filled. That's what I did on, what was it? It was on Lilly. Okay. I didn't want to chase it yesterday, so I put a good till cancel limit order on a credit spread yesterday. Forgot about it. Good till canceled. It filled this morning, and sitting in a credit spread on Lilly now. So Novo, I like that one as well. Let's see, call vertical for February. When did they report Novo? NVO reports earnings probably in February, like the first week of February. So I'd probably do a 2 or 3 week trade, something short of maybe February 2nd. Debit, credit spread. That's January. Let's look at February, the first week of February. Okay, those look pretty good. Delta 40. So I'd go to the 104. That's a 29 delta. I want to get down to like 18 delta. So the 100 strike on Novo Nordisk, where, okay, 100 would put it below the 50-day. That's actually a good level. That's a 17 delta, but they're only going for $1. So not much premium. What about the 98 strike to buy? Yeah. Let's try just below the 21-day 102. I don't think it's coming back. 102 would be 22 delta. Applied volatility is 36%. Theta is $4 a day.
For this new year, we continue that today. Josh Brown, yours is what?
102.
Let's do KWAP. So basically, since inception, this thing has had a hell of a round trip, and it's no secret the entire Chinese stock market is down 60% over the past 2 years. You cannot find somebody who will tell you they believe Chinese stocks are investable. That is,
Yeah, I mean, I agree with that statement.
this is probably the biggest contrarian swing that you can take. The top 10 holdings in KWAB, which is the Berkshire Chinese Internet ETF, Baba, Tencent, PDD, Meituan, NetEase, JD, you know the names, Baidu, Trip.com. They're in all different sectors of the Chinese economy. There are multiple problems here with China. We're all familiar with government crackdowns against large tech platforms. We're all familiar with some of the
Credit.
relationship between China and the West. So if you think that this can never get better, then the huge discount that these names are selling for is a valid discount and should remain in place. However, if you think that things are so bad that there probably is room for improvement
S&P. Doing nothing.
KWEB is 72% below its all-time highs. It's had massive rallies over the last 10 years. It could again. I don't know what the catalyst would be. I'm not positioning myself as a geopolitical expert on U.S.-China relations. I'm just telling you, you want contrarian, this is contrarian. Okay, Shan, you want people to bet on commodities. That's your contrarian play. Why?
Well, it's so interesting. Normally, when we come on here, we'd be talking about expectations for a booming economy or meaningful supply shocks or both if you're talking about commodities. But we actually look at this in terms of a hedge potentially for 2024. A hedge against some pockets of surprise inflation, a hedge against some of those geopolitical concerns that Josh just mentioned, and frankly, a hedge against stronger Chinese growth. And so it's really interesting because I view this, if you look at last year's stuff, you look at all of the selling of Chinese equities. A lot of the emerging markets flows went into anything that was ex-China on the EM side. And so rather than having to take that
Okay, S&P still drifting lower, back towards support for multiple days now. Okay, so the dollar and the 10-year moving higher is not good for the markets at the moment. All right, so looks like a descending channel. We still got the 200-day and the 50-day overhead to deal with. The dollar. The 10-year yield. Okay, remember we saw that stochastics and RSI, everything was turning. So if this was a stock, we'd be looking for a bounce. Doesn't mean it's going to move very far. 200 days overhead for the 10-year. So maybe we roll over. at this point. Here's the 10-year yield. So we have had a couple of occasions where we moved higher. This market continues to discount everything. We are pulling back towards support now. Okay. Okay, Lily. It's a slow day again, not following through. I made a call. They're not interested in buying. Not a lot of blocks today. And up-down volume, let me just look at that. Up-down volume is currently 1-to-1. So another day where we're anticipating a doji. All right, so if you look at the S&P, we just got a doji. Oops, that's not what I want to do. Okay, we're sitting right on top of the 21-day. A lot of people are looking for a test of the 50-day. We got to take out 4,700. 4,700 has to go. We need to drop below 4,700 for that to happen. Okay. Bitcoin sideways in a range. Bitcoin. What's Coinbase doing? Coinbase sideways. Right around 145 to 155, bouncing around. Okay. Let's see what is working. Aside from the Dow Jones, let's look at the S&P 500. Okay, Carnival, Royal Caribbean. Royal Caribbean had pulled back. They have earnings coming up, right? I think at the end of January. I think that's what I heard. Allstate from the watch list. Allstate following through. Breaking out. Allstate. Look at the volume. That's showing institutions have been picking up shares. A little bit of selling. Second week of December. Then the buying started. And the trend just continues up and to the right. Many of these insurers look good and bullish. Stock market's at sleep at the moment. Stock market is at sleep. Netflix doing well. Sorry about that. Had you on mute. All right, so I'm talking about S&P 500. We had a nice run up from the October low up to the high. We're giving back 2%. 4,800 was a major level overhead resistance. We're off 2% after gaining 16% since October. If we go back a year, October in 2022, we're up over 37%. We subtract 2%, so we're up 35% since October of 2022. So we could still see it pull back 3 to 5%. That's a normal correction in a bullish trend. We have a bullish trend, obviously. Some people are looking at a 382 Fibonacci down at the 50-day. That's possible, but we have to lose 4,700 first. Once we lose 4,700, that sets a different dynamic into momentum. Okay. Not only do you have momentum from the move lower, but you also start to see dealers will start to sell some of the shares that they have where they have options that are in the money. They have a lot of in the money options that was carried over into January. That's the one concern, and it's mostly calls. So if we start to lose 4,700, those calls are going to lose value. So they'll start selling that. That becomes supply. And once we drop through 4,700, now the dealers have to position their hedges differently. So they'll start selling shares. They'll start selling Delta, their shares. And that could exacerbate the move. So we always want to pay attention where the volatility trigger is relative to where price is. So the volatility trigger is right here, 47.45. We're right below that right now, okay? Trading near 47.06. So we're right above yesterday's close, 2 points above yesterday's close. S&P cash. We need to defend 4,700. There's a lot of puts here and a lot of puts just below. Now, there's a possibility we dip below it and then bounce back above it like we did recently. All right, so I was just showing you this. All right, so the volatility trigger is right here, 47.45. We're below it right now, so this could accelerate if we get below 4,700. That tall orange and tall blue bar, okay? So that's where all the puts and calls are, just underneath price at this point. All right, we're starting to bounce now. A little bit. Okay, so it's probably going to be another boring day. I hate to say it. So that's why I like selling premium, whether it's a Iron Condor or credit spreads, overhead credit spreads, bear call spreads like Apple. Apple's not making any progress. I don't think Apple's going to make much progress. It is starting to bounce a little bit, so that's fine. For those of you that are long, like Scott Bravo. Alrighty.
The fact that they're managing to do that now with another Apple downgrade. I think the data today was
So Apple got another downgrade today.
stronger than expected. Leisure and hospitality dominating another ABC report. I think this market is setting up for something tomorrow. I'm not surprised by the price activity the first couple days of this year based on what yields have done much higher. This one,
all right, closing bell today. Hope you join me. Adam Parker will be here. Jeff DeGraff and Amy Kong. She has Apple and Microsoft as two of her top holdings, so a great time to get her views on mega cap tech and the markets. Also, you have an article on CNBC Pro. Tell us what we should check out.
Yeah, thanks, Scott. It's about what sectors of the market might pick up: healthcare, financials, and industrials if the tech trade doesn't keep working.
All right, CNBC.com/pro is where you can find it. Shannon, final trade from you, please.
Small caps. Not only do you get capitalization diversification, but it's a very different sector mix than what you see in the S&P 500.
All right, Josh Brown.
I'm not in this trade, but Netflix held its 50-day beautifully on the tech pullback. I think she wants over 500 this year.
Very interesting. You thinking about getting into that trade?
We'll see, Judge. We'll see.
Sounds like yes.
Okay. Farmer Jim?
Qualcomm. A lot of AI applications on the phone are going to have to be done on the phone, and that plays to Qualcomm's chips.
All right, Carrie Parsons.
Waste Connection. It's not a cyclical business.
All right, thank you. Thanks, everybody. I'll see you on Closing Bell, the exchanges now.
Thank you very much, Scott, and welcome to the exchange. I'm Kelly Evans. Here's what's ahead. Is stronger than expected economic data throwing the Fed's rate cut timeline into question? 10-year yield just below 4% again.
With yields up is surprising. Yeah, only 5 out of the 11 S&P 500 sectors positive at this point. The downside saw a little reversal in oil, but the big story again today, second time this week, the stock's been downgraded, is Apple. Let's bring in Jenny Horn, market correspondent here on the network to help us break this down. I had trouble with your name there, Jenny, but it seems like the market's having trouble with Apple, another downgrade today.
I know it's seeming like these downgrades are becoming less and less rare because first when Barclays downgraded the stock earlier this week, it was like, whoa, this is pretty unusual for Apple. But now similar sentiment echoed by Piper Sandler, who downgraded shares to neutral from overweight. Price target now $205 a share. That's down from $220. But it does put slightly above the average right now, which stands at about $200 among the 40-something analysts that do cover Apple. And they actually cited the valuation concerns as well as some broader handset.
All right, watch Tesla. Tesla's starting to move here.
They're starting 2024 with a more pessimistic view on the overall semiconductor business, believing the first half of the year will be challenging for the analog market, handset, and consumer end market. But for Apple specifically, they did say that they are concerned about handset inventories, and they also feel that growth rates have peaked for unit sales, as well as what we're seeing in China, given the deteriorating situation there, they see could also weigh on their overall handset business. But their fiscal fourth quarter results, I will say, as much as like every analyst wants to harp on their accelerating growth for the last 4 quarters, we did see earnings and sales that did beat expectations. It's not like this company is falling apart by any means. And like,
What has the first 3 days of 2024 brought to the table? What's brought weakness in the mega caps, primarily in Apple? And if you were going to list the most important of all the mega caps, it's Apple, just solely off the size and value of the company. So you're seeing a little bit of a broad bounce back here. About 60% of the S&P 500 names are higher today. But Jenny, Apple is down another full percentage point. So you look at the NASDAQ 100, the most exposed index to Apple, down 30 points. So it just goes to show the importance of those big tech trades.
and it goes to show really the way that Apple was such a resilient player in 2023. And I just feel like actually just consistently that when Apple's having a bad day, of course, like you said, it impacts the whole market. But we'll be focusing on Apple later on in the show. We just time to get through, as always, taking things off our upvote and downvote segment and charting and trading those upvotes. FOMO today, we're actually looking at Walgreens Boots Alliance, which was selling off even more substantially earlier on the session and given back some of those losses, but still seeing a pretty major move to the downside after they cut their dividends by nearly half, which was seen as a pretty major shock as they now appear more strapped for cash, which of course is a pretty major concern. And then we'll also be looking for under 30 today at rocket companies, as we did see JP Morgan reversing actually their earlier 2023 bullish call on the company, which of course is never exactly what you want when you see that fundamental shift from any analyst or any advisor on the street.
Yeah, well said. Stock down almost 5%, so that would be a good one to talk. Rocket Mortgage, I know it's rocket companies, but if you're thinking about what do they make, are they going up into space? No, Rocket Mortgage is what we're referring to with that one. Looking forward to the conversation on Walgreens Boots Alliance as well, and of course upvote downvote, which has a little bit of a semiconductor theme here today. So let's start there. Not endorsements, not recommendations. Jenny, first one on the list is Micron MU. It was late to the party, but it got there by the end of the year. Really impressive performance the last few months of the year for Micron, but never made an all-time high like some of these other names. A little bit of a pullback here to start the year, but some strength here today.
Yeah, and I will say they're down about a little bit over 2% this week, even with today's nice 1%.
I'm just looking through positions right now.
Quite better
pick of the stocks Piper Sandler was looking at, upgrading the shares to overweight from neutral. Price target raised to $95 a share from 70. And they do believe that pricing momentum paired with high bandwidth memory in the first half of the year will provide some major tailwinds, as well as with normalized inventories and some recent supply cuts. Pricing, they believe, should accelerate upwards in both the DRAM and NAND markets. They also argue that some of these production cuts from South Korea's competitors should be meaningfully achieved, as well as achieving the supply and demand parity. And they believe that on peak earnings, book values could reach between $50 and $60 a share, with the stock trading at a multiple between around 2.5 to 3 times. This name, 38 analysts, 30 do have a buy rating, but I will say we did just get their earnings. I feel like they're somewhat still riding the wave of what was a pretty strong report from Micron that reported. I mean, thank goodness it was like the most news-light week of all time, and Micron reported. So that was something that we had to discuss. But that name now doesn't have earnings until March, late March.
Yeah, I'm only seeing one major kind of well-known investment bank. That's Morgan Stanley with an underweight on this particular stock. So for the most part, I mean, you're talking 90-95%, at least in the hold camp for Micron. But as you said, Piper Sandler was really the culprit with this particular theme, as they did sort of a sweeping analyst update on the Piper Sandler front. The next one on our list here is Skyworks. This one not getting the same amount of love.
No, so this one getting that downgrade from Piper Sandler to neutral from overweight. Price target of $90. And this is due to its valuation as well as overall large customer risk. So the firm does believe that handset shipments particularly may continue to be under pressure now in the first half of this year. Their base case is that it will take 1+ years before Skyworks gets back to its high watermark of around $3.5 billion in revenues for their integrated mobile business, which they reached back in 2022. We haven't been back to those levels though since. They do see this sluggish growth at the large North American customer also in the first half of this year. And this name, more mixed. We have 12 buys, 18 holds, 1 underperform, and 1 sell. So mostly a neutral feeling on Skyworks. And this name is clinging on to about 11% year-over-year gain, but it's down 8% this week.
Yeah, this analyst note contains 6 downgrades, all from like an overweight equivalent to neutral, of which, of course, Skyworks.
All right, markets aren't going anywhere fast.
Also was in that bunch as well. Another name downgraded here by this analyst, which, of course, is Harsh Kumar over at Piper Sandler. No surprise, names you'll find in the overweight camp still. Micron, of course, is being upgraded. But talk to us about the thoughts here on Corvo.
So also that, like you said, that downgrade to neutral from overweight, which to me doesn't necessarily mean it's a bearish call. I feel like we see the word downgrade and we actually go to like, oh, they're pessimistic. No, they're just taking a more side.
Netflix with a bounce.
$20 price target is actually still well above the average, which is around $108 right now.
Micron is up.
They said their primary reason behind the shift is the concern again around handset growth.
Okay, back towards VWAP. This is just going to be a repeat of yesterday, it seems. Bouncing around. The key, though, is 4,700 still holding as support.
No doubt, and you can see the spillover effect. So not only is Apple important because mathematically it's a huge percentage of these indices, but if Apple's struggling, they're not going to be buying as much supply. So where do they buy supplies? They buy them from Skyworks, they buy them from Corvo, they buy them from countless names. I mean, I've just got the Apple supplier list from fiscal year 2022 up on the screen. First 25 pages, and the font's like this big. So the list is very, very exhaustive. You start looking at it, and it makes sense. It's the spillover effect of a big company not doing as well as planned.
And I think totally, when you're a company as massive as Apple, so many of these smaller technology companies rely on you. Naturally, when there's this weakness, it impacts every different aspect of Apple. So it's interesting
Okay, B and C pivots aside, we're looking for some sort of direction. We have nothing so far. It's just flat VWAP on the indices. Let's see what IWM looks like. IWM, flat. Q's probably a little bit lower, right? Nope, it's flat with VWAP as well. And the diamonds, that faded from the high, but still a flat VWAP. So markets are all doing the same thing. No momentum, so you can expect stocks to be stuck in the mud as well. If you're considering any trades, look to the healthcare sector, consumer staples, some of the transports.
Just by luck got that out just before or not, but it's almost immediately irrelevant because we have all this new information as well. And that's really what sent the stock into a bit of a spiral, I would say, today. We did hear from Bank of America, which has updated now since that. They slashed their price target from 47 to 22, downgrade from neutral to underperform after this outlook for 2024. And the key reason they cite is a surprisingly disappointing outlook, a large inventory buffer of its products built up by tier one suppliers. So they don't say it specifically, but they basically go out here and say that they're not having people buy their products by huge inventory buffer, essentially saying these aren't flying off the shelf.
And when you cut your revenue target by 50%, you're right, I totally did bury that lead. That is huge, that is substantial. And also interesting enough is they're majority owned by actually Intel, which they developed their various autonomous driving technologies for major automakers. So also, I mean, seeing some fallout from Intel as a result of that, when you have that massive exposure to a company that's trimming its targets. I mean, we did see also some of their customer orders they expect to fall significantly shorter of where they projected a year ago. So this is pretty major bad news for Mobileye.
Yeah, Intel taking it in stride a little bit, but keeping in mind that the stock's down almost 7% already year to date, but only down about 0.5% today, kind of in line, I would say, with NASDAQ stocks today, kind of bouncing around the unchanged mark. So, Intel, you could say it could have been worse, but certainly feeling it in Mobileye down almost 25%.
Yeah, I actually said that Intel's having a relatively nice day, considering that it is, of course, exposed to this pretty negative story of Mobileye. But we'll be looking more at the chart of Mobileye as well as an example trade, and also looking at Micron, which is, of course, seemingly a bright spot now in this overall market in the tech space. We'll be diving more into example trades, key technicals. Stick around, Next Gen Investing. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums, unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
There's no place like the New York Stock Exchange. We got you covered. The biggest stocks, the biggest trends, all the market moves. The Watch List with me, Nicole Petalevy, 2 p.m. Eastern on Schwab Network.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street. Monday through Friday, 3 p.m. Eastern, available anytime, anywhere, on any device for free. Only on the Schwab Network.
politics, no noise, and bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. It's time for our Chart Master segment. Today we're looking at Micron as well as Mobileye shares that are moving in two very different directions, especially this week alone. So, of course, here to discuss more on the technicals for us to be watching is Vicky Cat joining us here in studio. So, we're going to start things off with objectively the much more positive story and a much larger company being Micron. So, walk us through what you're seeing here.
Much more positive chart, too. And this one is interesting, I think, because we've seen a progression from a more modest upward channel type shape here, demarcated by our two blue dashed lines there, that transitioned to a more steep upward trend line there that recently kind of culminated with our yearly highs, 52-week highs near 87. Since then, we've seen heavy volume trading around earnings. That study I have at the bottom shows volume spikes when volume is above 50% of it. It's 50% more rather than its 50-day simple moving average. So you can see typically pretty heavy volume around earnings. This last one was especially heavy though, so showing some conviction on the part of traders. We had a retest of our yellow 21-day exponential moving average. Price had a bit of a decline. We're down about 5% or so from those highs that we reached about a week and a half ago or so. And we did bounce when we hit that yellow 21-day EMA. Now we tested the level that was...
I'm going to take a 5-minute break, guys. I'm going to go ahead and make lunch. I'm not going anywhere. I'll be right here.
Not quite able to do it just at this point yet here. But following our moving averages, we can see that the trend is still up based on these measures. Price is above all three moving averages. All three of them are trending upward. They're still diverging farther apart from each other. So things are looking fairly decent for this name still, although we are seeing a bit of a stall.
And I feel like that stall right now we can almost attribute to some of the overall market weakness because we've seen the stall in pretty much all of the major tech players, even a name like NVIDIA and Apple, of course, we keep bringing up. But as far as now the momentum of this trend goes, what are you watching here? Because I have to imagine with the stall in price, we're also seeing a stall in momentum.
Yeah, definitely a bit of a stall. That's a good word for it here. You can see that we had a little bit of bearish divergence in RSI, our measure of momentum there. Take a look at that red line going down across those peaks. Kind of complicated, though, because we were also crossing into the overbought area at the same time. So that's a bullish signal. We had on one hand, the bullish signal of crossing above that overbought area. On the other hand, we had the bearish signal of the bearish divergence where price was making new highs, but RSI was trending downward. More recently, though, we did finally crack. We trended downward out of that overbought area, that threshold of 70. We made new relative lows on the RSI. We made a new low versus our previous low point there. So, kind of an uncertain situation still. We are still above that 50 midline, so still more bullish, but definitely an interruption in this uptrend here. What you'd want to see if you were bullish in this game would be a pushback above that overbought area, a break above these old resistance areas that we've highlighted here, our red and pink lines there, and you want to see that downward sloping trend line on RSI invalidated.
So now as far as some levels you're watching, because we don't have a major earnings catalyst for quite some time now since we just had their earnings, tell us what you're keeping your radar on as far as support and resistance go.
Kind of a wide range to keep an eye on here. And I chose to include standard deviation channels on this chart here. We take our blue line, our linear regression line, our line of best fit based on closing prices. We hit standard deviations above and below those lines to help give us a reading on how extreme the price movement is. So relative to its own history, we're at the +1 channel, so somewhat, of an upward movement there, but not necessarily very extreme or anything like that yet. So that +1 channel is a resistance point coming in near 84, roughly matching up with that level of the gap that I mentioned earlier. 84.08 was that point here. So now we have kind of a wide range to look at here. To the downside, we've got our linear regression line that comes in near 77, just below that mark. That lines up with our old upper boundary of our channel as well. To the upside, our +2 channel, that would be fresh new highs beyond where we reached just about 2 weeks ago or so. That comes in near 91. So kind of a big area to keep an eye on here, but it could go either way at this point. Especially, I would be curious to see whether we can close above or below that +1 channel that comes in near 80 points.
Yeah, right. And the 84 right now looking a little bit like you said, more neutral. The price that we got out of pipe for today was 95, which is very optimistic. But obviously, that's 12 months out, I believe. So we're now looking at an example trade here, Alex. Walk us through your thinking, leaning into the fact that we are seeing some stalling momentum, some stalling price, and things look just relatively more tame in Micron right now.
Yeah, look at a neutral strategy in this one. Of course, as you guys mentioned, maybe it's just got a little ahead of itself and needs some cooling off and potentially can resume down the line. No earnings to worry about for a little while. So looking at selling an Iron Condor, going out to the February 16th cycle. So this is going to be your February monthly expiration. And then this kind of equal distance Iron Condor, $5 wide, still rounding the current share price. We're going to look at where Micron's trading in real time. It's about $83 a share. We're looking at selling the 77.5, 72.5 foot vertical below the market. At the same time, selling the 90, 95 call vertical. Whole package done for $1.50. Credit would be $150 max profit on $350 in risk. You can see that plateau-like risk profile that we've come to know with the Iron Condor. This is a strategy that benefits from a lack of activity taking place, or at least movement taking place, and time passing. This is one that really asks Micron to stay within a range, and that range of break-evens is from 76 to 91.50. You find that by taking that $1.50 away from 77.5 and simply adding it to the short call strike of 90 to get to 91.5. Risk is a move outside of our long strike in terms of max loss potential. It is limited to 350, as we said. But effectively, this is taking the short put vertical, the short call vertical, and putting them together to create a strategy that looks for a range-bound, neutral-like trade.
Right, and I think that is just perfectly aligned with exactly what Rick just laid out. And so now we're going to shift gears here and look at the name that's in a more precarious situation today. That is Mobileye, cutting a lot of its forecast pretty unexpectedly, also getting some analyst downgrades, which Alex so rightly pointed out are just sort of good luck timing, it seems like, with this move lower that I'm sure as a result of their lower targets, but we're down almost 27% here on the session.
Yeah, really tough move for the bulls today here. And when we look at our chart, we can see that it happened on extraordinarily heavy volume here. We're over 30 million shares changing hands today. That's not typical for this company. The average 50-day simple moving average volume is more like 2.5 million. So very heavy trading activity in this name. And, things were actually looking a little more problematic even before today. But look at that red line there, near 44.36. You can see that was our high close from back in July. We had two separate rallies recently. Our first rally did not clear that point. Our second one came closer, and it made a point above our previous high, but we still didn't really crack above 44 with any convincing strength or anything like that. Then things started to fall off. We started to slip below our moving averages. Yellow 21-day, orange 63-day. We fell below both of those within the past few days. The moving averages themselves also started to slope downward here. That's a sign of trend rollover. Not what you want to see once again if you're bullish here. So it was looking a little problematic as well before that. We also broke through our trend line, that blue dashed line there. Yesterday we fell below it pretty resoundingly. It was nothing compared to today's move, though. Really tough situation here. So now we have the situation where all three of our moving averages are trending downward here, suggesting that the new 52-week lows we reached today may have some staying power here. So beware of this one right now.
No kidding. I mean, we just dropped significantly below the 50 and 200, and I think it was really good thing that you pointed out, and that's the volume, which is just soaring. I mean, so much above its historical averages. So, I mean, as far as momentum goes here, what are you seeing?
Well, not a ton to say about this one because we had such a huge turnaround during the past few days. Things were looking decent before that. We did see a little bit of divergence, though. Look at our previous peak where we crossed into the overbought area. We did not make a subsequent higher peak. We actually were trending down. We failed to reach that overbought area. Now we're pretty deep into the oversold territory. That's the threshold of 30. So we're below 20 now, 18.7 or so. And remember, RSI only goes from 0 to 100. So once you start getting around 20, that's really quite low. That's a significant reading here. So momentum in the yearly lows previously near 28.73, inching closer to that level now. Momentum is definitely not looking positive.
I could imagine that. We're not necessarily seeing any bulls right now in this name pouring in on the day when we're down almost into now 26.75%. But as far as now some support and resistance, I can imagine this is difficult because we've broken through all of the major trends as of late.
Yeah, but we have a trick up our sleeve here. We've got standard deviation channels, and that's, the same study that I mentioned before. And I know there's a lot going on in this chart here, but it's important to kind of incorporate all these things together and use them in your trading. And you can see here that price is right now very close to the -3 channel, that solid red line near where we currently are at in terms of our price activity. That comes in near 29.23. So that's an area where you'd really be curious to see if we can manage to close above that level today as we near the end of this trading day. If we do keep going downward, -4 channel comes in near 25.89 or so. And, stocks typically stay between +2 and -2 standard deviations of that linear regression line on a yearly basis here. So a move beyond that -3 channel, that's noteworthy. That's a significant downward move here to digest for traders here. So 25.89 is potential support, 29.23 is resistance. Beyond that, if we do keep moving upward, 32.57 is our -2 standard deviation channel. So, good luck getting there at this point, but, stranger things have happened.
Stranger things have happened, and I think a really good way to break down the way to look at standard deviations, even when we're breaking so much below the averages we've been seeing for quite some time. So really great breakdown on two names moving very much in different directions. So now when we trade this name, Alex, walk us through what you're seeing, and I can imagine that it's more bearish as far as the example trade and like the FOMO feeling that we typically have with other names. With this name, I would say it's all to the downside.
Yeah, stock's getting hit pretty hard today on a fundamental update. There's already getting downgraded before that fundamental update. You can see the technical picture wasn't the brightest either. A couple things of note with this one, hasn't been trading all that long, so only monthly option cycles are available. I looked at a put calendar below the market, centered around the 25 strike, so looking for continued downside potentially in this name with this type of a strategy. Again, buying the April 25 put and looking to reduce that debit spent by simultaneously selling the February 25 strike put at the same time. The whole package around 65 cents for a debit would be $65 in risk on this one. And we, of course, know the risk profile has that mountain-like appearance to it, which it peaks out at that strike selected. So in this case, it is a 2-month-long calendar that actually doesn't expire on the long side until April. Selling February, 65-cent debit, $65 in risk, but it would be customizable for those who have a different outlook on the stock, both in time horizon and, of course, directional.
Yeah, and a pretty brutal day for Mobileye. But as we know, this is volatile. So even though we are seeing this mass selling today, perhaps now we could see some of this now hopefully priced in, as these expectations have been reset here. But we will leave it there for our Chart Master segment. Now coming up next, it's time for FOMO. We're looking at another name that's unfortunately making a pretty sizable move lower today. That is Walgreens, which is down 6.5%, a little bit over that now.
My dad was a hard worker. He used to do side jobs, installing windows, charging something like $100 a window, and other guys were charging $400 or $500. He just didn't want to do that. He was proud of the price he was charging. My dad instilled in me always put the people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me. Yeah.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device, for free. Schwab Network.
Spotlight the biggest market trends on Trading 360. 11 a.m. Eastern, only on Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction action in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Wrap up the trading day with me, Oliver Rennick, for the biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Welcome back. Time for FOMO. Walgreens in its earnings is the subject of discussion. Probably not something that always elicits that FOMO feeling, but it is today, and it's maybe for the wrong reasons, Jenny, as the stock continues its downwards trajectory. It tried for a month or so to make a recovery. Then it had to give us some numbers, and it was back on its way down.
Yeah, and I think the major concern of their quarterly update was the fact that they seem a little bit strapped for cash. Not exactly what you want to hear, of course, when a company releases these financials. So they did unexpectedly post a quarterly loss on a non-adjusted basis. That was significant and cut their dividend to shareholders by nearly half, which is obviously not exactly what you want to see. But net losses came in around 8 cents a share compared to $4.31 per share a year ago. So we are seeing that improvement as far as their net losses, but analysts have been forecasting a net profit of roughly 24 cents a share. Now, when you look at on an adjusted basis their earnings, that figure came in around 66 cents. That did beat expectations. So depends on what figure you're looking at, but all in all, sales climbed 10% to around $36.7 billion. That did also exceed forecasts, but they said they're in the midst of a challenging consumer backdrop and they're evaluating all strategic options to drive shareholder value while cutting costs. They maintained their fiscal 2024 outlook, which I think is huge, but again, cutting that quarterly dividend to 25 cents a share, that was down about 48%. Retail pharmacy sales did rise to almost $29 billion from around $27 billion a year ago. Comparable prescriptions filled increased about 1.3% in the period, but retail sales fell 6%, or comparable retail sales dropping around 5% due to what they said was a weaker flu and respiratory season. Now, what shocked me, because years and years ago, they were trying to offload their Boots UK business. That was actually a bright spot. They saw higher comparable pharmacy sales of around 0.8% and comparable retail sales growth of almost 10%. So Boots actually continues to perform quite nicely, with the sales overall growing around 18% in the quarter. So now it seems like that's a tone shift. This part of their business being somewhat of a headache from years and years ago to now being actually their brightest sales growth engine. I mean, that's a significant shift. And all in all, Walgreens has just suffered. I think the narrative still remains. They're suffering from the lack.
I know it's frustrating to have the markets just chop around and do nothing, but that's the situation we're in right now. So if you're looking for trades, again, to repeat myself ad nauseum, look at the XLP, consumer staples sector, look at the healthcare sector, pharmaceuticals, biotechs, medical device makers, healthcare providers. Those are the two sectors that are seeing a lot of the price action, higher highs and higher lows. And just we have to get through this next couple of days, I guess, because we're just a second day now with flat VWAP. I think Tuesday was flat too. We just gapped up yesterday. So although it's frustrating, I feel you, because I would like to do something a little bit more aggressively, but all I'm doing right now is selling credit spreads, condors, and just watching the markets. It's a slow process with iron condors, spreads, etc., butterflies. You have to wait for theta to kick in and for price to do what you think it's going to do. So it takes time. Not a kind of market that I want to take too many call positions and or put positions for a big move, because we just continue to hold this 4,700 level. So until we break out of this range and finish this consolidation of the past 10 weeks gains, until we break out of the consolidation, it's probably just going to stay like this. Frustrating. I would just say take lunch, do whatever you need to do, because run some errands, just listen to the broadcast, because there's not a whole lot going on. With that, I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It's Thursday, the 4th of January. It's 1:36 on the East Coast. Reminder, at 2:40, I need to leave here for an appointment at 3 o'clock with the doctor for my annual checkup. I'll be back probably by 4 o'clock. So just watching the markets chop around at this point.
especially when you're looking at Ford and GM, maybe shifting here in 2024 as the cost of trying to ramp up the EV business is a little bit higher than what they may have expected. But overall, we are really seeing the EV and the hybrid space is still just a very small portion of the overall business. Around 10% of Ford's total sales alone. And they still have a long way to go when it comes to trying to capture this market. But the F-150 continues, or the F-Series continues to be the #1 selling truck series for Ford. It's around 46 years around then that it has been able to keep that title. So I think that's always a nice little figure for them as they continue to command the ICE vehicle space at this point.
Yeah, and so kind of along those lines, all we hear about is investment into electric vehicles, and we kind of know the devil we know, if you will, is the ICE vehicles, and that, of course, has been the long-standing business of some of these legacy automakers, but it hasn't been enough to excite investment into these, stock shares. So if the story that they're painting for the EV isn't as strong with price slashing and adjustments and talks of no demand, which we see kind of across the board, limits that sentiment, is there anything here and enough here to excite investors beyond the 3-cent rally that we see today?
Well, I think, the ICE business is still a very profitable business, to say the least here. And they're also going to see maybe a little bit of a buildup in demand as oil prices and energy prices go down. We usually see this inverse relationship when it comes to EV sales and hybrid sales. As the price of gasoline goes up, that seems to trigger the interest when it comes to consumers who look at hybrids and EVs. When we start seeing oil prices and gasoline prices remain at some pretty low levels, that might entice some of these consumers to continue to stick with ICE vehicles. I think over time, Ford and GM knows that the industry is changing and they're trying to change with it. It's just the cost and scale of trying to make that transition makes it a little bit difficult, especially with labor costs going up in the next couple of years here. That's going to also eat into their projection when it comes to trying to expand their EV fleet.
Yeah, and Kevin, I think it may be perhaps the bright side of that, because I completely agree, is that we're anticipating this, right? We're anticipating it's going to be a relatively difficult environment for them to grow in. And at least now, perhaps we have some of these major headwinds behind us. That's at least a bright spot. And they're hanging on to their 0.3% gain here. But we will leave it there. Appreciate the insight, as always, Kevin Green, Senior Markets Correspondent for the network. Now, coming up next, it's time to discuss arguably the mover of the day. That's Apple, because it's dragging on the major indices. We'll discuss the second major downgrade this week with Renita Young coming up next.
At each and every angle, the whole picture, everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab Network.
Power your portfolio with the Schwab Network. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Next Gen Investing. Apple, the unlikely, for some maybe, culprit in the market's weakness so far in 2024. I can't believe we're already talking about 2024. It's been 3 days, but it's hard to ignore, Renita Young, Apple's weakness, as it's been in your face. Stock almost hit $200 a share. It is trading $182.95, and this is after a little bit of a rally here intraday. So talk to us. What's weighing on these shares? Because this thing just can't get out of its own way.
Well, first off, this is not the way Apple wanted to start out 2024.
No kidding.
Right. Nobody's taking a bite out of Apple, right? But it's because it got 2 price target cuts, 2 downgrades, I should say, this week. The latest one came from Piper Sandler today, cutting that target to $205 from $220. And the analysts have concerns about Apple's valuation. They also downgraded it to neutral from overweight. And so the broader handset and macro environment weakness in the first half of 2024, that's why this.
All right, up volume starting to pick up on New York Stock Exchange. Up volume starting to pick up.
Will be difficult for analog handset and consumer end markets. And then this analyst is actually starting out 2024 with a cautious stance on semiconductors. So I wouldn't be surprised if this sentiment seeps into semiconductor trading today, tomorrow, maybe a little bit longer as well. They also think that macro environment in China will also weigh or could also weigh on Apple's iPhone business.
And I think that that is the story here. It's the iPhone business. I keep saying this. I probably sound like a broken record, but I'm like, yeah. Dan said, of course, the various aspects of their revenue are important, but this is still a company that's so vastly exposed to the iPhone. So that's why I did find the sale earlier this week a little bit more compelling that mentioned more of this iPhone 15 sales cycle weakness. And I mean, Piper Sandler downgrade, or excuse me, cutting its price target to 205. But earlier this week, Barclays 160, which is pretty negative.
That was below where it was trading at that time. It's still below where it's trading now. But Barclays is what?
All right, Disney's starting to reverse again. Disney reversing again. Pushing higher.
Services will be a meaningful bounce back enough to offset the weakness that is seen in iPhone sales. And they're also seeing other weakness in other categories like Macs, iPads, wearables, weakness. And Barclays is looking at its services to grow maybe less.
Okay, Disney's starting to move back above VWAP. So we're seeing buyers at the low of the day. If we can get this to, what would be great if we could close positive on the day. I doubt that's going to be the case, but Disney definitely showing, indicating that we got buyers at the low of the day. So unfortunately, not every day is going to be an up day. Yesterday was a nice bullish day. See if we can finish higher today. Stochastic still set up properly. Need to see VIX, RSI back above 50. Apple sitting just above the 200-day moving average. I still think that was possible that we could test the 200-day. Merck. Merck. Nice follow through on Merck. All right, Merck, nice follow through on Merck.
Welcome back to Next Gen Investing. Time for Under 30. I'm talking alongside Jenny Horn. Joining us now is senior markets correspondent for the Schwab Network, George Tillis, to discuss rocket companies, not to be confused with something flying off into space, George. We're talking mortgages. We're talking Rocket Mortgage, I think would be the brand that many viewers would be familiar with.
Yeah, I mean, ideally speaking, when you think of Rocket companies, you think of Rocket Mortgage, but in fact, the offerings for the business guys is actually expanded quite a bit into other areas for consumer finance, which includes things like personal loans and auto loans. They actually have, the mortgage origination business is actually their primary business. They also offer things like title services, and they actually have a digital advertising and digital talent division, as well as a customer service technology division. So they've been expanding their different offerings across the board, but unfortunately for the company, the mortgage market.
Merck, just watching Merck on this breakout. 117 is the breakout level. We're above that level. AMD, a nice reversal today. Starting to see a little bit of short covering and new trades coming in. Almost a bullish engulfing candle. Looking for a bounce. Look for a follow through tomorrow. Maybe a trade on AMD tomorrow.
But they actually look at the call with their price target now at $10.50. It's really about the risk reward profile. In other words, looking at the entire consumer finance space, which is becoming very, very competitive. We talked about SoFi, for instance, yesterday. They're a competitor in the consumer finance, the auto loan markets. Just to give you an example, they're looking at the profitability profile of rocket companies. It's not necessarily as compelling compared to other consumer finance companies in the respective groups. So there's other businesses out there. If you look at Ally Financial, they're very auto-centric in terms of loans. If you look at Capital One, Discover, the consumer credit cards and consumer personal loans, as well as the auto loan market. I think the mortgage market, is picking up, because if you look at mortgage rates, which I did, they actually peaked close to, this is again, average credit rating at 7 7/8%, so close to 8%. This is going back just a few months ago. Now they're down about 6 3/8%. So they've come down about 150 basis points, which again is compelling for the transaction volume for rocket companies. But nonetheless, you have to consider profits, and this is important because even though rates are coming down and expected to be cut, at least on a short-term basis, the Federal Reserve, we're not going to get to those levels we were, let's say, 2 or 3 years ago. And that's important because, for those who are hoping the mortgage market is going to come back to the 3% level, that's going to be sort of far-fetched considering that rates will fall, but probably not the same levels we saw prior to the pandemic or even post-pandemic when they were extremely low. With mortgage rates actually below 3% at that time.
So, George, before we let you go, I'm glad you mentioned SoFi yesterday, because I was going to ask, is this just more of a broader call to more defensive of some of these consumer finance stocks?
It is. It's not necessarily JP Morgan saying, hey, we're picking on rocket companies because they're a bad company. I mean, one of the things I did note is their operating cash flow is actually negative in the last 4 quarters. And that's to be expected, because you have to look at the back half of last year was really bad in the mortgage market. But going forward, their earnings growth is about 5%, revenue is 4%. These are the estimates. And they can improve if rates do come down, let's say another 50 basis points on the mortgage market. So, it's not a call on Rocket per se. They're just looking at Rocket on a relative basis, companies which have a better profitability profile and maybe not have the same level of mortgage exposure or mortgage origination exposure that Rocket does.
Right, and I think that's like an important distinction, because it's not like this company they're saying is falling apart by any means, but we are seeing shares somewhat fall apart today. We're down pretty substantially, but we will leave it there. Appreciate the breakdown as always, George.
remember when I first started flying and we would experience turbulence, I would watch the flight attendants. They're not nervous, then I'm not going to be nervous. Financially, I'm the flight attendant in that situation. The relief that comes over people once they know they've got a guide to help them through, I definitely feel privileged to be in that position.
I'm Nicole Petalini, live from New York Stock Exchange. Catch me on Schwab Network, available anytime, anywhere, any device, for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
ZIM Market with the Schwab Network. Tune in 24 hours a day, 7 days a week on SwabNetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. ZIM Market with Schwab
Excuse me. All right, so got about an hour before I have to run to an appointment. A little bit less than an hour. I have an appointment at 3 p.m. I'll be back here most likely by the closing bell. Not much to do. Not much to do. I just opened an order for my son. Just opened an order for my son on Amazon. $180 credit with a $380 cash hold, something like that. So we're looking for Amazon. Looking for Amazon to hold right in this area. Max profit would be about, oh, I took it for 175. Sorry. Credit. So we're looking for that credit. Looking for price to stay in the range. Amazon. I took this for myself, just a larger position than my son. I'm teaching him how to do credit spreads, so I'll show him when he gets home. Looking for Amazon to stay in this area or potentially get down as far as, 140. I sold the 135 and bought the 130. I sold the 160 and bought the 165 for protection. It's an Iron Condor. Looking for price to stay inside of that range. Over the next 30 days or so.
tomorrow's jobs number and the corresponding wages data that we'll get in that jobs number is really going to drive trading tomorrow. Remember, here's some of the expectations for jobs. 158,000 payrolls are expected. Unemployment expected to go from 3.7 to 3.8%. Wages from up 0.4 to up 0.3, and the year-over-year wage data from 4% to 3.9. That, Nicole, in my opinion, will drive stocks tomorrow and the reaction to those numbers.
Yeah. In the meantime, Mobileye shares of plunging. This chip maker is warning of an order pullback. Doesn't sound good.
Yeah, the Israeli-based self-driving and advanced driver assistance company is basically cutting their numbers for next year. They cite excess inventory from their customers. They lowered their fourth quarter revenue guidance and full year revenue guidance, Nicole. And what does that do? That brings in downgrades. So Wolf Research downgraded it to peer perform from outperform, even though they really think it's a pretty significant company in the work that they're doing for self-driving. And then Bank of America downgraded it to underperform from neutral. Price target $22, Nicole, down from 47. They claim the disappointing 24 outlook gives it a limited upside. So real bad news. Mobileye down just under 26%. It was down 26% when we came on the air. So a significant down day here in Mobileye, on lower numbers.
And just so folks know, that ABC number, the private sector employment in the U.S. rose by 164,000 in December, and annual pay was up 5.4%. So this is part of what we use. It doesn't necessarily mean that it shows you what tomorrow is, but it's always good to take a look at the big picture. We'll see some fewer job openings. That was another thing that was on my mind. Kevin Hanks, good to see you. Thank you so much. Now let's take a look at the bigger picture. Octavia Lorenzi's with us, CEO of Optimus. Thank you for being with us. So your thoughts on the big picture? I mean, I know that the job market, labor market is still tight, though loosening some. What say you about 2024? How do you feel about the market?
I'm actually feeling pretty good about these markets, and I've been in a good long time. So I'm feeling we're off to a really good start. We saw a nice rally at the end of last year. I think going into this year, basically, because the Fed sort of models pushing interest rates, or at least not raising them any further. And that's going to be very, very good for equities and for bonds and for all sorts of other asset classes. We're certainly seeing a spike at the moment with Bitcoin and gold and things like that. So those are areas worth watching as well. But I'm very optimistic about this coming year in terms of equities prices and where they're going to go. And I think really at least all eyes on the Fed and what they're going to do. Now, I will say we saw the minutes come out from the Open Markets Committee yesterday at the Fed. It's a bit of a mixed bag, but there's not as clear a direction to tighten rates anymore, keep them very, very high. So there's some dissent brewing within the Open Markets Committee about whether that's the right path to take. And that's going to be very good for the markets as they start to think about lowering rates. So that's basically what we need to do, keep an eye on the Fed. But I'm, like I said, very optimistic, the most I've been in quite some time.
That's actually pretty good. Nice to hear it, particularly since when I asked one of the traders here about the year 2023, he said, well, all I can say is good thing that those last 2 months, right?
All right.
October was pretty tough, but then you had the end of October, November, December, which was better.
Disney back to VWAP. S&P just holding on to support. Flat VWAP, no momentum. Up volume is a little bit more skewed to the upside, skewed to the bull side.
So there might be a pullback here or there. There always is that possibility. But I think overall the direction is going to be upward and onward, as it were.
Right, understood. So when you have an investor and they're telling you, what can I do here? Put my money to work. What do you advise to them?
trades, those are the stocks that we take off. We've seen that over the course of the past few months as well. So I think we'll see.
Okay, let's go take a look at skew. Give us an idea if institutions are concerned. We already know that institutions don't seem to be that concerned, so they're not buying a lot of puts. VIX is still below 14. So one way to check is to look at skew to tell us whether or not institutions, they're right at 135, but they're well off of the extremes that we saw at the end of the year. Extremes thinking that the markets were going to roll over. They were hedging. They closed those hedges, as you can see, drop back down to 135. I'd like to see this moving lower. Okay, last time back in October towards the bounce area, the area where we finally bounced to late October, you can see that skew had made it up to 144, then it dropped back down and oscillated back up to 154 as we started to rally. So right now, I don't see a lot of concern. It doesn't look like traders are worried about a downside move to the 50-day at this point, as long as we stay above that could change, of course, if we drop below the 4,700 level. So right now, I don't see a reason to be too concerned because other investors don't seem to be as well. Okay, let's look at junk bonds. All right, junk bonds, we want this to be making higher highs and higher lows. All right, so we're sitting on top of the 21-day looking for a bounce, inside day for now. The green line is IBB. We want to see that moving higher. We also want to see IWM, the red line, turning up. These are actually three risky assets. And we want those to be moving higher, telling us that we have a risk-on appetite. Crude oil, the blue line, is moving lower. That's good for consumers, lower gas prices. And we've got 44,000 is the Bitcoin. Bitcoin is hanging in there. That's another risky asset starting to move back into yesterday's down candle. Advanced decline, while below the 10 MA, is still making higher highs and higher lows. And finally, the 10-year, we have one indicator plus the dollar that is giving us a headwind, but not a reason to outright just start selling, okay? If you don't like the amount of risk that you have on, I would suggest doing what we did the previous 2 weeks going into year end, which was to take profits off into strength, reduce your exposure, reduce your risk, gain some cash. Here goes VIX is starting to move higher now, VIX. So if you're still concerned, you can hedge if you don't want to change anything. My personal belief is that until we decisively lose 4,700, we could still gyrate in here and have people do some knee-jerk trades, get shaken out of some trades. But there's not really anything to tell me to start selling. Now there's a mechanical issue that kicks in if we drop below 4,700. Okay, the mechanical issue is there's a lot of in-the-money calls overhead. There's a lot of in-the-money calls at this point, I should say. And if we start to move lower, those calls start to lose money. Now, the dealers are long gamma, so they have shares to offset. If we start to lose 4,700, the people that have those in-the-money calls will likely start liquidating positions, taking profit. That, in turn, will cause dealers to start selling as well. And the more we blow past the 4,700 level and start moving lower, the more that kicks in. So you have to know that a move below 4,700 would be an area where I would be buying more protection, selling more overhead call credit spreads. All right. So it's the reverse of a put credit spread. Put credit spread, you're looking for price to move away. So you're selling a put, thinking the price is going to elevate in price. If we lose 4,700 and start dropping and we start to see a lot of selling, then I'll turn around and sell call spreads overhead because I'm looking for price to move lower. So I'm going to reap the premium for people who think we're going to break out with the market starting to move lower. I know it seems kind of counterintuitive, but there's always somebody out there trying to buy calls. And if volatility picks up with VIX, then options are going to get a little bit more expensive. Bottom line, with everything I just said, watch 4,700. Hold or sell into strength above 4,700, take risk off. If we drop below 4,700, take more risk off, hedge more, and position for downside move. 4,700 is a key area right now. All right, so we're just grinding people's expectations, just sideways. All right, let's see. What else can we look at here? New York FANG Index. Be nice to see a Morningstar Doji at the 236. Okay, Morningstar Doji would be, you got a red candle yesterday, a Doji today, indecision. Tomorrow we get a big bullish day. Look for a bounce. Not saying that's going to happen. We could very easily just drop down to the 50-day. Let's see what the Qs look like. The Qs. Okay. All right, it's 2:22. I got to leave here in 20 minutes. 20 minutes. 20 minutes. Okay, so S&P.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
What is Tesla doing anyway? All right, we're down. We're heading down towards 4,700. Okay, I just think that they're gonna. I just think they're gonna frustrate everyone. The way the markets look right now. Yeah, I realize Grover was telling me that as well. Last time he traded, it ran up $100. Okay, what is this? Thursday the 4th? Okay. Got to leave here shortly. About 10 minutes. I got to cut out of here, head to my doctor's appointment. Should be back by 4 o'clock. Annual doctor's appointment. I hardly take any time off, as you know, if you've been around for a while. Got to take care of the old body from time to time. Need to go see the doc, make sure everything is in working order. All right, looking for a bounce so I can leave with 4,700 support holding again. Now, remember yesterday we dipped below it right at the close and then bounced this morning. All right, so I'm going to go ahead and leave now. There's nothing going on. The market's coming down to test. I will be monitoring the stream from the road. I have to go to a doctor's appointment. I'll be back probably around 3:45, my guess, near the close. Okay, so I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It's Thursday the 4th. I'm going to a doctor's appointment, annual doctor's checkup. So keep an eye on the markets. I will too via the YouTube channel and be monitoring the Slack. We'll see you guys shortly. I just got to run. I'm going to give myself an extra 5 minutes to get out of the neighborhood. See you soon. See you soon.
Welcome to Morning Trade Live on the Schwab Network. I'm Oliver.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Kickstart your morning with a full dose of commodities, technical analysis, economic data, and live reaction in global markets. Available anytime, anywhere, on any device for free. And available on all your favorite streaming services. Futures with Ben Lichtenstein every weekday, 8 a.m. Eastern on the Schwab Network.
Welcome back to the Ron Phillips Up and Cole Pedal Ladies coming live from the New York Stock Exchange. 3 minutes left in the trading day, and we are seeing some up arrows trying to hold on to some gains after what we saw the S&P yesterday down Wednesday was down for the third day in a row. The Nasdaq is looking to snap a 4-day losing streak right now. The S&P is down. Nasdaq down a quarter of 1%. The Dow is in a quarter of 1%. Russell's up 0.5%. Market prep was pretty good in that you had many of the futures up arrows, so really hovering around the gains line as we await that big jobs report tomorrow. I'm going to bring in Ben Lichtenstein, who's a futures contributor here on the network, to take a look. 90 minutes left in the trading day. I know you'll get to Treasury, but the big deal here is that we see 4%, and Jim Bianco calling for 5.5%. That would be the highest levels we've seen since 2001. So we have a lot to discuss. I'll start off with the big picture. 90 minutes left in the trading day. Your thoughts?
Well, kind of a choppy trade here, Nicole. I'm not sure how much to make out of today's session. I think we're kind of just in a bit of a holding pattern as we wait the data tomorrow. I do want to talk about rates, but let's get into the indices first and foremost, because we've continued to see some further weakness off highs we saw at the end of the year and to begin the year. And you can see off in last week we were from that 4,800, 4,850 level that we come off about 100 points to the downside. So still holding these lower levels, but mostly just consolidating within and around the range that we established yesterday. So let's take a step back from some of the selling we've been driving in the chart the last 4 or 5 days, and you can see here that all-time high again up to 48, 41.50. We're looking at the futures here, and you can also see last month's highs. So we briefly traded above the December highs at the beginning of the year, but followed through somewhat limited, kind of rolling over. But again, still kind of hanging in there for the most part. This was the big update, if you remember, back on the 13th of December, and again, there was a lot of conviction associated with that. So I think it's important for the bulls that we're still holding above that level right now. Still a bit of a bullish pattern here as we look at this, again, hourly candle chart. And then just one more step back, I'm going to show you really the strength that we've seen off the October last year lows, and then even more importantly, just the year that was last year, from 3,804 all the way up to the highs I just mentioned, 4,841. So we're talking about 1,000 points to the upside in a year, and again, the pullback that we're seeing here, basically 100 points off that right now. So I'm kind of not getting too concerned about the selling we've seen over the last few days here. I think it's just a little bit of profit taking after a solid run up here and ahead of some data throughout that got investors a little bit on the edge of their seats, but I think that's always the case when you're on all-time high. But went back down to, okay, well, now we're going to start to see cuts rather than further hikes. The Fed paused 3 times, and we have seen yields come off significantly, right? Spike up 5% in 10-year. But I've got mine on the 4% level because, well, we saw a lot of energy in stocks to the upside as we saw the 10-year break down below 4 into that 3.78 level. Now, again, still kind of hanging off this range down here, but I feel like if we're to get a lift here, if we're to get a stronger than expected data point, yesterday's more pushback on those cut expectations for March and a little bit further out into next year. Well, then ultimately, I think that 10-year could continue to come off and back up through 4%. It's kind of that psychological level. Take out 4.25, man, I don't want to think about getting back to 5%. I would definitely derail the momentum we've been seeing in stocks. So let's take a step back here from the hourly candle chart here. I'm going to show you the declines we've seen, because this again was really fueled stocks to the upside, in addition to stronger than expected reports we've seen here suggesting the U.S. economy has managed to avoid recession. But again, kind of stalling out here, get back up above 4.25, those highs from October of last year, of 2022. Well, we could settle into a bit of a range below 5%, but yeah, take out 5, that'd be a big concern. Lastly, I just want to point to and remind everybody again, I think a lot of what we're seeing here in terms of speculative, is this selling that we saw on, I think it was Tuesday, a bigger deal than just some profit taking over that. I think it's important to remind everybody here, you can look at the quad chart and see that we are just a matter of ticks off those all-time highs here. So this, I think, very typical ahead of the post-launch jobs report like this. Don't forget, we got CPI and PPI next week. So investors are going to be a little bit on the edge of their seats here ahead of some of this data. And in a Fed, data-dependent environment, we as investors and traders are as well.
Right, okay. Then Mr. Frank, thank you. Appreciate it. Let's turn our attention to the ETF market. We're waiting, of course, for the decision on the stock exchange ETFs and what happens there. That's been dominating the headlines for the Bitcoin trade as well. So let's get some insights on all of this. Welcome in, Anika Hilal, the ETF data and algorithms CFO. Thank you so much for being with us. People love ETFs. They find into a wonderful trading tool, gives them more of a basket of things. And there's thematic ETFs, there's index ETFs, there's leverage ETFs. And it's been, I think, a lot of fun over the last decade. It's something that our parents didn't really have. They were looking at mutual funds back then. In the meantime, let's talk about some of the themes that you're watching for 2024. What would they be?
Sure, Nicole. Happy New Year. First, it's important to note that 2023 was a very good year for ETFs. The year, actually, the industry finished very strong in the last couple of months. Wasn't looking as good in the first half. We generally look at 3 things when we're looking at the ETF space. One is close activity, then there's returns in terms of how the ETFs have performed, and then new launches. On all 3 parameters, ETFs actually did really well, particularly in the last 2 months. We actually set a record for back-to-back months in inflows in November and December of 2023, and ended at about $580 billion in total inflows for the year. We had 540 new ETF launches in the year, again a record number. And in terms of performance, of course, as you know, it was the year dominated by tech, growth-oriented themes. The QQQ ETF was up 54%. Tech ETFs were up again 54-55%. So overall, a very good year for ETFs. And looking ahead, we actually expect that some of these growth and tech-oriented themes will probably maintain momentum going into this year.
Right, understood. So how much excitement do you think there will be? I mean, everybody's sort of eagerly awaiting to see if this is moving forward and get the okay. And should be imminent that we get the okay on the Bitcoin ETF, spot Bitcoin ETF. But do you even think that they will do that? Or is it more kick the can down the road? Because they've certainly been kicking that can since last year.
Low tick alert -800.
We don't know for sure, but all indications are we will get approval. Our understanding is that the SEC has been in pretty active discussions with the 14 issuers who filed and are waiting to launch waiting for approval. We've also seen regular updates on regulatory filings, including updates on tickers, expense ratios. We now start to get some idea on what those funds would look like in terms of costs. Fidelity has now come out and said they'll price their product at about 39 basis points. Invesco's at about 59 basis points, even though they've actually announced that they'll waive their fees for the first 6 months. So overall, things that we think it will take some time before flows actually pick up. It takes time for firms to market their products and advisors to adopt them. But overall, it does seem like this will be a new breakthrough in the ETF space.
Yeah, understood. What about the thematic ETFs? Where do you see strong growth? What seems to be popular? I mean, of course, even last year was the year of tech.
Yeah, even within tech, if we parse out particular themes, we've seen certain themes be very strong. For example, fintech actually, again, linked to Bitcoin and blockchain, did very well. If you look at an ETF like VITS, that was up over 200% last year, calendar year. We had semiconductors, of course, do well. Anything that had NVIDIA, of course, not surprisingly, had a good year. So if you look at, for example, SMH, which is a semiconductor ETF, was about 75% last year. We expect that some of these sectors will continue to maintain momentum in this year as well. Analysis by some of my colleagues at CFRA show that generally, when you're coming out of an up year, you want to let the sector winners ride and stay with the sectors that have done well. And so our fundamental analysts right now believe that even though tech is at a high valuation, the tech sector will essentially grow at that multiple. And so there is still room for growth there. So overall, we're still overweight the tech ETFs and communication services relative to the broader market.
Yeah, you think some of those things that did well last year could do well again. What about, let's turn our attention abroad? I mean, you have emerging markets, you have international, ex-China, with China, India, new China. Your thoughts?
Yeah, it's been interesting. We talk about emerging markets a lot, and sometimes they don't always live up to expectations. But one of the interesting things about last year was a huge divergence between China and the other emerging markets. One of the challenges of investing in emerging market ETFs and using broad emerging market ETFs has been that China makes up 25-30% of these ETFs. And so if China is doing badly, that trade doesn't work really well. And so what we're really expecting to see next year is some unbundling of emerging markets exposure. In other words, investors may be using emerging markets ex-China ETFs. The PMXC is an example. And maybe pairing that with China ETF to calibrate China exposure more in a more targeted way. Or maybe even using individual country or regional ETFs to essentially build up an emerging markets portfolio. And this is all in response to the fact that China still faces headwinds. There's political tensions between the US and China. The companies may look at diversifying the supply chains. So in response to all of these things, we do expect to see some unbundling of emerging markets exposure and maybe a little bit more attention to markets like India, Taiwan, Korea, and others that may benefit from some of these supply chain changes.
Yeah. And just tell me, I mean, overall, if someone were to ask you on a test, how do you feel about the market? And I saw on the test as well from the CFRA today, and his general feeling about 2024 was what?
Right now, I would say we're optimistic. We think that a lot of the sectors that had momentum in 2023 will continue into 2024 unless something comes out of left field or surprises us dramatically. But given the fast patterns of sector changes in such bull markets, given that the Fed may cut rates, and given that overall the ETF industry has been healthy, I would say we're optimistic about the markets and the ETF industry going into this year.
Yeah, understood. Thank you very much. I'm going to allow CFRA on ETF today. Thank you. Still ahead, our panel is ready to discuss Walgreens. Surprising to see the Dow Jones Industrial is higher by 93 points. Walgreens is still down. It's down about 6%, certainly off the lows of the day, and cutting the dividend. That was huge news. What is the decision of doing so mean? The outlook for this pharmacy chain coming up.
Cut the cord on the way you get market news. It's Market on Close. Join me, Oliver Rennick, for the biggest earnings coverage, insights from the smartest minds on Wall Street.
Hi, Tip Alert Plus 800.
Friday, 3 p.m. Eastern. Available anytime, anywhere, on any device for free. Only on the Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any any device for free. Schwab Network.
Missed out on today's market headlines? Get caught up and catch the rest at schwabnetwork.com. Available anytime, anywhere, on any device for free.
Welcome back to the watch list. We're watching shares of Walgreens taking a beating off the lows of the day, but still down about 6% after having been down double digits in percentage terms. Also, after a quarterly report, the company also announced slashing the dividend by 48%. Hasn't done that, hit its dividend in over 40 years. So there were some upbeat points within the earnings report. Let's dive into this name right now. Brian Shankle is with us, healthcare equity analyst at Jefferies. Cedric Cho, founder and president of Point Wealth Capital Management. Thank you both for being here. Brian, I mean, there were some good points within the Walgreens report. I know they're working very hard to improve cash flow. For example, really looking through the strategic options of how to improve things. What did you make of this?
Hey, Nicole, thank you, and Happy New Year, and thanks for having me here. So I would say, look, I mean, I think you hit the nail on the head, right? The dividend cut was viewed as a negative. Fundamentally, the company maintained EPS guidance for the year, but the reality of it is that they were able to maintain that because of a tax rate issue coming down. But the operating income outlook for the company has shrunk, and they called out that the U.S. consumer outlook is weakening, and that is one of the headwinds that they're facing. On top of something that we've talked about in the past, how they're continuing to face gross margin pressure in the pharmacy. So putting all this together, and I think, you mentioned the healthcare investments that they're making, those continue to drag on earnings. Management maintain the guidance for that specific segment, but putting all of these pieces together points to a slightly worse outlook operationally for Walgreens, and that's why the stock's down, plus the dividend cut off.
Yeah, understood. Sandra, what did you think?
Well, I thought there was a silver lining, right? So they definitely, I totally agree that they face a lot of headwinds. Consumer spending is down, but that's really for every company. I think Tim Wentworth, the CEO, has his work cut out for him, but there is a possibility of a turnaround. And there is some progress made with cuts and really looking hard at those margins, streamlining the product selection, and the possibility that he has mentioned of incentivizing managers to increase sales growth and encouraging pharmacists to recommend store brands over name brands. So there is some potential there for a turnaround.
Yeah, and Verizon is a down component with a dividend payer. Everybody was looking at Walgreens was one of the big dividend payers within the Dow 30. Sandra, when you see a cut, does it raise a red flag? Or is it just sort of a reorganization in your mind?
It does raise a big flag, but that flag has been up, right? Their earnings have, though they're up, their cash flow has been just not great, right? And their margins are very, very slim. So they are doing some things like closing unprofitable stores and trying to increase margins that way, but they might be forced into a sale of assets in order to free cash flow and increase their reserves, their cash reserves.
Yeah, they said they were basically nearly having the dividend to bolster their cash position. But Brian, at first the stock went higher, but then lower, and I guess folks got sort of spooked. I mean, the other thing is the consumer, and as you noted, the operating income outlook looks a little weaker, the concerns about the consumer, and maybe a shifting of habits. For example, I can tell you here in New York City, everything is locked up. So if I want Zyrtec, Tide, and ice cream, put shampoo on there too, I have to go stand in a thing in the hallway with those things and press a button and wait a really long time, 4 times. You know what? I get all that on Amazon pretty fast. And so what happened is that the fun of going around in Dwayne Reed, which is where I spend a lot of my money, it doesn't happen anymore because it's not worth the time and the effort. Everything's locked
shrinkage is an issue that has actually worsened, right, in the first fiscal quarter for the company. So that is certainly an issue, Nicole. It's something that is dragging their margins. But just to your point earlier on cash flows, right? I mean, and the dividends. Maybe one thing I'd point out, they burned through almost $800 million of cash in this past quarter. That compares to about $100 million of cash burn last year. So I think they really needed to focus on shoring up the balance sheet. And obviously, the dividend was one of the easier levers to pull. I mean, it's a painful decision for management to make, but at the same time, I think it was a necessary decision, especially given the recent Moody's downgrade that they saw on their bond rating.
Yeah. Brian Tanquillet of Jefferies and Sandra Cho of Point Wealth Capital Management. Thank you both for being here today. Appreciate it. That's going to do it for us here on the watch list. I'm Nicole Catalidi. Thanks for being with me live at the New York Stock Exchange here on Schwab Network. And I will also join you for Market on Close, but Oliver Reddick kicks it off at 3 o'clock, so stand by. He will be right up next.
Knock, knock. Number one broker here for the number one hit maker.
Thanks for swinging by, Carl.
No problem. So, what else for?
This lets me adjust the bass, add more guitar, maybe some drums.
Wow, so many choices.
Yeah, like Schwab. I can get full service wealth management, advice, invest on my own, and trade on Thinkorswim.
You know, Carl is the only front man you need.
Oh, I gotta take this, Carl. Schwab.
Have a choice in how you invest with Schwab.
I'm Nicole Catalidi, live from the New York Stock Exchange. Catch me on Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Trading the trending names every day. I'm Tom White, host of Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Welcome to Schwab Network.
Daily live exclusive content tailored to today's investors.
Broadcasting 24/7 from our studios in Chicago.
And from the heart of Wall Street at the New York Stock Exchange.
Up to the minute market insights.
Example trades and stock-specific analysis featuring the smartest minds in the business.
No politics.
No noise.
Analysis ahead of the biggest events for the economy.
From bell to bell and beyond.
Watch live
and on demand.
24/7, 7 days a week on schwabnetwork.com.
And on all your favorite streaming services.
Available anytime, anywhere.
On any device for free.
Schwab Network, empowering every investor and trader.
Every lucky day. Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
Be part of the latest commodities action on Future with Ben Lichtenstein weekdays, 8 a.m. Eastern on the Schwab Network. Available anytime, anywhere, on any device for free.
I'm Oliver Rennick. Get ready to cut the cord. Market on Close is coming up. Good afternoon. Welcome to Market on close and all of that. We've got an hour left in the trading session. Stocks generally pretty okay, but not very good. Got a little mixed action. A little up, a little down. Dow's best performer again. You know the Dow has been trading at all-time highs for some time now. The Dow's in leadership the last couple of days does reflect some of the rotation of the market that's been underway as we've gotten softness generally in big tech names and strength and firmness in underappreciated staple like utility, healthcare style companies. And some of those do help the Dow a little bit more, particularly in the healthcare category. So we've got mega caps, of course, NASDAQ is a laggard. Russell hanging on, kind of a mix, not really. S&P's a little changed. Not a whole lot to say, honestly. Sporting got a pretty decent bond sell-off, and that has held, but it hasn't really accelerated at all through the data that came through today. The numbers came in pretty early. Bond hasn't changed much since. It's kind of interesting that we're down 50 bips in the 10-year, but the dollar's not really taking off. You know, if this is the market when bonds are selling off 0.5%, that's pretty encouraging, I think, for bulls. I've argued that equities should have some resilience built into them now for bond sell-off, given that we're only at 4% for the 10-year. 8% coming off the high for the past 52 weeks. Familiar with the level. I don't think anybody actually has come on this show yet and said they think the Fed is going to cut as much as the market says. So even though you have this pretty extreme pricing in bonds for all those cuts next year, it's still at like 6.5 cuts, kind of depending what hour you check it. But nobody, not a single person has come on this show or anyone I've seen anywhere say that they actually think the Fed is going to cut that much. So the thing is that there should be a little volatility in bonds. That seems like it should be understood at this point until we really resolve the difference between the Fed's signal for a couple cuts versus the market signal for a lot of cuts. So I would think, and I will argue, that stocks should be more resilient to some bond sell-off right now, but you never know. Obviously, that's been the culprit for major weakness over the past 2 years. We need to stay alert to moves like we're getting in bonds down 0.5%, but when the dollar is down, you don't really have that full-on risk-off trade. We talked this morning about how it made sense for the dollar to be higher when it was down this morning, and it did go higher. It was green, but then it came back down. We're kind of right about that, kind of wrong. Generally, what you know is that when yields and the dollar are up together, that's when stocks really start to buckle. And we're just not getting that. Some of the data from this one was okay around the world. Some thoughts maybe kind of improving. Got some decent data there, but there's not a whole lot really developing here on the macro until I think Friday. We've got your big important report. One thing, look at the 10-2 spread, because in the wake of the Federal Reserve's acquiescence to the market when they put those 3 cuts on their dot plot last year, I expected to see some curve steepening because when you have the economy as strong as it is, and a Fed now showing a willingness to further loosen financial conditions, you think that would be good for the economy and that our yield curve should widen out. It really hasn't, though, over the past couple months. But note that we'll be selling this week. The 10s and 2s are actually kind of trading at the higher end of the range since like November. So it's kind of interesting. You see the 10s and 2s spread push back up to a fresh high, then we can talk. I think that's basically what tends to get interesting. Because the framework that most people have right now is not really for steepening, and even if it is for steepening, it's purely for a bull steepening where most people expect yields to come down overall over the next year. But in the last 3 days now, with some persistent bond selling here, you've actually kind of stretched that yield curve back out. You can see that kind of 2-month range it was in. Now we're near the high end of that range. It's still off the 52-week highs. That's the other thing I'm watching. Actually, one other chart real quick. As some of the big tech stuff struggles here, your high-quality trade that worked really well last year is just kind of flattened out. If you look at a chart like NVIDIA, we're going to talk Apple here in a second, which is pretty soft, but the NVIDIA chart still looks like an absolute beast to be reckoned with as we have continued to generally gravitate up and to the right. And it's just not really showing any weakness. Another day up 1.5% here. Got me kind of let's talk some Apple first. I feel like that is kind of the story of this week. We've been talking data and what's going on, but at the end of the day, Apple's just
sluggish, and there's a lot of negativity and a freshly negative note today. We're talking about it all day, but I still think it's the most important day.
I've talked about it in every single live shot I've had today. But listen, the latest no come from Piper Sandler downgraded the stock to local rate, cut the price target to $205. And while on the whole they're most concerned about the valuation within that, the biggest product they're concerned about is the iPhone. They feel like iPhone sales growth might have peaked already, and they're concerned about its growth going forward. That's really the big story about this.
And the same message from Monday too, right? So this analyst today lines up with Monday, highlighting the iPhone.
Oh, absolutely. So Monday was, or Tuesdays, I should say, was a little bit different.
Oh, that's right. That's right.
Although, right, we missed
the day off.
You know, we missed the day. I'm still riding 2023, but I'll get to it next week, I guess. But from earlier this week, Barclays also cut its price target just by $1 though to about $160 a share, and they did downgrade the stock to underweight from equal weight. But they noted the sluggish iPhone 15 volume, said that the upcoming iPhone 16 could also be sluggish, but they said it's a more broad story about wearables, about other devices like the iPad and iMac as well. So they're saying that those may not be able to recover as quickly.
This is kind of getting more dramatic. The more analysts turn sour. I can't really think of the last time. There were instances, Kevin, of course, where the broad analyst community has doubted Apple, and generally they've been wrong. But it doesn't come around very often. I can think of a couple pockets in the last 5 years where you had a stretch of analysts warning. When it was the beginning, like 2022, I guess maybe. We've had pockets of it, but not for at least like a year and a half.
Yeah. How many times can you say that Apple's oversold?
I think that's the point. Yeah.
Yeah.
And what I've just gone so
there's not a lot of those on the calendar. There's a couple. It happens because people, move money around and lighten up and do other things. But Apple's currently sitting right at 30 on the RSI, and it was lower than that midday. So it has come back a little bit, but this is what 5.5%.
I don't realize. So Apple is almost oversold at this point.
Yes. And 1930 on the RSI is technically oversold now. Now, a warning to everyone: it can stay oversold just like it can stay overbought for a long period of time. Boeing was basically overbought for most of the fall. So be careful there. It's one tool to look at.
Yeah.
So the momentum.
It's not a coincidence, right?
Exactly right.
That because here's the difference. We talked about before. Okay, I know we're going to say, okay, we've kind of been repeating some stuff in the past week. But look, starting off the year, things generally are still kind of forming the narrative. So we're trying to get really into the weeds. And the really important point is that NVIDIA versus Apple are completely different stories. I almost point out the NVIDIA chart actually looks pretty good still because it's gotten cheaper over the past year.
Because the PE.
Exactly.
The stock is low and the earnings have exploded.
Which is the key point. Because now the analysts are basically coming together, kind of going, it's expensive by Apple standards. Right. Some of these notes, though, have also been like kind of salacious in a way, where they have the downgrade, but then like they're still calling for higher prices. Right? Because the guy names what, 200 plus?
Right, 200 plus. The one today, 205, and that came from what was the previous price target was at 220.
Okay. So they still need to make a record.
Right, they still need to make a record. Not quite, right? And that's why the other two, I think, were more significant. So it was just one other downgrade, which was just $1 downgrade. However, it was below where the stock is trading. Almost comical. However, it's still below where the stock is trading, right? $160. And then there was D.A. Davidson that initiated at $166 a share. So that is also significant. And then with the neutral rating, yes, yesterday.
Okay. So yeah, some of those are actually real kind of negative commentary.
Yeah.
The one today, not so much because we still got the $25 price.
Right. And then we still have the bulls who will continue to bull like they do earlier this week.
Yeah,
Absolutely.
Okay, and the RSI, I hadn't realized that, did I? So it's not kind of oversold. So, all right, that is indeed the story for the good things we've done. All right, we should get let's be talking to Bob, get back to the macro here. We'll talk some more in tech and do some
trading as well, but let's skip bonds and talk about the rest of the year ahead, which so much seems dependent on expectations of big pivot by the Federal Reserve. Joanne Bianco joins us from Bond Blocks, an investment strategist and client portfolio manager. Joanne, welcome to the show. First, tell us about Bond Blocks. You guys have a lot of bond ETFs and really specifically targeted funds, from what I can understand.
That's right. Thank you so much for having me on your show today. Really appreciate being here. And yes, Bond Blocks, we are a fixed income ETF provider. We have 20 funds currently and more to come. And we're focused on enabling investors to have more precise exposures within fixed income asset classes, including high yield, treasuries, and emerging market sovereign debt.
Yeah, that was the other thing I thought was pretty cool. Is it's not just duration targets. You guys have really specific funds. Actually, to be honest, I didn't know about that. I'm probably going to be using in our coverage more often because oftentimes they have trouble showing credit in a way that a lot of people can trade, right? So, especially for the low ETF traders, this basically brings a whole asset class that honestly there's not that many options for. I mean, I know the duration-wise, you've got competition there, but high yield energy, high yield telecom, media, sector-specific stuff. That's we don't have a lot of funds like that you can do with that.
There are no other funds like that.
Really?
We are the only ones that break down the high yield industry, the high yield market by industry sector and by rating category. The only competing fund that we have is one to our double B ETF, but that one, we have the whole suite, double B, single B, and triple C, and no other provider has that.
Got it. Okay. All right. So these are all very specific. What is there anything green right now from your flows are moving, particularly in the high yield space? Like, are you seeing people make big bets that we're going to have this great year of contained inflation risks, contained credit risks? It's like, is there nirvana showing up in your flows like it seems there is in the bond market?
Well, we're thinking that, there's probably more flows to come into high yield. It was a more muted year last year in terms of flows, even though it ended up being the best performing asset class in fixed income, led by triple Cs, and I think that surprised the market, and also by the consumer cyclical industry. But high yield was a great performer last year with a resilient economy that continued. It filtered down to really the fundamental strength of all these high yield companies. And, we're not anticipating that to be much different this year. We're still at elevated yields. We have coupon income that is attractive for the high yield asset class. It is about picking your spots, though, about being more precise in terms of your exposure. Not all high yield exposure is the same risk, as you know. And so, what we try to do is give people the ability to look beyond broad-based benchmarks and invest more specifically in high yield.
Okay, but as you decide which products to make in the future and where you want to put the emphasis, imagine you've got some kind of macro view that you imagine might unfold this year. Can you give some insight?
Well, our macro view is that we think it's going to be another resilient year for the U.S. economy, and we're not forecasting a recession at any time during the year. We also think that we are near the end of the Fed rate hiking cycle and see more opportunities within fixed income as a result of that this year.
Okay, so if we don't get the deep recession, then high yield credit we think is doing pretty well, or is it as backwards of a world right now where a decent economy, no recession, means no cuts, or not as many as the market thinks, and you make sure you don't want to stretch your high yield too far. People still have to pay up.
Right, but you are going to be benefiting from the higher coupon income that you get from high yield versus other asset classes. So from that perspective, it still could be a good total return play.
You have to have something really bad happen.
Excuse me?
Was that right? You have to have something really bad happen.
to make it not worth the coupon.
Right.
Do we know how
And
that?
that's not our base case or not my case right now.
Okay. Seems like that's kind of one of the big questions for next year. Like, even if you have a downside scenario, as pretty much everybody does, the question is whether or not it's going to be like a black swan type situation. It's going to set off like
Low tick alert minus 800.
Right.
Yeah. So, high yield then ultimately is it the quality of the economy that matters more than the interest rate level?
It has been. We started with fundamentals that were stronger this time, at this point in the cycle, and probably in any time that I've seen in all the years that I managed high yield bonds, just fundamentals being really solid for high yield. So this starting point in fundamentals last year, and it continues this year, where companies have, focused on managing their balance sheets. There's not too much debt that's coming due in terms of the maturity spectrum. And, so we're in a place that we haven't been for the high yield market. We're not at a place of excess, which is what has created some of the default rights spikes in the past.
Two kind of questions for you then on where some of the higher yield credit stress points might be. One is like in terms of financing, the other is in terms of timing. We're kind of just thinking of one, as you mentioned, there's no big moments coming up of payments. Where is kind of like that? If we just say hypothetical, the rates don't go down at all. Where is that kind of wall that some of these companies will start to hit? Is that like next year? Is that this year? 6 months? 18?
It's probably, it starts growing a bit next year, but it's still manageable next year.
Okay.
This year is definitely manageable.
This
So,
year.
the earliest that you have to kind of look out is 2026, and honestly, a lot can change before then.
Okay, so like the zombie credit wall is not in 2024?
It is not.
Okay, well, that's reassuring. All right, so then the other stuff then, I guess, is 2 cuts, 6 cuts, that doesn't matter so much to the point about what matters more is in the economy right now. I think that's very useful. What's the most popular fund right now that you guys are getting most flows in?
Well, the most popular fund for us in the past year has actually been our XHLF, which is 6-month target duration fund, yielding over 5%. So that's been, a low risk way of being able to capture some, great yield.
Okay. And people view this as a yield play, not like, do they put it in their equity basket because it's an ETF and they're looking for yield? Is it still part of bond allocation?
No, I think they did it instead of doing, it's a low cost product, it's only 3 basis points of fees. So it's really competitive versus money market mutual funds and CDs. So it's basically, a great way to, earn returns on your cash. But, in the most recent months, we've actually seen a lot of investors start to go out in duration, starting to increase their exposure to some of our longer duration funds. And then we've also seen strategic exposure in our rating category funds. The triple C one has definitely gotten inflows in recent months. And, so we're seeing people use our products the way that we anticipated that they would be used. They can be in the short stuff and then move into the longer duration stuff on the treasuries, and then they can dial up or dial down the risk exposure in high yield, either with the credit rating category funds or with industry sector funds.
Great stuff. Thanks so much for the details, and I'm looking forward to continuing the topic this year and a lot of great stuff going forward.
Thank you very much for having me.
Yeah, absolutely. A fun conversation that wants to go Anthony on the bonds a lot. All right, duration specific, but more uniquely the high yield by sector and specific credit rating too. We come back. It's long shorts. Gonna catch up with Vince Russo joining us, acting manager. We've been keeping tabs with for a couple of years. Always good conversation. Don't miss it.
My dad was a hard worker. He side jobs, installing windows, charging something like $100 a window, and other guys were charging $400 to $500. He just didn't want to do that. He's proud of the price he was charging. My dad instilled in me, always put people before the money. Be proud of offering a good product at a fair price. I think he'd be extremely proud of me.
Trading the trending names every day.
Fast market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Empower your portfolio with the Schwab Network. Schwab Network is available anytime, anywhere, on any device for free. Schwab Network.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week at schwabnetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Schwab Network.
It's time to move forward
Find the next trend.
from every click to every tick.
There's no fear of missing out on next investment.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffee. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Market on Close. Let's get along in a short hit. Vince LaRusso, President and CEO at Pro Capital Partners. Vince, welcome back to the Schwab Network, sir.
Thanks, Ollie. Nice to see you.
Absolutely. I'm always excited to see you. And hear about your stock picking method and your very good details. But I'm kind of like trying this conversation because your long pick is a funeral home business or something.
It's true, Ollie. Thanks for this setup. I hope I don't disappoint. But,
No, the Patrick
maybe we can
Bateman's
talk about
finance
SCI.
TV show.
Well, as an asset manager, as a portfolio manager, we have to look across the equity universe, purchasing ideas that are right for the environment. And, truth be told, this has been a company that I've been following for many years, really because of the management team. As you mentioned, the industry is not that glamorous, but the death care industry in the United States is a large business. And, SCI has a leading market share. They've got a 15 to 16% market share of revenues. And they really are professional operators. When you think about the needs at that time for, as folks think about pre-need purchases of funeral plots and cemetery services, they really have proven to be very professional and honorable operators. And I think that's one of the reasons they've been able to grow the market share on a really compelling business that, as equity holders, we think it's a compelling position.
Right. Well, I've sure heard a heck of a lot of really logically, fundamentally sound healthcare theses based on the aging demographic. So I guess it makes sense to just project out to the next level. So I feel like that about sums it up pretty well, right? I mean, there's a reason why people want to own a bunch of healthcare companies. I as well put it all.
Well, as I think Ben Franklin is credited with saying, death and taxes are the two sure things. And, demographics play a role. But again, as operators, this management team has done a really good job of being stewards of capital. So share buybacks, dividend, tuck-in acquisitions. They actually grow EPS at about 8 to 12%. That's their model for EPS growth. They've been able to demonstrate that for a very long time. But as we think about some of the volatility in the capital markets and some of the consumer and credit, they have a level of visibility that goes beyond mortality and demographics. They actually have $14 billion of pre-need sales, which is sales that have already been recognized, not in a GAAP perspective, because they haven't delivered the service. But folks, if you think about, in their mid-60s, start thinking about this planning, this stage of their life, it's not uncommon for folks to buy into closets to prepare for the services and to actually engage in a contract to take care of this need. But SCI doesn't recognize that revenue until they deliver the service. And it's just a staggering number, in my opinion. But with that market share for, executing so well for so long, we now have $14 billion of what we call pre-need sales that have already been made, but not yet recognized.
Big backlog. If I were their marketing team, I
I would suggest that they adopt a spokesperson in the actor who plays Wags from Billions, because there's a great funeral and plot making scene in that show. That's probably the best 3 minutes from that show. I don't know if you watched Billions, but that's a great.
I remember that. I don't remember what when he paid from that for.
Yeah, exactly.
I do remember.
But hey, let's talk your short, Yeti. I mean, it seems like they're doing a decent job getting people to pay silly amounts of money for coffee mugs and stuff. What's wrong with that?
It's a brand that people like, and they've been doing a really good job of that for a long time. What we're starting to think about from the perspective of somebody who's short Yeti in our long short line CBLS, we think there's some maturation in that category, and there's also some increased competition. What we're seeing is that Yeti's starting to lose some shelf space. In fact, one of the things that sort of happened out of this holiday stretch is some viral videos of some of the competitors' offerings that consumers are clamoring to purchase. And you think about distribution for something like that, sporting goods, some of the more local regional distributors that are prominently featuring Yeti for now several years. We're starting to see some of that shelf space migrate over to some other partners. One of the things that Yeti might be navigating here is that they've done such a good job, as you mentioned, Ali, on the DTC or direct to consumer channel. It's more than half their business, and I think some of the retailers might be perceiving them to be a competitor now, as much or more so than a partner. And that is opening the door for some of the scan phenomenon that seems to be getting some traction. So, the product is great, it works, but the stock at 18 times earnings in a maturing category with increased competition, to us looks like a good short position for CBLS.
Is that earnings? I mean, 18 doesn't sound super high compared to the market at this point. What measure is that?
Yeah, that's fair, Ali, compared to the market. But this is a consumer company. It's a discretionary purchase. You're thinking about something that has, as I mentioned, a lot of competition. And typically, you look at companies in that category, when they start to reach maturation, closer to 12 times earnings. So it's not purely a valuation short. I mean, we're interested to see how they navigate the holidays, how they deal with their recall. Think this increased competition, loss of shelf space are all fundamental catalysts to the downside, potentially impacting earnings. But we might get some lower earnings, but also some more contraction. At 18 times is not very expensive relative to some of the technology companies and faster growth companies, but they don't want to mature into a 12 times PE multiple from the 18 that they sit at today. We think that might happen.
Okay. Well, I've also heard people talking about some other new coolers people are using with the big straws and stuff. I'm not complaining on the brand name right now, but there's another one that's really popular.
Stanley Cup seems to be the big one.
Oh, that's it. Okay, yeah, that's it. That's when you mentioned Stanley. All right, so I mean, preference and popularity can be a fickle thing. Things can be fickle, but it does seem like this is almost a meme product. Kind of one of those things that seems like they're a product of the zero interest rate and easy money world. And none of those products have gone away though, man. They're all still here.
Yeah, they won't go away, but it is one of those products that with easy money, as you mentioned, and going back to the COVID phenomenon of folks being outdoors more and traveling more with things like coolers and campers and fishing rods and Yeti mugs. That was a great period. They introduced a fine product at the right time, and I think just to a large degree they capitalized on it. But it's that transition to a more mature business with more competition, and as they sort of pull back in some of those areas, it's creating catalyst.
Okay. All right. Like the case, I just feel like you gotta get some more tightening in policy to really suck that Yeti cash flow out. Because you still got the coins and stuff going crazy. Bitcoin's $50,000 almost. We can afford $100 hub. I could pitch up a little bit.
Yeah, well, we'll circle back and see how we do with this one. But I do think the Fed might go easier on policy as opposed to tighter soon. But the consumer part of this equation is starting to show a little bit of signs of fatigue.
Love it. Appreciate it as always. Thanks a lot. Vince Russo.
Thank you.
Join us for Full Capital Partners when we come back. Got 2 bullish trades in the options corner, 1 bearish. It's in McDonald's. After getting just back to those recent highs. PDs is the subject of a fader today. Someone thinks it's going to drop back down.
I remember when I first started flying, and we would experience turbulence. I would watch the flight attendants. They're not nervous, and I'm not going to be nervous. Financially, I'm the flight attendant in the relief that comes over people once they know they've got a guide to help them through. I definitely feel privileged to be in that position.
Every morning, every trade, always live. Expert earnings analysis, in-depth technical insights on every changing trend in markets. Available anytime, anywhere, on any device for free. Welcome to Morning Trade Live on the Schwab Network. I'm Oliver Rennick.
Empower your portfolio with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Get each and every angle, the whole picture. Everything comes full circle on Trading 360. Catch us right here at the New York Stock Exchange on Trading 360, only on Schwab Network.
Welcome back to Market on Close. That's options trades. Mr. Tom White here from the studio. You got bearish trade McDonald's thought of it. I think he's sprinted right back into his MPS. Got close to depression, went high earlier this week and knocked down all about 8 cents there.
Yeah, impact's not as big as the initial impact when that news came out. We were on fast market when the CEO came out with that statement on LinkedIn stating that it's not only the Middle East but other several markets are getting impacted. He did say that there was some pushback on some of the that are affecting the brand misinformation on social media sites that said that McDonald's was supporting one side or the other, which he kind of pushed back against. You saw some reaction from Starbucks, which turned back around with positive. QSR, restaurant brands, also got impacted on the news. CMG did a little bit also. So saw a little bit of a pullback. What is that going to equate to? How long is that going to last? What's the impact? Is probably a little bit of clarity. You mentioned the stock hit $299 in July when the market was at all-time highs, or near all-time highs, or 52 highs, and then pulled back with the overall market down to $245 at the end of October, rallied over 20% to those levels, but just sitting below all-time highs here. Steeple came out with a positive note on them. The price started at 322 on the shares, outperformed. So it's had that parabolic move back higher along with the overall market since the October lows. But this news, what type of impact on a percentage basis is this going to have on the company? I think is what a lot of investors want to know. And what other areas, sectors, is this going to affect, right? The geopolitical risk that's out there. So, got some put buyers in here.
Boy, that might be a stretch, man. What kind of geopolitical risk with McDonald's and
So the market pushes back against all that.
Not going to show up at crude oil, but they show up at McDonald's, like, God.
Well, when the CEO comes out and states that, maybe, a warning signal.
Like a low ball. That's a low ball.
But, the stock's gotten a lot of...
Crude's not responding to war in the Middle East. Yeah, but the chicken's been sucked.
But that's what I mean. The market tends to push aside a lot of maybe initial geopolitical risks, right? McDonald's shares probably will too because the stock bounced off the lows, even though it pulled back on that news. Saw some put buyers out there in the February cycle, so about a month and a half to expiration. Saw it traded by over 2,000 to 290 strike push, basically at the money. Paid debit about $3.40, so that break even of 286.60 over the next 43 days. It's only about 2% below the current share price in there. Got duration in this trade, 43 days. Put volume about 4 times the normal daily average volume that we've seen over the last 5 trading sessions. But then on the flip side, Oliver, call volume actually spiked up a little bit, about 3 times the normal daily average volume. So this trader is taking a bearish view, maybe hedging a position that they might side, we're seeing call buyers in there also kind of pushing against this news that this is going to severely impact the revenue.
I'm a little bit of a downer for the fundamental case. But respect the trade. Let's talk Eli Lilly.
Respect the CEO, Oliver. He's the one that came out and stated it.
Right. I think he's lowballing. Well, the market's selling off too, so. Okay. All right. Eli Lilly. Let's talk about kind of crushing it right now.
Yeah, the weight loss drug going Lilly direct. So this is like he's almost taking a page out of Nike, right? They still have that relationship with Foot Locker and sales, and now they're going to sell direct to consumers where their margins improve. Eli Lilly going to do the same thing. As long as you have a subscription to their new weight loss drug, then maybe you can buy directly from the company. What does this do as far as pricing goes? Because that's one of the headwinds for consumers out there is the pricing, the drug company. What does this do for PBMs out there? So there's a lot of news swirling around this. Stock did hit an all-time high today. What was up 59% last year on the outlook on the weight loss drug, along with Novo Nordisk. That stock's up on the back of this news also, and that's now the biggest market cap in Europe. So yeah, the weight loss drug. WW got hit on this move. It's down over 10%. Sure, at one point. But Argus did put out a note.
That's the stock, by the way, that I think legitimately should take a hit because if you're paying for weight watchers, you're going to be overlapping more with customers who are going to pay for weight loss drugs.
Exactly.
All the other ones are like a big stretch. That one to me is like 1-to-1, basically.
Yeah, I think it's a good mix for Lilly where they can still go through PBMs, sell it that way. But you're still monitored by you're still getting a prescription for it, so you're still monitored by your physician. But just by it direct, maybe you get less payment on that thing. So saw some call buyers in there in January 630 calls in the January 5th weekly series. So these are buyers for strike hours. The 630 strike call at 8550 for about 5,000 of those. That break even just above 635 for tomorrow, 2.5% gain. Stock was up earlier, but that break even.
So what time is the trade?
This is midday, right? Call volume is about 3 times the normal daily average volume. You should expect stock hitting all-time highs today. We're seeing a little bit of a pullback from those highs, but I think this makes sense for the company. And this call buyer thinks, hey, I'm going to play for the next 24 hours. We saw a lot of back and forth in the near-term options that expire tomorrow. We typically on news like this, we see a lot of buyers and sellers in here, but people taking full of view.
Well, look, I mean, anytime it's expiring tomorrow, it's it catches my attention because even though it's looking for the level we were at earlier today, you might go, all right, no big deal. It's kind of a big deal because it's trading now at $20. Yeah. Off that high again. So I mean, we're a little flat.
Yeah, we could easily be up there. I mean, think about the sell side is probably going to come out with some notes on it overnight.
Well, maybe,
based
sure.
on the fact that, hey, maybe we've run the numbers and that direct to consumer really
does that look like a good risk reward?
Yeah, I mean, because the break even is about 2% of what the difference. So you get another move like we saw this morning on this
side. It's going to happen tomorrow.
Yeah, exactly. But that being said, the 0-date options, that grown massively in volume. SIBO, I think, is up 35% of full volume.
All right. Here's the other mix too: is that the healthcare stocks have been trading like inverse to Nasdaq. If the Nasdaq bounces back tomorrow, probably in trouble with the healthcare trade. All right, let's do DraftKings real quick. Now, let's trade. We know the story.
DraftKings, they're rolling out a position that they have. They got earnings on the 15th. This stock was up 209%.
I know that's the story. That's what I'm saying. With all those stories, they're killing it.
Right, they are killing it. But we saw a trader sell out of some February 2nd weekly options on the 35 strike call, and they bought 10,000 or 18,000 on the March 15th monthlies and 34 strike calls. Paid an average debit of $3, so that break even at $37 over the next 71 days. They'll capture that earnings event about 12% above the current share price in there. Call line is double what we've seen over the last week on a daily basis. So yeah, someone's taking a stance here that we're going to see some more good earnings, and if they get more approvals, we're still looking at Texas and California, that's going to be a big move for them.
Because Vince LaRusso from our earlier segment, Cold Capital, listening right now, and he's going, Phoenix, they're not crushing it. Look at their valuation. They don't make any money. They've got competition. That's true. I just feel like, that high is only going to get bigger over time. utilization continues to spread.
Well, think about this. They $3.7 billion worth of revenue business generated last year. That was 65% above the prior year. So we're still growing.
Yeah, for sure. That's massive. Okay. Next up, coming up. Let's talk some Bitcoin. Bob Iron is on with us. We're going to chat about the ETF drama, the ups and the downs, whether or not Bitcoin is still working the stock risk comparable in a down zone world. We're also pretty big meteorite deal in sports biz. You want to give us a developing update on the ESPN deal with the NCAA. We'll be right back.
Schwab Bank Investor Checking, the checking account built for investors, named highest in client satisfaction by J.D. Power for 5 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with no monthly service fees or account minimums, unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Accelerate your market knowledge.
And shift your perspective into full view. Real-time example trades, a full hour of trading.
I'm Tom White.
I'm Kevin Gates. Catch me on Fast Market, weekdays at noon on the Schwab.
Fast Market, ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
It's time to look forward
Find the next step.
from every click to every tick.
There's no fear of missing out on Next Gen Investing.
Available anytime, anywhere, on any device for free. Empower your portfolio with the Schwab Network. He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Market on Close on the Schwab Network. Time for Bitcoin with Bob. Bob Iron. Join us, he's got his hat trade partner with All right, we'll talk with BTC. Maybe Bob, are you paying attention to all this stuff, or can we just zonk out on crypto until the SEC makes whatever decision they're going to?
Well, there's three things I'm paying attention to relative to Bitcoin. Since it's Bitcoin with Bob, I'm glad you named that. So, from a perspective of the SEC and the results of the ETFs, whether they're all approved all at once, a little at a time, somebody told me today that the market is pricing in an 83% chance that they're going to be approved. I'm not sure how you calculate that, but let's just call it that. So it seems to me like this could be a sell the fact kind of a situation. I don't think that sell-off will be big, and I think the sell-off will likely be bought. You had Goldman Sachs talking today about being one of the authorized participants in BlackRock's ETF and Grayscale's ETF. That's pretty big support there when you got Goldman Sachs involved. So I think that's likely. If it is a sell the fact event, I don't think it's going to sell off very much. Maybe the high 38s, but that would be about it. So I'd probably buy that dip. The second thing I'm looking at has to do with central bank. So we still have 6 rate cuts priced into the futures markets right now from the Fed. And you initially talked about the possibility that Bitcoin was actually a stock market hedging vehicle. Well, we can find out if it is an actual stock market hedging vehicle if the Fed cuts rates 6 times.
I think you would lever with it really more than hedge. And pretty correlated.
So we would need to see if the Fed starts cutting rates and they cut rates 6 times, they likely are either driving us into a recession or there's already a recession coming. I mean, you don't cut 6 times unless you see a recession coming, given the numbers that we have now. We're going to get non-farm payrolls tomorrow, expectations for about 150,000 jobs, but the whisper numbers crept up to about 172,000.
So you're gonna cut rates 6 times based on that. If you do, that likely means a recession is coming, or someone sees a recession coming. And if Bitcoin becomes the thing you sell to raise cash, then it's not a stock market hedge.
Do you think BTC has some real cyclical properties to it?
I think BTC should act like gold, and that really hasn't, although it's performed well in some of the same periods that gold has. Gold does better when the dollar is devalued, right?
I love the chart I got the other day that had ranked all these different asset classes by their volatility adjusted returns, and gold is the best on the list for the last 2 years.
Well, I think that's one of the things people look at gold and they say, well, Ken Fisher had that article about how it doesn't perform as well as the stock market. Well, it's not supposed to. It's supposed to be the store of value for when you're worried about the globe or the U.S. That's what it's supposed to be, and that's how it behaves. We need Bitcoin to behave the same way. And lately, it's just kind of correlated too much to the NASDAQ. Although that broke away about 6-8 months ago. You and I talked.
Yeah.
But if we get a sell-off based off of the Fed doing too many rate cuts or not doing as many as the market wants, then we're going to see if Bitcoin's become a store of value.
Totally. I super agree that is a big test. Because so far, generally, risk assets have loved whenever the Fed's cutting, but in theory, if it ever is actually happening because of the deep recession, then stocks in theory shouldn't like that. So Bitcoin then in that moment has got key opportunity for itself. So it seems like you're earning the ETF stuff is just kind of like on the side for now, and that drives it, and then whatever is the result of that, we come back to the macro case later on.
So look, as a fan of Bitcoin, I'm kind of hoping for that result, because in the same way that equities tend to start to rally in the early parts of a recession, I'm hoping for one so I can load up on both Bitcoin and more equities that I missed out loading up on these previous moves.
Thanks, Bob. Appreciate the chat.
Good to see you.
Talking about the latest in sports media, Jimmy Horn hosting next gen in a developing story. I understand this is a big number and a pretty big league, the NCAA number.
It is. And so, okay, NCAA ESPN reaching this 8-year deal. It's worth around $115 million annually, but the total deal is valued at like $980 million. I mean, it's crazy money.
So what else is in there? How do you get that extra $800 million?
So, well, that's like the total of the 8 years. So it's $115 million annually, and that's 3 times the size roughly of their current deal, which was around $40 million annually.
It's almost $1 billion deal for less than a decade.
It's huge, yeah. 8 years, over $900 million. I mean, this is pretty massive. They have said that a good chunk of that has been for various marketing costs, but also it will then help with some of the exclusive championship coverage of various rounds of like women's basketball, volleyball, gymnastics, softball, what have you.
Just every sport? Just any NCAA?
It's not. I don't believe it's okay.
No, that's the
That's
question.
the fine print.
It
is 40 NCAA championships, so it's not every sport. I don't know. Gotcha. I might be the wrong person to ask about that. I mean, it does provide international.
More than football.
It is more than football.
I'm not sure if like NCAA, does that mean just football?
No. That means that
Low to alert minus 800.
Basketball's actually okay. Funny that you say that, because as we've seen the sports media landscape change, actually women's sports have become much more lucrative to their overall business. Right now, we are seeing women's sports notching record ratings in recent years. Actually, ESPN has benefited hugely from airing the WNBA and NCAA playoffs, and there's so much that so many people have consulted on the deals that 57% of the value is tied to women's college basketball specifically, which is kind of amazing, because I do feel like that is an aspect of sports that doesn't get the proper coverage. So that's definitely a bright spot. Media rights will also allow for revenue distribution units across women's basketball tournaments, men's basketball tournaments. See, I'm a pro-sports girl, so I'm not as familiar with the NCAA world, but I do know this is like high viewership as far as ESPN goes. And this relationship between the NCAA and ESPN has lasted more than 45 years. So this is just continuing to strengthen that bond. But the next is...
It's not like a huge surprise.
I don't believe it's a huge
Because I'm kind of wondering about this whole thing, like, well, who else is like, Amazon vacation?
See, I think that would have been a shot. Now, the next segment that's up for grabs is the NBA, because that is like huge money. It's going to expect it to have a massive price tag, but right now it has to make current decisions before it expires, before the following, the 2024-2025 season. So that's the next major like cash cow that is right now up for grabs. That I could see far as like professional sports coverage goes, I mean, like Amazon, Apple, all seen as potential bidders, but of course, we will have that. That's more of a wait and see story. I will say that ESPN was like looking at how this actually impacts stocks, of course, majority owned by Disney. ESPN gets a lot of flack for being non-profitable, like hemorrhaging money, but actually in their fourth quarter, which was the first time they broke out the sports division as its own, we saw revenue rose around 1%, and we did see operating income rise 16%. So ESPN viewership has actually improved, despite that all you hear is
narrative.
I know all you hear is like it's a losing star, but it is lose some actually in the third quarter, and then came back in the fourth. So breaking out those numbers, I think makes it look. If you look at year-over-year viewership, they're still up.
Yeah, that's pretty impressive for all the flack they get in the commentary about content. Well, they're spending the heck out of their budget, so they're gonna have to keep up the pace at minimum right now. Thanks, Jenny. Appreciate it. All right, our sports dosage for the day. We're gonna get our little slight policy Washington D.C. dosage when we come back. It's our big picture panel from our Schwab team. And it's gonna be a really good one. As we hope that a day that is looking worse, the closer we get to the bell. Yikes.
I was born on the south side of Chicago. It's been a long road, but now I'm working for Schwab. I love to help people understand the world through their lens and invest accordingly. You can call us Christmas Eve at 4 o'clock in the morning. We're going to always make sure that you have all of the financial tools and support to secure your financial future. That means a lot for my community and for every community.
No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device or phone. Schwab Network. Power your portfolio with the Schwab Network. Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
We got 7 minutes till the bell. Stocks looking more red here. Dave Peterson joins us from Schwab's Center for Financial Research, Director of Derivatives Analysis, and joined with Mike Townsend, Managing Director of Legislative and Regulatory Affairs at Schwab. Dave, great to see you again. Mike, I love your appearance rate because I get really excited whenever I see it. It means like, something big is coming. But hold the thought on the policy. Maybe let's talk markets for a moment. We're down a little. VIX is a little changed, and we can't seem to get anything started this week.
Yeah, Oliver, we did talk about the negative RSI divergence on Tuesday. You look at the price action today, yesterday, look, first of all, my focus is more kind of near term for our more active trading audience, more lean on technicals, more lean on near term catalysts. So I'm being maybe, kind of focused, really narrowly focused here when I talk about price action and where we close on the day. But yesterday we closed at the lows. It looks like today we're closing on the lows again today. One would think with the benign ADP report and the initial claims that traders might want to be in stocks at the end of the day before tomorrow's open. So this kind of price action just tells me we probably have more of a pullback or consolidation period that we need to go through. If you look at the leaders in sectors today, healthcare, financials, real estate, money's trying to find a place that perhaps isn't as susceptible to some of that profit taking from the big rally from last year. But it's part of my thinking is if we get a benign non-farm payrolls report tomorrow, does that kind of re-emphasize some of the moderately hawkish tone that we got on the FOMC minutes? Maybe that's what the market's thinking. We saw some of the probabilities for a rate cut in March pull back from about 88% on Thursday to about 68% right now. But the action's tentative. This does not look, it looks like we got more to go.
I like the point particularly about tomorrow because we could go, or even maybe still, I might argue that most data outcomes are going to be well received by the market because, we've got hyper cuts in reversal price by the market and then cuts in reversal price by the Fed. So it's like it has to take something monumental for us to get like a big tail risk surprise. But at the same
price action would argue, why aren't people been getting in the market today ahead of tomorrow's employment, right? So then maybe the thesis I just laid out is a little bit off, and maybe it's because we dropped from 85 or whatever to 60, which is crazy that the market would get nervous about that.
Yeah, exactly. And so, I'm in the camp that good news is good news because I thought the Fed and the inflation story was in the back seat and that therefore good news equals soft landing. So let's applaud that. But after the probability changes, maybe the market is still sensitive to wanting to get those 6 cuts this year.
Yeah,
and given the price action, though, I think those technicals, the kind of the orange flags that I identified on Tuesday there, that is showing us that we just ran too much in 2 months, in the final 2 months, and we need to kind of, give some of that back still.
True. All right, so we got too hot and possibly even way too aggressive on the sincerity with which the market thinks that first cut is coming. It doesn't like dropping from it. If they're sensitive to drop from 80 to 65%, then all right, we're probably over our skis there.
Price action is suggesting that, yes.
Okay. Mike, let's talk some policy. We've been so focused on inflation stuff, almost forgotten it's an election year. Of course, some argue, that and why we're cutting. What's the most important thing that you're thinking about right now?
Well, we're in the short term, we're watching a potential for a government shutdown later this month. So Congress comes back from its holiday break next week, and they've got a couple of deadlines coming right up. About 20% of the federal government is funded only through January 19th. The rest of the federal government is funded only through February 2nd. If they don't get a deal to extend that funding, we're looking at a government shutdown. I think chances are reasonably high that we do get a shutdown. Now, as we discussed before on this program, the markets don't kind of overreact to government shutdown. But if it's an extended one of weeks, then we're talking about a potential real impact on broader economic numbers. So it's definitely something to watch. And as you know, it's just crazy here right now in terms of the partisan shakeup and the divided between the parties. Really hard to see how they get to some decent solution here. And that's not even mentioning the whole debate over Ukraine funding, Israel funding, all of which is tied to border security. So you got a host of issues kind of crashing together this month. I think it's going to be a really busy month for NBC.
My crazier has it been border specific that has held up previous functionality of the government?
Yeah, they've gotten really come together now. Republicans are really pushing for tough border restrictions, more money for the border, and they say they're willing to shut down the government over it. We'll see if that's a hollow threat in the next 4 weeks, but these two issues have become really tied closely together, and I think that's going to dominate conversation here over the next week.
Yeah, that definitely seems to be a pretty astute observation that that's where the geopolitical funding is now kind of competing. Musk is tweeting like imagery of people across the board and stuff. It seems like a hot topic thing. So then the possibility that, I don't know, at this point when markets get nervous about us dropping down, the rate cut from March to May, then maybe they will have a problem with the government shutdown for the first time ever. But Mike, one other thing here. You're watching the crypto stuff. What's going on down there?
Yeah, lots of attention here right now on the whole crypto thing. And I listened with interest to the Bitcoin the Bob segment just a few minutes ago. There's a lot of speculation, obviously, with the SEC, finally approved the Bitcoin ETF, as soon as tomorrow or early next week. I'm a little more on the skeptical camp. Gary Gensler has been just openly hostile as SEC chair to crypto for his entire term. And I really wonder whether he's going to approve something without having courts telling him that he has to approve it. So I think it's going to be really interesting to watch how this plays out over the next few days. There's certainly a sense here that it's going to happen. I'll believe it when I see it.
All right. Great stuff. Imminent. Obviously, the election 10 months from now. Let's talk about that next time, Mike, in your next celebrity appearance. Appreciate it, sir, as always. Hey, I love you too, Nate.
I understand.
Thanks, guys. Nate Peterson, Mike Townsend. When we come back, actually, we're going to hit the bell right now. There it is. Perfect. So Dow manages to squeak out an A again. Dow, just old man strength. The Dow exhibiting here. When everything else is struggling. These are not big moves. but the timing is a bit peculiar as we've been discussing with jobs tomorrow. It sure seems like most outcomes for jobs would be well received, given how accommodating generally the Fed's language has been. Maybe minutes really changed people's minds about what possibly did for the Fed. Bonds did sell off today, so that is notable, but our 2-year is still just at 4%. So if stocks are this sensitive, these kind of weird bonds might give us something to talk about. Dollar there did end slightly lower, but not a lot. Crude oil finished a bit lower. We saw inventories again generally favor the bears. Saw one description of, I think, the weekly gain in gasoline inventories being the biggest since like 1993. I know somebody who would know. Let's get Kevin Grant and Nicole Perlitz in here for a closing count. Let's watch this from Bank 360, of course, Kevin Green, the senior markets correspondent. But a big crude watcher. Did I get that stat on inventories right, Kevin? What was the inventory takeaway today? I heard it was like one of the biggest gasoline bills in a long time.
The distillates and some other byproducts as well, and that's actually not surprising.
What was it? Sorry, it's like your audio was a bit off there by a second.
Yeah, it was fairly big. Yeah, I don't know if it's back into 95, but it was a significant buildup. But if we look at the structure of that album, what's actually happening in the last couple of weeks, we saw this huge buildup in inventories for crude oil, pretty much the last 2 or 3 quarters, if you will. And we saw these huge drawdowns in gasoline, huge drawdowns in distillates, huge drawdowns in heating oil. So now we saw this huge drawdown in inventories, and now you're seeing the refiners basically taking that inventory and then making a final product. So what you really kind of want to focus on is what's happening in Cushing inventory. That's where we really transport a lot of the oil, and that's been, for the most part, stable. We are seeing the export demand starting to fall off here a little bit, but right now, we see finally we're getting ready for March and April this year. That's where the spread is. That's where the market is really pricing in the AMZ increasing, and it's trying to take the time right now to be able to get these refineries up and running as much as possible, especially when it's cheap, and then try to make that spread in Q1 and Q2 this year.
Got it. All right. Thanks for that, WTI. And cozy down here in the low 70s, just stuck. But that kind of comes back to our general conversation going into tomorrow's employment, Nicole, because it's kind of been a situation where nothing can do any wrong to the stock market. We've been so impervious for so long, but it's like this week we can't get anything going.
So long. Well, I like it. I'm going to take so long because it was 9 weeks in a row of games. So I'll take it. I think so long was a really long time of games. However, we had obviously up and down throughout 2023. And the question that I find in the conversations that I have here on the floor is whether or not everything was overextended. Were we just due for a little bit of a mild pullback? Were we due for a little bit of profit taking? And that seems to be the question. Now, here's the thing. The NASDAQ has 2 days of 1% losses to kick off this new year. You know the last time the NASDAQ kicked off a new year with a 1% loss and a 1% loss? A long time ago. It was 2005. And before that, it was 1980. What? Okay? Everybody was listening to, I mean, I can't even say Duran Duran because that was in the late 80s. So I don't know what you were listening to in 1980s, but that's the point. It shows you how uniquely bad it really is. So, but I don't think it tells the story of what 2024 is to come. So, but it is worth noting that our kickoff here is a particularly tough one. As far as the jobs picture, I'll take that short. You have a very strong jobs picture. ADP comes in stronger than expected. Jobless claims to fall. You're seeing demand for services. Factory jobs have come down a little bit. The good thing is that wage growth has been slowing, and we're seeing that in ADP print. And hopefully we'll continue to see that tomorrow as well. And that will sort of battle with this inflation picture. Inflation going in the right direction.
There's still a lot of data points to come over the next couple of months. Your point about start the year being kind of uniquely negative, I didn't realize, that kind of the early year effect, Santa Claus kind of carryover rally is the real deal. And it does, kind of bring it back to this conversation we were just having too about some of those metrics getting super hot super overbought? How do we distinguish, Kevin, from a technical perspective, when we're in break mode, breather mode, pullback mode, and like actually turning of tides? I mean, we wouldn't describe this as turning of tides, so at least not until we get some, big data. We do this tomorrow in employment, but okay, maybe.
Yeah, there's a lot there, so let me just condense it here really quickly. For a lot of technicians, last week was very difficult, however, because it was already a holiday week. So you had light volume. In a normal week, if you had that light volume like last week, yes, you would say that we were overdone to the upside. The ZIM Trade to the pullback, but we can't really confirm that right now. So this week is going to basically replace what we did last week, and then we'll try to confirm from there. If you're looking at it from a TCI standpoint on the 1-year daily chart, we are starting to get towards maybe some more sold levels, but the RSI is not there yet. So what I would do is focus on the weekly chart. The weekly chart does show that we still have some moves on the downside. I would say the 50-day moving average for the S&P 500 would be a good gauge to see a little bit of a rebound here. But when we're looking at seasonality as well, usually the first 2 weeks of January are decent. The last 2 weeks is where we actually start seeing the volatility going up through February, and then out of February to into March is when the market starts to rally again. So we kind of have a lot of historical precedents right now to say we really don't know where this market's going to go, because the technicals say, yeah, cool off. The seasonality says we're a little bit backwards, and economic data, for the most part, some of the economic data is not good, but some of the economic data says, hey, we should be able to hold up for the most part right now. I think we're just waiting for earnings. We have good earnings announcements in some of these big names. I think that'll carry the market forward back to the upside here in short.
Right, we do have those coming up pretty soon too. Dobbs first, though, then the earnings start to kick in. This data so far this week, I mean, pretty good. The job numbers have been real solid, so maybe tomorrow could go surprisingly good. Maybe talking also about the stock problems that Apple presented, but you also had the big Mobileye crash today. Do you think that hit the market? Cool.
Look, I think that goes with the big picture. And by the way, some of the whisper numbers for tomorrow are definitely higher than the current estimates that we're seeing. So I think that is always worth noting. That being said, when I look at what happened with Apple week to date is down 5.6%, has 2 downgrades this week. Mobileye is down over 30%. Now, you may remember this was spun out from Intel. Intel still has an 88% holding of the outstanding interest. So it's worth noting, Intel got down arrow today, but ever so slightly, Intel's been a stellar performer. 1 year is up 75%. The problem with Mobileye may not be a problem at all, but it's too early to tell.
Yeah.
The supply chain started to work. They have all their advanced exercise driving systems ready to go, but they have too many. They have an excess. So the question, and they say they expect that excess to be used in the first quarter. In fact, the impact could be much less than what they're saying, but they are warning, expecting first quarter revenue to drop 50%. And that spooks folks because they said, is this a self-driving technology problem? Is this a chip problem? And what is the problem? And this just may be a check and balance problem. Too many driving assistant technologies, but that the demand, in fact, is not the desire for that assisted driving technology. It just was too many in one place at one time. So by the end of the first quarter, this may be a very old story, and at 29, it's just under $30. Let's check back and see if it's a winner.
I don't know. I feel like there is a lot of evidence building here. I saw a report on Bloomberg last week talking about how the EV adoption rate estimates keep dropping lower, and to a very surprising degree. They're like consistently dropping lower. Obviously, Tesla's had to do all the markdowns. The potential here that maybe some of the chip kind of clean out that happened over the last year. I mean, I look at the BMW, the EV ETF, they're down 1%. Chips are only down 1%. I think this might be like a Mobileye specific product. But having how many of these kind of stories, especially with oil, though, that some of these sectors, that autos, Silicon Rock, the tech stuff, just not quite living up to some of these expectations. It could get interesting.
Yeah, definitely. I would say from an EV standpoint, we actually have seen this type of cycle before in the past. Usually when you start seeing gasoline prices going down and bringing create this inverse relationship. And you could also add in interest rates. So that would not be surprising. What I would say though is that channel check immobilized does cause a little bit of concerns for me, Oliver, when it does come to earnings, because at the end of the day, who are the customers that aren't able to sell their cars enough and have this much backlog? That is a little bit of a concern, to say the least. And then the last thing I will say, from a semiconductor standpoint, I feel like that industry still has another week or two, or maybe some pressure to the downside because of the Taiwan election that is going on next week. I think that channel will probably continue to get some volatility here. But I'm right there with you. I mean, that's a fair amount of backlog, to say the least, to try to ride it off and say it's going to be good. And then, of course, I think that's going to be a risk.
Fully contained it. All right. Also appreciate the KG Global Calendar alert. You always feel it in there. I love it. Taiwan election. So I appreciate it. Thanks, Kevin Green. Thank you for Pedalese. Great chat, guys. When we come back, you overlook stuff in the day. Pretty simple. Good food. At least that's what they pretend to have. Chart. Exactly. Chart.
Young lady who was mid-30s, a couple of kids, recently went through a divorce. She had a lot of questions when she came in. I watched my mother go through being a single mom. At the end of the day, my mom raised 3 children, including myself. And so once the client knew that she was hurt, we were able to help her go forward. The client won't care how much you know until they know how much you care.
Download the Schwab Network app and join in on the latest market trends. Anytime, anywhere, on any device for free. Schwab Network.
Wrap up the trading day with me, Oliver Reddick. Biggest earnings coverage, 3 p.m. Eastern. It's Market on Close. No place better than the Schwab Network.
All the need to know info from every trading day. I'm ready to go. Earnings, data, the biggest headlines that move the market, all condensed into a few minutes. Download the Schwab Network app and join in on the latest market trends. Available anytime, anywhere, any device, for free. Recap your trading day with the wrap, right here on schwabnetwork.com.
Binge watch the market with the Schwab Network. Tune in 24 hours a day, 7 days a week on schwabnetwork.com and on all of your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free. Binge watch the market with the Schwab.
Okay, I'm back. Looks like we bounced a little bit after hours. We broke through 4,700, so you have to go with the risk-off scenario for now. I'm your host, Cousin Vinny, coming to you from theclosingprint.com. It's 15 minutes after 4 o'clock p.m. on the East Coast. Have a great evening, everyone. Take care. We'll see you tomorrow, bright and shiny and ready to trade. Take care. Ciao.